Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's dive into the world of Bitcoin and cryptocurrency trading. If you're just starting out, it can feel, a little overwhelming. But don't worry, in the next few minutes, we're going to give you the map and the compass you need to navigate the absolute essentials and get you started on your journey. So right off the bat, here's the biggest question you've got to ask yourself. Is this actually for you? I mean, you hear these incredible stories of fortunes being made like overnight, but then you also hear the horror stories, right? That it's just a massive, high-stakes gamble. The truth? It's a thrilling and, sometimes terrifying mix of both. And this just shows you exactly why. Just look at this roller coaster. Bitcoin shot up from about $1,100 to nearly $19,000. Then, whoosh, it crashed all the way back down to $3,800. And just when you thought it was over, it soared again to a brand new all-time high. It's wild, it's unpredictable, and honestly, that's exactly why traders are so drawn to it. So, what is Bitcoin, really? Let's pull back the curtain and get a handle on the world's most famous cryptocurrency.
Unlike the dollars in your wallet that a government just prints, Bitcoin is purely digital. It's literally created out of thin air by a massive global network of computers. And this whole process is called mining.
So here's a cool way to think about it. Imagine a digital Rubik's Cube that's filled with all the latest Bitcoin transactions. Now, every 10 minutes, thousands of super powerful computers all over the world are in a frantic race to solve this super complex puzzle. The computer that wins gets to add a new block of transactions to the public record, and for their hard work, they get rewarded with brand new Bitcoin. It's a pretty genius system, really. It creates new coins and keeps the entire network secure at the same time.
Okay, so you've got the basics down. Now, what do you actually need to start trading? Let's open up your essential crypto toolkit. There are two main things you gotta have. First, a crypto exchange. Think of this as the marketplace, the stock exchange for crypto, where all the buying and selling happens. And second, you need a wallet. This is like your own personal digital vault to store your crypto safely after you've bought it. Now listen, these two things are not the same, and knowing the difference is absolutely crucial.
And when it comes to wallets, you've got options. A mobile wallet on your phone? That's kind of like the cash in your pocket. It's super convenient for quick access and smaller transactions. A hardware wallet, on the other hand, that's like a high-tech, fortified bank vault. It's built for maximum security, for those larger amounts you plan on holding for a long, long time.
All right, you've got your tools. Now it's time to learn a bit of the language. Let's start with the most basic thing you'll see on any trading screen.
Okay, so when you first see a screen like this, it looks crazy, right? All these charts and numbers. Just ignore all that for a second. I want you to look right here. See that? BTC/USD. That's your starting point for everything. That's called a currency pair, and it's actually way simpler than it looks. The first one, BTC, is the base currency. That's the thing you're trying to buy or sell, Bitcoin. The second one, USD, is the quote currency. That's what you're using to pay for it, in this case, US dollars. So BTC/USD simply means you're buying Bitcoin using dollars. That's it.
Now, before we go any further, I have to stop and tell you about the one golden rule of crypto. If you learn nothing else today, learn this. It's the most important lesson for keeping your money safe. Say it with me. Not your keys, not your crypto. Let that sink in. Your keys are basically the secret passwords that prove you own your Bitcoin. And here's the kicker. If you leave your crypto just sitting on an exchange, well, the exchange holds those keys, not you. You're basically trusting them to hold your money for you.
And let me tell you, history has shown us why that trust can be a really bad idea. The famous Mt. Gox hack? 850,000 Bitcoin just vanished. Poof, gone. Or the exchange Quadriga CX, which just collapsed, locking everyday users out of their money forever. This is exactly why you use a personal wallet, where you and only you control the keys.
Okay, so with all this talk of risk, you might be wondering, where is all this headed? Well, let's zoom out and look at the bigger picture, because something has fundamentally changed recently.
You see that huge price explosion back in 2017? That was mostly fueled by regular people like you and me, what they call retail hype. But the more recent surges, that's a whole different ballgame. This time it's being driven by the so-called smart money. We're talking huge hedge funds, major corporations, and serious institutional investors all piling in.
And these big players are making some predictions that are, well, they're pretty astonishing. For instance, the chief investment officer at Guggenheim, a massive, respected financial firm, said their own fundamental research puts the potential value of a single Bitcoin at $400,000. Wow.
Which brings us right back to where we started. Is this whole thing the actual future of money? A revolutionary new asset that's now being legitimized by the world's biggest investors? Or is it still just a crazy high-stakes gamble? The real answer is probably somewhere in the middle. But now you're a whole lot better equipped to start finding that answer for yourself.
All right, welcome to The Explainer. Today, we are jumping headfirst into Bitcoin. Yeah, probably one of the most volatile, most misunderstood assets out there. So what's the deal? Is it a scam? Is it the future of money? Let's dig in and find out.
Okay, so to really get Bitcoin, you've got to look at its price history. And honestly, calling it a roller coaster, that's an understatement. It's more like a rocket ship that occasionally falls out of the sky. We're talking about a story of absolutely incredible highs and, yeah, some pretty gut-wrenching lows. Fortunes have been made and lost in the blink of an eye. Just to give you an idea, think about this. In one single cycle, it blasted off from about $1,100 all the way up to almost $19,000. I mean, that kind of jump in such a short period, it's practically unheard of in traditional markets.
But you know what they say? What goes up often comes down, and sometimes it comes down hard. After hitting that incredible peak, it just plummeted. We're talking a crash all the way back down to $3,800. Can you even imagine holding on through a drop like that? It's the kind of thing that would give any investor nightmares.
And yet, after all of that drama, all that volatility, in late 2020, it did something nobody thought was possible. It didn't just crawl back. No, it completely smashed through its old record, setting a brand new all-time high of over $28,000. Just incredible. So all this craziness, these wild swings, it really brings us to the fundamental question, right? What is this thing? How can something so unpredictable even be taken seriously? Well, that's exactly what we're going to break down.
All right, let's get into the big debate. When it comes to Bitcoin, there is no middle ground, it seems. The opinions are about as polarized as you can get. You've got people screaming scam on one side and financial revolution on the other.
So you really have these two extremes, right? On one side, you've got the people who are absolutely convinced it's nothing more than a scam, a giant bubble waiting to pop. And on the other side, you've got believers who treat it almost like a religion. So to find the truth, we're going to have to walk a path right down the middle, cut through all that noise, and just look at it for what it is.
So how do we figure out if it's a scam or a revolution? Well, we can't just listen to opinions. We need a system, a framework. And really, the best way to do that is to measure it against the fundamental rules of what makes for good money. These are rules that have been figured out over, centuries.
But wait, before we jump into those rules, we need to understand a key concept, how Bitcoins are even made. See, unlike the dollars in your wallet that are printed by a government, Bitcoin is mined. It's this wild process where thousands of super powerful computers all around the world are basically in a race to solve a really complex math problem. When one of them cracks it, a new block of transactions gets verified, and boom, new Bitcoins are created as a reward. This whole mining thing is crucial to one of its most important features.
Okay, so what makes money money? For basically anything to work is good money. I don't care if it's a seashell, a gold coin, or a digital token. It needs to have these 5 key things going for it. It has to be divisible, durable, rare, uniform, and, well, people have to accept it. This is the checklist. This is the yardstick we're going to use to see how Bitcoin measures up.
All right, time for the showdown. Let's put Bitcoin to the test. How does it actually stack up against these 5 properties, especially when you put it side by side with the old guards, like the US dollar and gold?
And when you lay it all out like this, you can really see where Bitcoin shines and where it, well, kind of stumbles. I mean, divisibility, you can divide it into 100 million tiny pieces. Durability, it's digital, so it's perfect. But its biggest strength is rarity. There will only ever be 21 million coins, period. It can't be inflated away like the US dollar. But it does hit a potential snag when we get to uniformity.
So here's the catch, the uniformity problem. The fancy word for it is fungibility, and it just means that any 2 units are basically the same. Like a brand new dollar bill is worth exactly the same as a crumpled one that's been in a million pockets. But with Bitcoin, it's different. Every single transaction is recorded on a public ledger. You can trace a coin's entire life story. And that means a coin that was, say, used in some illegal activity could be seen as tainted. And that's a big deal. It could be rejected or even valued less than a clean one. This is a real challenge for its potential as everyday money.
Okay, so now that we have that foundation, we can finally talk about what the heck happened in 2020. That massive surge past $20,000, it was different from the rallies before it. This time, the really big story was all about who was doing the buying.
The entire conversation just shifted on its axis when huge players from Wall Street started talking. I'm talking about guys like Scott Minerd, the chief investment officer for Guggenheim. He came out with this absolutely stunning prediction. He wasn't just saying, hey, we're buying some. No, he was putting a potential price target on it of $400,000. A number like that, coming from a guy like that, yeah, that gets everyone's attention.
So this wave of what they call smart money, all this institutional interest, it was the fuel that finally pushed Bitcoin to smash right through that massive psychological wall at $20,000. An asset that was once, laughed at by a lot of Wall Street types was suddenly becoming a must-have for some of the biggest portfolios in the world. It was really a perfect storm, You had hedge funds pouring in billions of dollars. You had huge companies like PayPal jumping on board, making it super easy for millions of people to buy. And all this was happening while there was this backdrop of huge economic uncertainty and the Fed's policy of, basically printing endless amounts of money. When that happens, a super scarce asset like Bitcoin starts to look pretty darn attractive.
So, after all that, what's the big takeaway? What's the bottom line for you?
Look, given how incredibly volatile this thing is, the main advice you'll hear is to be careful. For most people, this is a high-risk asset, plain and simple. A pretty common rule of thumb is to only put in what you are 100% prepared to lose. The potential for huge gains is there, for sure, but the risk of a massive drop is just as real.
And that really leaves us with the ultimate question, doesn't it? When you look at it on paper, on a purely technical level, you can make a really strong case that Bitcoin has the properties to be the best form of money ever created. But is the world actually ready for it, or are these insane price swings just a taste of an even wilder ride ahead?
All right, let's talk about one of the biggest hurdles when you're starting out in crypto, choosing an exchange. I mean, where do you even begin? There are literally hundreds of them. It can feel super overwhelming, I get it. But don't you worry, we're going to break it all down over the next few minutes and make this whole process a lot less scary. So, you've made the decision, you're ready to dive in, ready to buy your first Bitcoin, maybe some Ethereum, who knows? The excitement is definitely real. But that excitement usually leads right to the first major roadblock that pretty much everyone hits. And there it is. With all these options staring you in the face, it can seriously feel like you're lost in a maze. You're trying to figure out fees, security, which ones even work in your country. It's a lot. But hey, that's what we're here for. Think of this as your personal guided tour to get you straight through the confusion. All right, let's get this tour started. We're going to navigate this maze together, and by the end, you'll feel way more confident about making that first move. Okay, but hold on. Before we even look at a single exchange, we need to talk about the golden rule. Seriously, this is the most important piece of advice you'll get, and it's absolutely critical to get this right from the very beginning. This is it, right here. An exchange is for one thing, exchanging. It is not a bank account, it's not a vault. I want you to think of it like an airport terminal. You go there to catch a flight. You don't live there. Never, ever leave a large amount of your crypto just sitting on an exchange. So what's the right way to do it? It's a simple two-step dance. Step 1, you buy your crypto on the exchange. Step 2, you immediately withdraw it to a personal wallet that you control. You hold the keys. And if you want the absolute best security, you want to look into a hardware wallet, something like a Ledger or a Trezor. That's the gold standard. Okay, security lesson over. Now that we've got that down, let's finally talk about the exchanges themselves. And we have to start with the two biggest names in the game, the undisputed heavyweights, Binance and Coinbase. So when you put them side by side, you can immediately see the fundamental difference. Binance is built for traders. It's got a massive selection of coins. We're talking tons of altcoins, and the fees are super low. Then you've got Coinbase. Their whole mission is to be the easiest on-ramp for absolute beginners. They prioritize a clean, simple user experience above all else. But you do pay for that simplicity. Yeah, let's zoom in on that number for a second. 0.1%. That's where Binance's fees start. What does that actually mean? Well, if you make a $1,000 trade, you're paying $1, just $1. On Coinbase, that same trade could cost you like $15, $20, maybe even up to $40. If you plan on trading even a little bit, that adds up fast. Now, Coinbase knows its fees are higher, so they have some pretty sweet perks to get you in the door. You can often get free Bitcoin just for signing up. And their Coinbase Earn program is actually really cool for beginners. You basically watch short videos about different cryptocurrencies, answer a few questions, and they give you some of that crypto for free. It's literally like getting paid to do your homework. Pretty neat, right? So why would anyone pay those higher fees? Well, this is the big reason: security. Coinbase has a reputation for being a fortress. They have yet to suffer a major platform-wide hack. And a huge reason for that is it keeps something like 97% of their crypto in what's called cold storage. That just means it's completely offline, disconnected from the internet, tucked away where hackers just can't get to it. For a lot of people, especially when you're starting out, that peace of mind is priceless. But look, it's not just a two-horse race. The crypto world is way bigger than that. So let's talk about a couple of other major players, the strong contenders that give the big guys a run for their money: Kraken and KuCoin. And again, we see two very different philosophies here. You've got Kraken, the old guard, founded way back in 2013. It's built its name on trust and security. Then you've got KuCoin, the newer, scrappier competitor that's all about low fees and privacy. And that last point is a really big deal for some people. So what's the deal with Kraken? Why do people love it? Well, for one, it's an OG in the space. It's been around forever, which means it has a solid reputation. It's also really good at letting you trade directly with regular money, like US dollars and euros. And on top of that, it has some fantastic options for staking, which is just a fancy way of saying you can earn rewards on your crypto by helping to secure the network. Now, this right here is KuCoin's secret weapon. It doesn't force KYC or know your customer on everyone. What's KYC? That's when you have to upload your driver's license and a selfie to prove who you are. By not requiring that for every single user, KuCoin offers a level of privacy that's getting harder and harder to find on the big centralized platforms. Okay, so everything we've talked about so far, Binance, Coinbase, all of them, they're all companies, centralized exchanges. Now, I want you to throw that idea out the window for a second, because we're heading to the decentralized frontier. Welcome to the world of Uniswap. So what on earth is a decentralized exchange, or a DEX? Honestly, it's a mind-bending concept at first. Imagine a vending machine instead of a store clerk. There's no company in the middle, no one holding your money. It's just smart code running on the blockchain that lets you trade crypto directly from your wallet with someone else. No middleman, period. This really is the core difference. With a centralized exchange like Binance or Coinbase, you are trusting them to hold your funds. It's their house. With a decentralized exchange like Uniswap, you are always in control. The crypto never leaves your wallet until the second the trade happens. It's the ultimate expression of that old crypto saying, not your keys, not your coins. On a DEX, they're always your keys. But, and this is a huge but, with great power comes great responsibility. Uniswap is definitely not for beginners. You have to know your way around an Ethereum wallet, and you have to be incredibly careful. Since anyone can create a token and list it, there are a lot of scams out there. It really is the Wild West of crypto. But it's also where you can find the most exciting, brand new projects before they hit the mainstream. Whew, okay, that was a lot. We've gone from the super simple on-ramps all the way to the decentralized edge. So now, for the big finale, let's figure out which of these is the right fit for you. It all comes down to this one simple question. What do you care about most? Seriously, there's no single best exchange. It's about what's best for you. Is your number one priority just making it as easy as possible? Are you trying to save every last penny on fees? Or is privacy the most important thing to you? So here's a little cheat sheet to help you decide. If you are brand new to all of this, just start with Coinbase. It's designed for you. If you're watching your budget and want the lowest possible fees, you're looking at Binance or KuCoin. For the privacy-focused folks, KuCoin is a great middle ground, and Uniswap is the most private option. And finally, if you're an explorer, someone who wants to see the future of finance being built, well, Uniswap is your playground. Look, I know choosing an exchange can feel like this massive final decision, but try to remember, it's not the destination. It's just the front door. The journey into the wild and wonderful world of crypto, well, that's just getting started. So now you know the main gateways. You've got the map. The only question left is, which path are you going to choose? The adventure is yours for the taking. Good luck out there. Okay, so you own some crypto. Chances are you bought it on an exchange and it's just sitting there. But here's a thought. Is that money really yours? Today, we're going to get into the super important step of taking true control of your digital assets. We're counting down the top 5 mobile wallets that put the power right back where it belongs, in your pocket. So let's just start with that really crucial question. You open up your exchange app, you see the balance, you made the trades, so you own that crypto, right? Well, you might be surprised to learn that it's not quite that simple. This is a question every single person in crypto has to face, and the answer is a real eye-opener. And that leads us to probably the most important phrase in this entire space. You'll hear it everywhere. Not your keys, not your crypto. And listen, this isn't just some catchy slogan. It's a fundamental truth, a serious warning about what it really means to own something in the digital world. Right, so section 1, let's really dig into this. What does not your keys, not your crypto actually mean? I mean, what's the big deal with leaving your coins on an exchange anyway? Let's break it down. Here's the bottom line. The thing that gives you, or anyone, control over cryptocurrency is something called a private key. And when your coins are on an exchange, you don't have that key. The exchange does. That means you are trusting them 100% with all of your money. And that trust, it comes with some massive, massive risks. And I'm not talking about some theoretical risk either. Let's talk about the Mt. Gox hack. It was infamous. A staggering 850,000 Bitcoin just gone, poof, stolen from the exchange and from all the users who were trusting it. And the story doesn't end there, not by a long shot. More recently, you had the Italian exchange BitGrail. It got hacked and its users lost a cool $170 million worth of crypto. And then you have the whole Quadriga CX mess up in Canada. Another $119 million just vanished. The list, believe me, goes on and on. This is a real recurring problem that you need to be aware of. So, if leaving your crypto on an exchange is basically a high-stakes gamble, what's the alternative? Well, thankfully, the solution is probably already sitting right in your pocket. We're talking about a mobile wallet. It's really just an app on your phone, but it does something incredible. It lets you hold your own private keys. You control them. And this, my friends, is a total game changer. It means you're not trusting some company anymore. You're trusting yourself. You get true, undeniable ownership. Okay, so now we know why we need a mobile wallet. The next big question is, which one should you get? Let's kick off our countdown, starting with wallets 5 down to 3. All right, kicking things off at number 5, we have the Ledger Nano X. Now you might be thinking, wait a minute, that's a hardware wallet. And you're right, it's a little physical device, but it pairs with a fantastic mobile app called Ledger Live, which makes it this really powerful hybrid solution. So the pros are pretty obvious. Security, security, security. We're talking Fort Knox level protection for your coins. But there's a big trade-off. To send any crypto, you physically need the device with you to approve the transaction. That makes it, kind of useless for paying for things on the fly. That hassle, plus the $119 price tag, makes it a tough sell for just everyday use. And that really sums up the Ledger perfectly. You're getting the absolute best security that money can buy, no question. But you're sacrificing that quick, easy convenience that most of us want from a mobile wallet. It's an amazing piece of tech, but you're not going to use it to buy a coffee. All right, moving on to number 4, we have Coinami. This one is a true OG in the wallet space. It's been around forever, all the way back to 2014, which is like ancient history in crypto terms. Konami's main claim to fame is its insane asset support. We're talking over 1,700 different crypto assets. It's also great for privacy because it hides your IP address, and you can trade and stake right in the app. Now, full disclosure, some users in the past have mentioned it could be a bit buggy, but it seems like recent updates have smoothed a lot of that out. So who's this for? Well, if you're an altcoin hunter, someone who loves collecting those weird exotic coins, this is your jam. Or if you're big into NFTs, or if you just really, really value your privacy, then Coinomi is definitely one to put on your shortlist. Cracking our top 3 is Trust Wallet. This is a really top-tier option, and it comes with some serious backing from one of the biggest names in the industry. So one of the best things about Trust Wallet is that it's open source. That just means anyone can look at the code to make sure it's secure. It's also the official wallet of Binance, which is, only the biggest crypto exchange in the world. Plus, for all you DeFi fans, it's got a Web3 browser built right in, so you can play with these centralized apps or DApps directly from your phone. Super handy. All right, we've made it to the top 2. Both of these are absolutely fantastic wallets, but they're kind of built for slightly different people. So let's see who's taking home the silver medal. And our runner-up is Atomic Wallet. Seriously, the very first thing you're going to notice about this wallet is just how good it looks. The interface is clean, it's slick, it's just a pleasure to use. So Atomic Wallet really scores high on its beautiful design and its awesome support for staking. That's where you earn passive income just for holding certain coins. But, and this is a big but, there's a major catch. If you want to buy crypto directly in the app with your credit card, the fees are, well, frankly, they're ridiculous. We're talking 7% with a $10 minimum. So it's great for managing your crypto, just maybe not for buying it. And now, the moment we've all been waiting for. Our number 1, top of the list, best all-around mobile crypto wallet is Exodus. Look, if a friend asks me which wallet they should get started with, this is the one I would tell them to download, hands down. It just nails that perfect balance between a gorgeous design, rock-solid security, and being incredibly easy to use. The user interface on Exodus is just chef's kiss. It's probably the most beautiful and intuitive wallet out there, which makes it absolutely perfect for beginners. Of course, all your keys and data are safely encrypted right on your phone. The trade-offs? Well, the fees for swapping coins inside the app can be a little high, around 2 to 5%, and it doesn't support every single obscure altcoin under the sun. But here it is. This is the single biggest reason Exodus gets the gold medal. They are, as far as we know, the only crypto wallet company that offers 24/7 live chat support with an actual human. If you're new to this stuff and you run into a problem, that kind of peace of mind is absolutely priceless. So there you have it, our top 5. But here's the thing, you don't actually have to choose just one. In fact, the pros don't. So let's talk about how to really use these tools smartly. The most important thing to remember from all of this is that there is no single best wallet for everyone, for every situation. It all depends on what you're trying to do. The smartest approach, really, is to use a hybrid strategy. Here's how you do it. Think of a hardware wallet, like that ledger, as the vault. This is where you lock up the vast majority of your crypto for long-term safekeeping. Then you use a mobile wallet, like Exodus, as the pocket. You just keep a small amount in there, maybe $100 for daily spending. And if you ever need to make a big purchase, you go to the vault. Simple, right? It's just like not carrying your entire life savings around in your wallet. So there you have it. We've talked about why you need to take control, and we've gone through the best tools to help you do it. You now understand the true power of holding your own keys. So the only real question left is, now that you have the keys to your own digital wealth, what are you going to do with them?
So you're in crypto. You know that the number 1 rule, the golden rule, is keeping your assets safe. Today, we are going to dive deep into the absolute best tool for the job, the hardware wallet. We'll break down what they are, which one is perfect for you, and most importantly, how to use them like a total pro.
Just imagine that for a second, that pit in your stomach feeling. You've been saving, you've been investing, you go to check your balance and poof, it's just gone. That absolute nightmare is exactly what we're going to learn how to prevent today.
Okay, so let's kick things off with a really fundamental question. If you bought your crypto on a big exchange and you just left it there, where is it, really? You might think you know the answer, but it's probably not what you expect.
And this slide, right here, gets to the heart of the matter. When your crypto sits on an exchange, you don't really own the crypto itself. What you own is an IOU. It's basically just a promise from that company that they'll give you your coins when you ask. They're the ones who hold your private keys. But when you move your funds to your own wallet, everything changes. You control the keys. You are, quite literally, your own bank.
Now, of course, there are other kinds of wallets. You've got software wallets on your phone or computer, and yeah, they're super convenient, but because they're always connected to the internet, your private keys are always at risk from viruses and malware. Look, they're fine for your daily coffee money, but you're not going to put your life savings on there, right? And paper wallets, honestly, they're just outdated and really not safe to use anymore. So, what's the real solution?
And that brings us to the hero of today's story, the hardware wallet. The best way to think about this is like your own personal, offline, digital Fort Knox for all your crypto assets.
So what exactly is it? Well, put simply, it's a small physical device, kind of like a fancy USB drive, that keeps your private keys completely 100% offline. The real magic is that it can approve transactions without those keys ever touching your computer or the internet. It's like having a bank vault where the master key is literally sealed inside the vault itself. It never, ever comes out.
And this is how that magic happens. You set up a transaction on your computer, right? Then the details get sent over to your little hardware wallet. You look at the screen on the device, and you have to physically press a button to say, yes, this is correct. Only then does the wallet sign the transaction internally with the key that's locked inside and sends just the signature back. Your keys, they never leave the device. They stay safe, sound, and totally offline.
Now, we have to be real for a second. These devices are amazing, but they're not magic. They can't protect you from what's called the $5 wrench attack, which is just a grim way of saying, physical threats. And this is so important. I cannot stress this enough. Never, ever buy one of these things from a random site like eBay. A scammer could have tampered with it before it even gets to you. You only buy directly from the official manufacturer. Period.
Okay, so now that we've got the serious stuff out of the way, it's time for the fun part. Let's count down the top 5 hardware wallets you can buy right now. We're going to start with number 5.
Coming in at number 5, we have the Keep Key. Now, this one's been on the scene for a while, since 2015, and it was actually bought by the crypto exchange Shapeshift, which gives it some pretty cool built-in features.
For just $49, the Keep Key is our budget champ. It's an awesome entry point if you're just getting started. It has this huge, beautiful screen for the price, which makes it super easy to see what you're signing. Plus, it has Shapeshift built right in for easy trading. Now, the big trade-off here, and you got to pay attention to this, is the coin support. It only handles about 40 coins, so definitely check if your favorite ones are on that list.
All right, in our number 4 spot, we have a really premium device from the OGs of hardware wallets, Satoshi Labs. This is the Trezor Model T.
The Model T is all about that premium, easy-to-use experience. It's got this gorgeous full-color touchscreen that makes everything feel so smooth and intuitive. It might just be the easiest wallet on this list to set up. But that luxury experience comes at a price, $165. And it's worth noting, while there is a known physical hack, let's be clear, a hacker would need to physically have your device in their hands to even try it. This isn't something they can do over the internet.
So, sliding into the number 3 spot is the wallet that basically started this whole industry, and it is an absolutely fantastic deal. It's the original Trezor One.
Okay, so here's the deal, and this is why it's number 3. For just $55, the Trezor One gives you the exact same core security as its super expensive big brother. Yeah, you lose the fancy touchscreen and support for a few big coins like XRP and Cardano, but if you're hunting for value, getting this level of security for this price is an incredible deal.
And now for our runner-up. This is a device that has become one of the most popular, if not the most popular hardware wallet in the entire world, the Ledger Nano S.
For just $59, the Ledger Nano S arguably offers the best security on the market. There are just no known remote or physical hacks for it. It supports over 1,000 different coins through its Ledger Live app. So what's the catch? Well, there's one big one. You can only store about 4 or 5 coin apps on the device at once. So if you hold a bunch of different coins, you might find yourself constantly uninstalling and reinstalling apps, which can be a real pain. And that one little annoyance with the Nano S brings us directly to our number 1 pick. This wallet takes the unbeatable security of Ledger and just supercharges it with all the features a serious investor could want. It is, of course, the Ledger Nano X.
The Nano X completely solves that big frustration with the Nano S. You can store up to 100 apps on this thing at the same time. It also adds Bluetooth, which means you can securely manage your crypto on the go with your phone. For anyone who's juggling a portfolio of a lot of different altcoins, the convenience here is just unmatched. It's worth every penny of that higher price tag.
All right, decision time. Let's put all 5 of these head-to-head so you can really see how they stack up. You've got the Ledger Nano X leading the pack on features, the Nano S and Trezor One in a dead heat for best value, the Model T as that premium, easy-to-use option, and the Keep Key as that perfect, low-cost entry point. So, how do you possibly choose?
Well, let's make it easy. Let's break it down by who you are. If you're a value hunter, just get the Trezor One. If you're a security maximalist on a budget, the Ledger Nano S is a no-brainer. If you're an altcoin diversifier with tons of different assets, you need the space of the Ledger Nano X. If money is no object and you just want the slickest experience, go for the Trezor Model T. And if you're a total first-time buyer, the Keep Key is a great safe way to start.
Okay, so you've picked out your perfect wallet. Awesome. But let's not stop there. Let's talk about a few next-level pro-gamer move security measures you can take to make your setup basically unbreakable.
Here are 3 of my favorites. First, your seed phrase. That's your master backup key. Don't just write it on a piece of paper. Get a UV ink pen and write it inside an old book. It's totally invisible without a blacklight. Second, distribute your risk. Don't keep everything in one place. Maybe put the wallet itself in a safe at home and the seed phrase in a safe deposit box across town. And third, and this one is genius, create a decoy wallet. Both Ledger and Trezor let you do this. In a worst-case scenario, you can give an attacker the password to a decoy wallet that only has a little bit of crypto in it, while your real stash stays completely hidden.
And all this really brings us to our final critical question. A hardware wallet absolutely makes your crypto secure. But true safety? That comes from thinking about everything else too. So at the end of the day, it's not just about whether your keys are secure, it's about whether your entire plan is safe. That's all for now. Stay safe out there.
Hey everyone, and welcome. If you've ever looked at a crypto trading screen and felt completely lost, you are in exactly the right place. Today, we're going to break down the one thing you absolutely have to know to get started: currency pairs. Let's jump right in. So, when you first open up a trading platform, it really can feel like you're trying to crack some kind of secret code, right? You've got charts, numbers, and all these weird abbreviations flying around. But trust me, we're about to decode this thing together. I mean, just look at this thing. It's like the cockpit of a 747, all these flashing numbers and graphs. But here's the secret. The key to understanding this entire screen is hidden in plain sight, right there at the top left. It's that little piece of text, BTC/USD. So what's the deal with that slash? What does that actually mean? Well, it's not just some random label, it's the fundamental instruction for every single thing that happens on this screen. And believe it or not, the answer is way, way simpler than it looks. Once you get this, everything else just clicks into place. All right, let's get into it. Every single currency pair is made of 2 parts. You've got what's called the base currency, and the second is the quote currency. And honestly, understanding the job of each one is the entire game. First up, the base currency. This is always the one you see on the left of that slash. The easiest way to think about it is that it's the base of the whole deal. In our example, BTC/USD, Bitcoin, or BTC, is the base. It's the asset. It's the thing we're actually interested in buying or selling. And on the other side, on the right, you have the quote currency. This is what's quoting you the price. It's what you're going to use to pay for the base currency. So for BTC/USD, the US dollar is telling you the price of 1 Bitcoin. It's the money you're using for the transaction. Okay, is that still a little bit abstract? No worries. Let's make it super, super simple. The best analogy I've ever heard for this is just picturing yourself at the grocery store. Seriously, once you think of it this way, you'll never forget it. And check this out. It maps perfectly. Seeing BTC/USD is literally the same as seeing a price tag that says apples/dollar. The base, BTC, is the item you want to buy. It's the apples. And the quote, USD, is how you pay for it. It's the dollars. The thing on the left is the item. The thing on the right is the cost. That's it. Okay, theory is great, but let's see how this actually plays out on a real trading platform. This is where it all starts to come together. Now, take a look at this list of different trading pairs. You see a pattern here? Almost every single one ends with USD. That's our big clue. It tells us that right now we're in a market where the US dollar is our quote currency. We're using our dollars to buy Bitcoin or Ethereum or any of these other cryptos. And you might be wondering, where does that quote currency even come from? Well, usually it's the fiat currency, like US dollars, euros, that you deposited into the exchange from your bank account. That becomes your default spending money. Now, here's something that trips up a lot of beginners. When you go look at your wallet on the exchange, you'll probably see your money split into a few different numbers. You'll see a total balance, an available balance, and this other one called in order. And they might not all match. So that begs the question, right? What does in order mean? Why isn't all of my money available for me to trade with right now? Let's clear that up. It's actually really simple. The second you decide you want to buy or sell and you place that order, the exchange kind of puts a hold on the funds you need for that trade. It sets that money aside, holding it in order until the trade is either filled or you decide to cancel it. And here's exactly where that money is. If you scroll down on the trading screen, you'll find a section for your open orders. That in-order balance from your wallet, it's sitting right here, tied up in a trade that's waiting to happen. It's not gone, it's just busy. Okay, so you've pretty much mastered trading with dollars now. But what if I told you that you don't even need traditional money to trade crypto? This is where things get really, really interesting. That's right. You can actually use a cryptocurrency as your, quote, currency. You can use your Bitcoin to buy other cryptocurrencies, like Ethereum. This opens up a whole new universe of trading pairs that have nothing to do with banks or fiat currency at all. And switching over is ridiculously easy on most platforms. You usually just go to that list of pairs, you click on the current, quote, currency, which is USD in this case, and a little menu will pop up. You select BTC, and boom, the whole list changes. And now you see new pairs like ETH/BTC, which means you can trade your Ether directly for Bitcoin. So why would you do this? Well, there's a pretty big benefit. On some exchanges, if you only ever deposit crypto and withdraw crypto, meaning you never touch fiat like US dollars, you can often trade without doing the full identity verification, or KYC. You're staying completely inside the crypto world. Of course, there is one common sense rule to all of this. Your base and your quote currency have to be different. I mean, it doesn't make any sense to trade BTC for BTC. You can't go to the store and buy apples with other apples, right? Same idea. So, if you remember just one single thing from all of this, please make it this right here. When you look at any currency pair, the one on the left is what you trade, the one on the right is what you use. Left is trade, right is use. That is the secret code completely cracked. And just like that, you have the fundamental key to reading any crypto trading screen on any exchange out there. That language isn't a secret code anymore. So, now that you can read it, the only question left is, what are you going to explore first?
Hey there, have you ever opened up a crypto exchange and just stared at that screen? That crazy wall of flashing numbers? Yeah, you are not alone. It can feel super overwhelming. But today, we're going to decode the heart of it all, the crypto order book.
I mean, look at it. At first glance, it's just a bunch of red and green numbers, right? Looks kind of random. But I promise you, there is a simple logic behind all this chaos. And by the end of this explainer, you're going to be able to read this screen like an absolute pro.
Okay, so let's start with the big one, that huge list of numbers you typically see on the left side of the screen. You know, this. This is the real engine room of the entire exchange. And it has a name. It's called the order book.
The best way to think about it is like a live digital marketplace. I mean, every single offer to buy or sell something like Bitcoin is listed right here in real time. It's basically a living, breathing list of supply and demand, and it changes literally every second. So this isn't just one big random list, it's actually two sides of the same conversation. It represents the two most basic things you can do in any market, buying and selling. So let's decode them. You've basically got two teams here. On one side, in green, you have the bids. These are all the buyers. Each green line is someone raising their hand saying, hey, I want to buy Bitcoin at this price. And on the other side, in red, you have the asks. These are all the sellers. They're saying, all right, I'm ready to sell my Bitcoin for this much. It's really that simple, a list of who wants to buy and who wants to sell.
And when you put those two sides together, what do you get? Well, it creates this perfect visual. It's like a constant tug of war over the price.
Think about it, right? The buyers, they're pulling on one side of the rope, trying to get the price as low as possible. They actually push the price up by being willing to pay more. And the sellers? They're on the other side, pulling just as hard, trying to get the highest price they can. They push the price down by being willing to accept less. It's this constant battle.
So how does anything ever actually happen? Well, a trade, an actual transaction, only happens when those two forces meet right in the middle. A buyer has to say, okay, I'm willing to pay that much, and a seller has to agree, all right, I'll sell for that much, and boom, the moment they agree, a trade is made.
And if you look closely, you can see exactly where that meeting point is. It's that price squished right there in the middle, between all the green and all the red. That single number is the most recent handshake, the latest agreement between a buyer and a seller.
Now, that number has a name. It's called the last price, and that's exactly what it is, the last price someone paid. It's the most up-to-the-second value of the coin, and you'll almost always see it displayed big and bold right at the top of the page.
And here's where it all connects. The system doesn't just forget that price. Nope. Every single time a trade happens, it's immediately recorded in the trade history. That's usually the other column you see on the screen. It's like a running receipt tape of every single transaction that goes through. See? It's all connected.
Okay, so now you can actually read the market. You know what's going on. So what's next? Well, participating, of course. Let's talk about how you can place your own order and actually join this big conversation.
The most common way to do this is with something called a limit order. And it's pretty self-explanatory, really. You are setting the limit, the absolute most you are willing to pay. With a limit order, you are in control. You set your price, you set how much you want, and you click buy.
All right, but hold on. This next part trips up almost everyone when they're starting out. So you've done it, you placed your order, you got the little confirmation pop-up, but then you look back at that big order book and your order is nowhere to be found. What's up with that? Did it get lost? No, don't worry. Here's the secret. The main order book you're looking at is basically a zoomed-in view. It only shows the action happening right now, super close to the current price. So if the market is at, say, $25,000 and you place an order to buy at $18,000, your order is perfectly fine. It's just sitting patiently in your open orders list, waiting for the price to come down to it.
So what happens when the market does move your way? What happens when your order is up to bat? Let's walk through the final part of this journey, from being just an order to becoming a real trade.
Okay, so your order is just chilling in that open orders list. Then the market starts moving. It gets closer, closer, and bam! The moment the market price hits the price you set and a seller is there ready to sell, your order gets fulfilled. It instantly transforms from an open order into a completed trade.
And this is the whole life cycle right here. Step 1. Your order is created, and it waits in open orders. Step 2. The market moves to meet your price. Step 3. The trade happens, and your order vanishes from the open orders list because it's not open anymore, it's done. And where does it pop up? You guessed it, right over in the trade history.
And hey, just so you know, this whole thing works exactly the same, just in reverse, if you're selling. You just place a sell offer at a price that's higher than the current market price, and then you just wait for a buyer to come up and meet you there. Same logic, different direction. Simple as that.
So, you see? That intimidating wall of numbers, it isn't really a wall at all. It's a live conversation, a massive global conversation about value, happening in real time. And now you understand the language. So the only question left is, what are you gonna say?
Welcome to The Explainer. Today, we're talking about a super powerful tool, basically a safety net for your crypto when the market decides to take a nosedive. Okay, let's paint a picture. It's a situation every single trader absolutely dreads. The market is in a free fall, your crypto is crashing, and you're nowhere near your computer. How do you get out before it's too late? And how do you do it automatically? But before we dive into the cool stuff, we gotta cover the basics, right? Just a quick look at the 2 fundamental orders you'll see on any crypto exchange. Think of them as our building blocks. So, it really boils down to one simple question. Do you want speed or do you want control? A market order, that's your get me out now button. You don't care about the exact price, you just want out. A limit order is the opposite. You're saying, I will only sell at this specific price, and I'm willing to wait for it. Okay, so what if you could have the best of both worlds? What if you could combine that instant trigger with that precise price control? Well, that's where you get something way more strategic, the stop limit order. You know, at its core, a stop limit order is just a conditional order. It's basically an if-then statement for your trading. If the price hits this specific point, then my order to sell goes live. It's that extra layer of automation that can save your skin. All right, let's really break this down into simple steps. Think of it like a tripwire. The stop price, that's the wire. The second the market price touches that wire, bam, it triggers the action. But, and this is super important, it doesn't sell right away. Nope. All it does is place your limit order on the market, making it active and ready to go. I know, that might still sound a bit theoretical. So let's make it real. Let's walk through an actual example with real numbers. This is where you'll see exactly how powerful this can be. Okay, so when you go to set this up on an exchange, this is pretty much what you'll see. You've got two main boxes to fill in. The stop price, that's your trigger, and the limit price. The limit price is the absolute lowest price you're willing to sell for once that trigger is hit. All right, story time. Let's say you've done your homework, you're feeling good, and you buy one Bitcoin for exactly $10,000. You're thinking, this is it. It's going to the moon. Yeah, but then the market does what the market does. It turns. That optimistic feeling? It's gone, and the price starts to drop. This right here is the exact reason stop limit orders were invented. But hey, you were smart. You set your stop price at $9,100. So as Bitcoin's price falls and hits that number, ding, 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 the alarm bell goes off, the tripwire has been officially triggered. And the second, literally the instant the market hits 9,100, the system automatically places your sell order. Your instruction was to sell at $9,050, so now there's an active order on the books to sell your Bitcoin for no less than that price. And boom, just like that, your order fills and you are out of the trade. Yeah, you took a small loss, sure. But what you really did was execute a classic strategy. You cut your losses. You've protected your capital from what could have been a much, much deeper crash. You know, using a tool like this brings up a really big question, a fundamental question, really. What kind of investor are you? Are you a trader or are you a long-term holder? On one side of the ring, you've got the legendary crypto mantra, HODL. This is the philosophy of just holding on for dear life, no matter how bad the crash gets, believing that eventually it'll all come back and then some. So here's the difference in a nutshell. The trader uses a stop limit because they want to cut losses and avoid something called opportunity cost. They don't want their money tied up in a losing bet when they could be using it on a winning one. The hodler, though, they're playing a different game. They ignore the noise because they believe in the long-term value and they're willing to wait. But wait, before you run off and put a stop limit on every single one of your positions, you absolutely have to understand its one big weakness. This thing is not a magic bullet, and there's a specific scenario where it can completely fail. So what are we talking about? We're talking about a flash crash. This isn't just a dip. This is when the floor falls out from under the market and the price just plummets in seconds. What happens to your clever little order then? And here it is, the big catch. Remember our example? Your trigger was at 9,100 and your limit price to sell was 9,050. Well, what if the price drops from 9,100 straight past your limit price, all the way down to, say, $4,000? In a blink of an eye, your order to sell at 9,050 never gets a chance to be filled because the price was never there. It just blew right past it. So your order just sits there unfilled and you're left holding the bag all the way down. So ultimately, it all comes back to that question of strategy. A stop limit order isn't just a tool, it's a decision. It's a commitment to active risk management. It forces you to decide, before you even enter a trade, what your pain tolerance is. It's the difference between having a plan and just hoping for the best. So the real question you have to ask yourself is, which game are you playing?
All right, let's talk about one of the biggest headaches in crypto investing, right? Those crazy, wild price swings. But what if there was a simple, totally automated way to turn all that volatility from something you fear into, well, an advantage? Stick with me because that's exactly what we're going to break down today.
I mean, it's the classic fear, isn't it? You're all set to invest, you're ready to go, but then that little voice in your head starts whispering, hey, what if you buy right now and the price just tanks tomorrow? Yeah, that one worry, it keeps so many people just frozen, stuck on the sidelines.
And listen, this is not just some what-if scenario. So many people lived through this exact thing. I mean, can you imagine the feeling? You finally decide to buy in, maybe at a peak, and then you just watch the value fall off a cliff. It's that kind of painful experience that really makes you go, okay, there has to be a smarter, less stressful way to do this.
And you know, that fear of buying at the absolute peak, well, that brings us right to the heart of the problem for most of us investors, something I call the timing trap. So here's the honest-to-goodness truth. Nobody, and I mean nobody, not even the so-called experts, can consistently predict what crypto is going to do next. You can stare at charts all day long, but you can never really know. So when you invest a big lump sum of cash, what you're really doing is making a huge, high-stakes bet that you've magically picked the one perfect moment to jump in. That's a ton of pressure.
Okay, so if trying to time the market is basically a trap, what's the alternative? Well, thankfully, there's a much, much simpler strategy, and it's called dollar cost averaging.
You know, the idea behind it is actually beautiful in its simplicity.
Instead of just throwing all your money in at once, you invest a smaller, fixed amount of money at regular intervals. Think like every week or maybe every month. The whole point of this approach is to lower your risk right from the get-go.
And this right here, this comparison, it shows a really fundamental shift in how you think about investing. On one side, you're trying to outsmart the market to pick the perfect price. But on the other side, with dollar cost averaging, you pretty much ignore the price and just focus on being consistent. See the difference? You stop being a market timer and you become a systematic accumulator instead. It's a whole different ballgame.
So how does this actually play out? Well, the real power of this strategy is in the math. And believe me, it's surprisingly simple.
Okay, and here is where the magic really happens. Because your dollar amount is always the same, it automatically, and this is the key, it automatically forces you to buy less crypto when the price is high. And more importantly, it makes you buy more crypto when the price is low. It's kind of like having your own personal, emotion-free purchasing agent working for you 24/7.
And this table just lays it out perfectly. Just look at week 2, right? The price of Bitcoin dropped down to $8,000. Your same $50 investment automatically got you more Bitcoin than it did back in week 1 or week 3 when the price was way higher. So over time, all these purchases start to average out your overall cost. Pretty neat, huh?
And that's really the whole point. You're not trying to perfectly catch the absolute bottom or the tippy top. You're just smoothing out the ride. By buying consistently, week after week, you seriously reduce the impact of that extreme volatility. You know, the very thing that makes crypto investing so nerve-wracking for most people.
Okay, so this all sounds great in theory, but how do you actually do it? Well, the good news is, setting this up is incredibly easy.
On most of the big exchanges, like Binance for example, the whole process is just a few clicks. Seriously, you just go to buy crypto, decide on your fixed amount, let's say it's $20, and then, this is the important part, instead of picking one-time purchase, you choose a recurring schedule. Then you just hit confirm, and boom, you're all set. It's that simple.
So you'll often see this feature labeled as recurring buy. Don't let the name fool you, it's the exact same thing as dollar cost averaging. The exchanges built this tool for a reason. They know that for most of us, trying to time the market just doesn't work out well.
And you've got total control over how often it happens. As you can see right here, you can set it up to buy every day, every week, or even on specific days, like say the 1st and 15th of the month. You just set it up one time and it runs automatically in the background, quietly building your portfolio for you over time.
Now look, this strategy is really powerful, but it's not a silver bullet. It's not for everyone or for every single goal. So let's talk about the trade-offs to help you figure out if it's the right fit for you. And really, it all boils down to what your personal goal is. If your main aim is to, shoot for the moon and get the absolute maximum profit possible, and you're okay with taking on massive risk, then you're basically playing the market timing game. But with DCA, the goal is totally different. It's all about minimizing risk. The trade-off? You're probably going to miss out on those absolutely explosive gains you'd get if you did somehow manage to perfectly time the bottom.
This strategy really shines for a few specific types of investors. It's absolutely ideal for long-term holders. People who believe in a project's future and just want to build up a position over months or even years. It's also perfect for anyone who just wants to build a portfolio with a lot less stress. And hey, even active traders can use it to steadily build up their holdings of a base currency like Bitcoin.
At the end of the day, that's the main takeaway. It's probably the easiest way to grow your crypto balance without taking on a ton of risk. It takes emotion out of the equation, it automates your consistency, and it helps you avoid that trap of putting all your money in at one single potentially awful price.
So I'll leave you with this question to chew on for your own strategy. In a market that's famous for its wild ups and downs, what do you think is more powerful in the long run? Trying to achieve the impossible task of perfect timing, or tapping into the simple, disciplined power of consistency?
If you're a Binance user, you've definitely seen BNB everywhere. It's kind of unavoidable. But have you ever stopped to wonder if it's more than just a coin the platform wants you to buy? Well, today we're going to dig into how you can turn BNB from this thing they're always pushing into a seriously powerful tool for your own trading strategy. Let's dive in. So, if you've spent any real time on the platform, you've probably felt this. There's this mixed feeling about BNB, right? A sense that Binance is constantly nudging you, pressuring you to buy their own coin. It's a really common skepticism, and honestly, it's totally understandable. But is there more to the story? And that's really the big question we're tackling today. Is BNB just some gimmick to help the exchange, or is it an actual, genuine tool that you, the trader, can use for your own benefit? So let's try to look past that feeling of being sold to and see what real value, if any, it actually has. Okay, first things first, the super quick basics. What even is BNB? Well, simply put, it's the native currency of the Binance exchange. Just like you'd use dollars to buy Bitcoin, you can use dollars to buy BNB. And its main jobs on the platform are for trading and, this is the important part, for paying for different services. All right, let's start with the most obvious one. The first and most immediate benefit of holding even a little bit of BNB is a straight-up discount on your trading fees. This is probably the easiest way to start making BNB work for you, right out of the gate. The number you absolutely need to remember is 25%. That's a huge saving that can really add up over time, especially if you're an active trader. And this isn't some short-term promotion, it's a core feature of the platform. So what does this actually mean in practice? Well, think about it. Every single time you make a trade, Binance takes a tiny fee. We all know that. But if you choose to pay that fee with BNB instead of whatever you're trading, bam, you instantly slice 25% off that fee every single time. And the best part? Turning this on is ridiculously easy. You just need to have a little bit of BNB sitting in your wallet, enough to cover the fees, and then you literally just flip a switch in your settings. That's it. You're now saving 25% on every single transaction. It's a no-brainer. Okay, saving money is great. We love saving money. But what if BNB could actually help you make money? And that brings us to the next level, the referral engine. This is where using BNB as a strategic tool gets really interesting. So beyond that nice fee discount, holding a certain amount of BNB unlocks the highest tier of the Binance referral program. A lot of traders just blow past this, but it's an incredibly powerful engine for creating a whole new income stream for yourself. Now, what you're seeing here is the real kicker. Look at that jump. By default, any user can get a 20% commission on the trading fees from people they refer, which is pretty good. But if you hold 500 BNB in your portfolio, that commission rate literally doubles to 40%. You're not just getting a little bump, you are fundamentally changing your earning potential on the platform. And here is the absolute crucial point. This is not a one-time bonus for getting someone to sign up. Like the source material says, it is residual. That means you earn a piece of the fees from every single trade your referrals make for as long as they're on the platform. It just keeps coming. So let's just recap why this is such a game changer. It's a continuous, ongoing income stream, not some temporary perk. Some of the top referrers on Binance have built truly significant regular paychecks just from this one feature. It completely transforms your account from just a place to trade into an actual business asset. Okay, so let's pull all this together and reframe how we should be thinking about Binance Coin. It's not just another coin to own. It's a key to unlock more value from the platform. So here's the strategy in a nutshell. First, you save money. Use a little bit of BNB to get that instant 25% discount on all your trading fees. It's the easiest win. Second, you make money. If you're serious about building income streams, holding 500 BNB to unlock that 40% referral commission is an incredibly powerful move. So the ultimate reframe is this. Stop seeing BNB as a coin Binance is forcing on you and start seeing it as a tool, a key that you can use to unlock the platform's full potential for your own benefit. And really, that brings us to the final thought. Understanding how to use BNB strategically is the perfect example of looking a little deeper into the tools we use every single day. So the question I want to leave you with is this. What other powerful tools, features, or hidden discounts on the platforms you use are you currently overlooking? So, you've got some crypto. Awesome. But is it just sitting there? What if you could make those digital assets actually work for you and start generating some passive income? Well, today we're going to dive into exactly how to do that and also a really costly mistake you're going to want to avoid. Seriously, think about it for a second. Could your crypto be earning you more? Because if your coins are just sitting idle in a wallet, you are absolutely leaving money on the table. Now, the way you make your crypto work for you is through something called staking. The easiest way to think about it is like a high-yield savings account. You're basically holding your funds to help keep the network secure and running smoothly, and as a thank you, the network pays you rewards. It's a fantastic way to grow your holdings over time. And that gets us to the really exciting part of staking, passive income. This is the dream, right? The idea that your assets can be generating returns for you 24/7, even while you're sleeping. It really is like getting free money. By holding certain cryptocurrencies, you can literally just watch them grow, generating more coins that you can then, trade or just hang on to. All right, so how do you even get started? For a ton of people, Coinbase is the first stop. It's super user-friendly, probably one of the easiest ways to dip your toes into crypto. And yep, they offer staking. And Coinbase makes it look pretty simple. If we take Tezos, for example, they promise you an annual reward of about 4.9%. Now, there's an initial waiting period, about 35 to 40 days, but then the rewards start rolling in every few days. On the surface, this seems like a great, super straightforward way to get started. But here's the thing. While Coinbase is simple, there's a catch, a big one. It's something they don't exactly put on the homepage, and it directly hits you right where it hurts, your earnings. And yeah, this problem, it directly impacts your bottom line. Get ready for this, 25%. That's a huge number. So let's break down what that actually means for your wallet. It means that for every reward you earn, Coinbase is taking a 1/4 cut right off the top. So that 4.9% return you were so excited about, well, it's actually a whole lot less for you. And this chart just lays it all out, plain and simple. For every dollar in staking rewards that your crypto generates, you only get to keep 75 cents. Coinbase just swoops in and pockets the other 25. And look, this isn't just a one-time hit. It's like a leaky faucet, constantly draining your growth. Because you're losing 25% of your rewards, you have a smaller base to earn rewards on in the next cycle. This is the power of compounding working against you. And over months and years, that can make a massive difference in your portfolio's value. But what if you could avoid that fee entirely? Let's hop over to another major exchange, Binance, and see how different the picture looks over there. Okay, the comparison here couldn't be more clear. It's kind of staggering, actually. While Coinbase takes that 25% commission, Binance takes zero, zilch, nada. That's right, a 0% fee. You keep 100% of the rewards your assets generate. For those of you in the US, the Binance.us platform has a really clean interface for staking various cryptocurrencies. And the key difference, right here, every reward generated is all yours to keep. And if you're outside the US, the global Binance.com site has an even broader selection of coins available for staking. Over time, it's pretty likely that more and more of these options will become available everywhere. Getting started on Binance is a really simple 4-step process. First, you register for an account. Next, you'll do a standard identity check. You'll see it called KYC or Know Your Customer, which is a regulatory thing for most exchanges. After that, you just fund your account, and then you're ready for the fun part. You choose a coin and start staking. So why does all of this matter so much? Because staking isn't just about the rewards you get today. It's about a really powerful 2-part strategy for your long-term growth. Think about it like this. You get a double benefit. First, you've got the staking rewards themselves. You're accumulating more coins, maybe 5 or 6% more per year. But second, and this is the real kicker, you have the potential appreciation of the asset itself. If the value of each coin goes up, your return on investment gets a massive boost. And this is the whole takeaway here. That 25% fee doesn't just reduce your immediate reward, it hobbles your potential for that explosive long-term growth. Choosing a zero-fee platform means every single bit of your investment is working for you. So, I'll leave you with this. Take a look at your own crypto holdings and ask yourself, are they truly working as hard as they could be, or is some hidden fee quietly eating away at your future growth? So, if you're like a lot of us in the crypto space, you've probably got some assets just sitting there in a wallet, right? Kind of collecting digital dust. But what if those assets could actually be working for you, earning interest around the clock? Well, today we're going to dive into a protocol called Compound and see how it can totally flip that script. So let me just ask you this straight up. Is your crypto just sitting there? For most of us, the answer is probably yes. Yeah, it's probably secure, but it's not actually growing. It's basically the crypto equivalent of stashing cash under your mattress instead of putting it in a savings account. And that's a huge missed opportunity. I mean, think about it, right? You would never, ever be okay with a bank savings account that pays you absolutely zero interest. But for some reason, that's just the default for most crypto wallets. They give you security, sure, but your assets are just static. And that's exactly the problem Compound Finance was built to solve. Okay, so how do we fix this? Well, that brings us to our first section. What exactly is compound finance? Let's talk about putting that crypto to work. All right, so what is compound really? At its heart, it's what's called a decentralized protocol. Now, you can just think of that as a set of rules written in code that lives on the Ethereum blockchain. It's not run by a company, there's no CEO. It creates this open marketplace for lending and borrowing crypto. The really key part here, it all happens without a bank or any other middleman taking a cut or slowing things down. And, this is where it gets really interesting. Instead of getting paid interest once a month like a bank, you're earning it with every single Ethereum block. We're talking about roughly every 15 seconds. There are no minimums to get started. You don't need to do any of those lengthy ID checks. And this is a big one, your funds aren't locked up. You can pull them out anytime you want. It's just a completely different way of thinking about finance. And you should know, this isn't some tiny, obscure project. Compound is a giant in the world of decentralized finance. It's got serious backing from some of the biggest names in the industry. We're talking Polytrain Capital, Bain Capital, and yeah, even Coinbase. Okay, that all sounds great, but how does it actually work? Let's get into the nitty-gritty of lending to earn that interest. So when you first land on the Compound app, you're going to see a dashboard that looks a lot like this. This is the all markets view. On the left, you've got all the different cryptocurrencies you can supply to the protocol, things like Tether, Ether, or Basic Attention Token. But the column you really want to pay attention to is the one that says Supply APY. That's the interest rate you can earn right now for lending that specific asset. And just to show you how powerful this can be, check this out. When this source was put together, the APY for Basic Attention Token was over 20%. I mean, seriously, to put that in perspective, a high-yield savings account at a normal bank might get you 1 or 2%. It's just a totally different ballgame. Now, of course, a rate that high isn't going to be locked in forever. APY, that stands for annual percentage yield, and on Compound, these rates are totally dynamic. They're always changing. It's simple supply and demand. If a ton of people want to borrow a certain token, the interest rate for lenders goes up to attract more supply. If demand drops, the rate goes down. It's all happening in real time, every single block. All right, so you see the potential. Now you're probably wondering, how do I actually do this? Well, let's get into a quick start guide. It's actually a super simple 3-step process. Yeah, it really just boils down to these 3 things. First, you connect your wallet. Second, you enable the asset you want to supply. And third, you supply the tokens to the protocol. Let's walk through each one. Okay, step 1 is easy. Connect your wallet. The app's going to prompt you to do this right away, and it supports all the big ones you'd expect: MetaMask, hardware wallets like Ledger, and of course, the Coinbase wallet. Next up, step 2, you have to enable your asset. Now, what does that mean? Well, before you can lend a token for the very first time, you just have to give the Compound protocol permission to interact with it. It's a security step. This is a one-time thing you do for each asset, and since it's a transaction on the Ethereum blockchain, it does require a small transaction fee. That's called gas, which you'll need a little bit of ETH in your wallet to cover. All right, once that enable transaction goes through, you're on to the final step, supplying your tokens. You just type in the amount you want to lend, confirm one last transaction, and that's it. You're done. Your dashboard will immediately update to show your supply balance, and from that very moment, you are earning interest. You can even see your net APY calculated right there on the screen. It's pretty cool to see. Okay, so earning that interest is awesome, right? But believe it or not, that's only part of the story. There's actually a bonus layer of earnings built right into the Compound protocol. That's right. That APY you see on the dashboard, it isn't the only reward you're getting. You're actually earning something else at the exact same time. And that something extra is the Comp token. So, what is Comp? It's the protocol's governance token. The easiest way to think about it is like holding shares in a company. It gives you voting rights. You get a say in huge decisions, like which new asset should be added or how the protocol itself should be updated. It literally puts control of the platform into the hands of its users. And here's the best part. You earn Comp just for using the protocol. It doesn't matter if you're lending or borrowing, you get it automatically. It's distributed to users every single day. You can then collect it and do whatever you want with it. Sell it on an exchange, or hold on to it and use it to vote. It's a really powerful incentive that basically turns users into owners. All right, let's zoom out for a second and look at the bigger picture here, because Compound is way more than just a place to earn some interest. It's actually a foundational building block for the entire decentralized finance, or DeFi, ecosystem. So far, we've focused mostly on the earning side of things, but Compound is also a huge marketplace for borrowing. See the assets you supply? They also act as collateral. This allows you to borrow other crypto assets against them. It's a really cool way to unlock some cash without having to sell your crypto. But, and this is super important, you have to be aware of the risk of liquidation. If the value of your collateral drops too much compared to what you've borrowed, the protocol will automatically sell it off to cover your loan. So it's a powerful tool, for sure, but you've got to be careful. And this is where you really see the true impact of the protocol. Compound isn't just one app. It's like a foundational money Lego that the entire DeFi ecosystem is built on. Just look at this ecosystem map. You've got dozens and dozens of other services that plug directly into Compound's core technology. We're talking crypto wallets like Argent that use it to offer interest-bearing accounts, portfolio trackers like Zapper, even services for big institutions. It's become a core piece of infrastructure for this whole new financial world.
And all of this really brings us to one final huge question. When anyone on the planet with an internet connection can earn interest and get a loan without needing a bank, what does that actually mean for the future of finance? You know, protocols like Compound might not just be a cool new way to earn on your crypto, they might just be a blueprint for a totally new, more open, and more accessible financial system for everybody. Thanks so much for tuning in.
Turning your crypto into actual cash can sometimes feel like the final tricky boss level. Well, in this explainer, we're going to break down exactly how to do it on one of the biggest platforms out there, Coinbase. And I'll even show you a simple trick to keep more of your own money. So you've held your crypto, you've watched the markets do their thing, and now you're thinking about cashing in. That's a huge step. But the big question is, what's the smartest, most efficient way to do it without losing a big chunk of your profits to fees? All right, so here's our game plan. We're going to look at the two main ways you can sell on Coinbase, the simple path and what I like to call the savvy path. Then we'll cover that all-important final step, the withdrawal, and help you figure out which path is the right one for you. When it comes to selling your crypto on Coinbase, you've really got two main choices. Think of it like a fork in the road, right? One path is super simple, super fast, but it's going to cost you a little bit more. The other path, well, it takes a couple of extra clicks, but it can save you a surprising amount of money. Okay, let's start with path number one, the simple sell. This is the default method you'll find right inside the main Coinbase app or on their website.
And you know, they've really designed this process to be dead simple. You're in your portfolio, you hit trade, then sell, pick which crypto you're selling, and tell it where to send the cash. Seriously, it's like 4 clicks and you're pretty much done.
And you can see it right here. They've designed this screen for pure simplicity. There are no complicated charts, no confusing jargon. It just asks you 2 basic questions. What are you selling, and where should the money go? It's all about making it as frictionless as possible.
So what's happening behind the scenes when you do this? Well, you're creating what's called a market order. That just means you're telling Coinbase, sell my crypto immediately at whatever the best available price is right now. The upside is speed and convenience, but that convenience, it comes at a price.
And yup, here's the catch. For all that easy-to-use goodness, the fees can be, as the source material puts it, a little bit steep. You're basically paying a premium for that simplicity, and over time, that can really start to eat into your profits.
So if you're like me and you want to keep more of your hard-earned gains, there is a better way. And this brings us to path number 2, the savvy sell, which uses Coinbase's more advanced platform, Coinbase Pro. So what's the big difference? Well, standard Coinbase is built for beginners and pure convenience. Coinbase Pro, on the other hand, is built for traders who are a bit more cost-conscious. The fees are way lower, and you get a lot more control over your trades.
Now listen up, because here is the secret weapon that makes this whole strategy work. Moving your crypto from your standard Coinbase account over to your Coinbase Pro account is completely free, and it's instant. There's literally no penalty for switching to the cheaper platform.
And the process itself is just as simple. Once you're inside Coinbase Pro, you just click Deposit, pick your crypto, and, now here's the key part, you choose Coinbase.com as the source. You type in the amount, and you are good to go.
Here's exactly what it looks like. On your main portfolio screen in Coinbase Pro, you can see that deposit button right there on the left. Once you click that, it gives you a couple of options, but the one we want is the one that says pull funds directly from Coinbase.com.
And the system is really smart. It automatically finds your available balance on your regular Coinbase account. You can see right there on the screen, the network fee is 0, and the processing time is instant.
You hit deposit, and boom, it's done. Your funds are now sitting in Coinbase Pro, ready to be sold for a much, much lower fee.
And here is the payoff. For trades under $10,000, the fee is just 0.5%. That is a huge saving compared to the fees on the standard platform, which can be much higher. You are immediately keeping more of your money, which is what this is all about.
All right, you've done it. You've successfully sold your crypto using either the simple path or the savvy path. Your crypto is now cash and it's sitting in your account. So, how do you get it out and into your bank? Okay, so both platforms let you withdraw directly to a linked bank account, no problem. But here's a really crucial detail. If you want to withdraw using PayPal, which is often a lot faster, that option is only available on the standard Coinbase platform. You can't do it from Coinbase Pro.
So that presents a little bit of a puzzle, doesn't it? You want the low fees you get from selling on Coinbase Pro, but you also want the convenient PayPal withdrawal option you only get on standard Coinbase. So how do you get the best of both worlds? Well, you guessed it, there's a trick for that too.
It's beautifully simple. After you sell your crypto on Coinbase Pro and save all that money on fees, you just do another free instant transfer. But this time, you're moving the cash back from Coinbase Pro to your standard Coinbase account. And from there, that PayPal withdrawal option magically becomes available to you.
And that's really the ultimate hack here. You trade where it's cheap on Pro, and you withdraw where it's most convenient on standard Coinbase. It's just one extra free transfer that lets you maximize both your profits and your options. It's a no-brainer.
So there you have it. We've laid out both methods, the quick and easy route and the slightly longer but much more profitable one. Now you have all the information you need to make the right choice for your own situation.
I mean, it really just boils down to this simple trade-off. The simple path is all about speed and convenience, but you definitely pay for it in fees. The savvy path, on the other hand, requires a couple of extra clicks, but it makes sure that more of the money from your sale actually ends up in your pocket.
Ultimately, there's no single right answer that fits everyone. But by understanding both of these paths, you are now in complete control. You can weigh the convenience against the cost and decide for yourself exactly how you want to cash out your crypto.
So, now that you're armed with this knowledge, the question is back to you. The next time you're ready to sell, are you going to take the simple path for pure speed, or are you going to take the savvy path to maximize your returns? The choice is all yours.
Okay, get this. What if you could manage your entire crypto portfolio without ever leaving your browser's start page? Seriously. Today we're going to break down this really powerful new integration that does just that. I'm talking about the Binance widget for the Brave browser. Let's dive in and see how this thing works. I mean, that sounds like a crypto trader's dream, right? Think about it. No more shuffling between a million tabs, no more logging into different sites over and over again. Instead, you get this one single unified dashboard where you can see, deposit, and trade all your assets. That's the big promise here, and we're about to walk through exactly how they pull it off. So, you might be wondering, how did this super seamless experience even happen? Well, this isn't just some small, dinky plugin. Nope. This is the result of a massive collaboration between two absolute giants in their fields. So on one side, you've got Brave. You probably know them, the privacy-first browser that's already got over 13.5 million people using it every single month. And on the other side, just Binance, the world's biggest crypto exchange by a long shot. So when these two decide to team up, yeah, that's a pretty big deal. It's a huge step towards making crypto way more accessible for everyone. And the goal they shared was simple, really. Just completely streamline the whole crypto experience. The idea is to let millions of people manage their portfolios as easily as they check their email, all there, without ever having to leave the browser. Super simple, super powerful. All right, so you're probably thinking, how do I get my hands on this? Well, your very first step is super easy. Just make sure your Brave browser is all up to date. It's a really simple 3-step process. You just click that little hamburger menu in the top right corner, then you navigate down to About Brave. And that's pretty much it. The browser will automatically check for and install the latest update for you. Just make sure you're on version 1.8 or newer, and you'll be good to go. And here's exactly what that looks like. You can see on the left, an older version is checking for the update, and then boom, on the right, you get that nice confirmation screen telling you you're on the latest version. As soon as you see that, you're all set to connect. Okay, browser updated? Check. Now it's time for the fun part, connecting the widget to your Binance account. So go ahead and open a new tab, and you should see the Binance widget right there. And hey, you can even toggle between Binance.com and Binance US, depending on where you are. To get started, you're just going to click that big Connect button. And what that does is it brings up the Binance authorization screen. This should look familiar. You just pop in your usual login details, and that'll securely link your account right to the Brave browser. Now, this part is really important, the transparency. Before you even log in, Binance tells you exactly what permissions the widget needs. It's going to need to see your email, your wallet address, and your balance. Just for display, of course, and it needs permission to do crypto-to-crypto conversions for you. The key thing here is there are no surprises. You are always in control. All right, you're in, you're connected, so let's take a little tour of your new command center and see what this thing can really do. So the second you're connected, you land right on the Summary tab. Think of this as your mission control, your high-level overview of your entire crypto portfolio, all in one spot. And check this out. It's a really smart privacy feature. By default, all your balances are hidden. This is absolutely perfect if you're, say, at a coffee shop or using your computer in public. When you're ready to see your numbers, just click the little eye icon, and it'll reveal all your holdings. Okay, next up, we've got the Deposit tab. So let's say you need to send some crypto to your Binance account from another wallet. Well, now you can grab that address right here inside the widget. It's so easy. You just search for whatever crypto you want to receive, and boom, the widget instantly gives you your unique deposit address and even a scannable QR code. It totally eliminates that annoying step of having to log into the main website just to hunt down that info. All right, now we get to what might be the most powerful feature of this whole widget, instant conversions. This is where you can swap one crypto for another, like with zero hassle. The interface they've built here just makes converting assets insanely simple. You just use the little drop-down menus, pick the crypto you're trading from, pick the one you want to trade to, and then just type in the amount. That's it. And before anything is final, don't worry, you get a super clear confirmation screen. It breaks down the fee for you, shows you the exact amount you're going to receive, and gives you a 30-second window to lock in that quote. It's all designed to be fast, totally transparent, and of course, secure. Okay, the last of the core functions is, of course, buying new crypto with your regular money. And yep, the widget makes starting this process super smooth too. So over in the Buy tab, you can select your currency, let's say US dollars, type in how much you want to spend, and then pick the crypto you want to buy. Now, when you click Buy, it's going to hand you off to the main Binance.com site just to securely finish up the final payment steps. Pretty slick. And last but not least, let's talk about managing your connection. Because, staying in control of your data and who has access to what is always, always the top priority. So if you ever want to unlink the widget, it's super easy. Just click that little three-dot menu and hit Disconnect. And don't worry, this only removes the widget settings from your browser. It doesn't touch or change your actual Binance account at all. And you can always reconnect later if you change your mind. An integration like this really makes you think, doesn't it? We're moving past just visiting websites. Now we're plugging powerful financial tools directly into the fabric of our browsers. So the big question I'll leave you with is this. Are we seeing the start of a truly integrated, maybe even decentralized web? And if so, what comes next?
All right, let's cut through all the noise. Forget the complicated charts, forget all the crazy jargon for a second. We're going to focus on one thing and one thing only, the button that lets you trade crypto, like right now.
Okay, so picture this. You've got your account funded, you're logged in, and you're staring at a screen that looks like you're about to launch a rocket to Mars, right? There are charts, numbers, blinking lights all over the place, and all you're thinking is, I just want to buy or I just want to sell. So, where's the easy button?
Well, that easy button, it's actually staring you right in the face. It has a name, and it's called a market order. This is your secret weapon. It's your go-to for pure speed and simplicity, for when you just need to get in or out of the market without wasting a single second.
So, let's break down what a market order actually is. And more importantly, why it's probably the very first tool every trader needs to get really comfortable with.
Think of it this way. A market order is basically you yelling at the exchange, hey, I want to buy this crypto, or sell it, and I want to do it right now at whatever the best price is at this very second. There's no waiting around, no fussing with specific price points. It's all about pure instant action.
This really sums up the first big decision you have to make as a trader. It's a classic trade-off, speed versus price control. Over on the left, you've got the market order. That's all about speed, getting it done instantly. On the right, you have something called a limit order, which gives you more control over the price. But you might have to wait for it. The bottom line is really simple. If you absolutely need to trade this second, the market order is your best friend, period.
All right, theory is one thing, but let's get our hands dirty. How do you actually place one of these things? Let's walk through it.
And you know what the best part is? This is pretty much universal. No matter what platform you're on, it almost always comes down to these 3 simple steps. Step 1, you select market from the order types. Step 2, you type in how much you want to buy or sell. And step 3, you smash that big buy or sell button. That's it. Let's actually look at a few real-world examples to see it in action.
Okay, first up, we've got Coinbase Pro. See that order form section over on the left? You've got your buy and sell tabs, and right underneath, you see the different order types. All you do is click Market, punch in your amount, and boom, you are ready to go.
All right, now let's hop over to the blockchain exchange. Okay, so the layout is a little different here. The order form is on the right side now, but look at the process. Is it any different? Nope, it's exactly the same. You just select Market, enter your amount, and you place the order. Simple as that.
And just to really nail this down, here's one more. Binance. Again, same deal. You find the trading section, you see your options, limit, market, all that stuff. You just click market, type in how much, and hit the buy or sell button. See? It's like a universal language for every trader out there. So the big takeaway here is that once you've got this simple 3-step process down, you're pretty much set. You can jump onto almost any crypto exchange and know exactly how to place a basic trade. That's a powerful skill to have.
Okay, so you've nailed the how-to part. Awesome. But now, let's talk about an important little detail. You know that incredible speed and convenience we just talked about? Well, it does come with a tiny little trade-off, and it has to do with something called taker fees. So most exchanges use this thing called a maker-taker model to figure out their fees. Now that might sound super technical, but the idea is actually pretty simple. It all boils down to one question. Are you adding an order to the market for someone else to fill, or are you taking an order that's already there? See, exchanges love it when people add orders. That's called providing liquidity. So they actually set up their fees to reward you for doing that.
And that's where your market order comes in. A market order is, by definition, a taker order. And why is that? Well, because you are instantly taking someone else's order right off the books at the current price. You're removing that opportunity or liquidity from the market. The other kind of order, one that just sits there waiting for someone to come along, like a limit order, well, that's a maker order because it's helping to make the market.
So here's the bottom line. Since you're taking that liquidity and getting that super convenient instant trade, you're considered a taker. And for that privilege, you usually pay a slightly higher fee. It's really just the price you pay for speed and convenience. Let's make this real with an example. Take a look at this sample fee schedule. Now, notice that if you're trading smaller amounts, say up to 10 grand, the taker and maker fees are often the same. No big deal. But look what happens as the numbers get bigger. If you're trading between $50,000 and $100,000, the taker fee is 0.25%, but the maker fee is only 0.15%. That little difference, that's the cost of convenience we're talking about.
Okay, let's wrap this all up. What are the absolute must-know key takeaways from all of this?
Here's your cheat sheet. First, a market order is the fastest, easiest way to trade. Hands down. Second, the process is always the same. Simple 3 steps. Select market, enter amount, and click buy or sell. Third, this skill is universal. You can use it on Coinbase, blockchain, Binance, you name it. And finally, number 4, just remember that market orders are taker orders, and that convenience might mean you pay a slightly higher fee. That's it.
So you know the how and you know the why. You get the tool, the process, and the trade-offs. The next time you're looking at the charts and you feel that need to act fast, you'll know exactly what to do. You're officially in the driver's seat. So the question isn't can you do it, it's when will you?
So you're thinking about diving into the world of crypto, and you've probably heard the name eToro thrown around. Well, today, we're going to demystify it for you. We'll break down exactly how to use the platform, from making your very first purchase all the way to managing your assets. Let's jump in. First thing you need to know is that eToro isn't just a single app. It's actually a whole ecosystem. As you can see here, it's made up of 3 different products that all work together to give you a complete crypto experience. Here's our game plan for today. First, we'll get the lay of the land, the eToro landscape. Then we'll walk through your first steps, like getting your account set up. After that, the fun part, making a trade. We'll cover how to manage your crypto, and then we'll cap it all off with a look at a really unique feature they have called Copy Trader.
All right, Section 1. Let's talk about the eToro landscape. What are these 3 core products that make up the entire platform? Let's break them down.
Okay, so on one hand, you have the main trading platform. This is what we're going to focus on today. It's designed for beginners. It's got a super simple interface. On the other hand, there's eToro X. Now that's a full-blown exchange meant for more experienced traders with all the advanced tools you'd expect.
And the third piece of this puzzle is the eToro wallet. The easiest way to think about this is like your own personal crypto vault. It's a totally separate mobile app that lets you hold over 120 different coins, and this is the important part. It lets you actually move your crypto off the eToro platform and into your own custody.
Which brings us right to Section 2, your first steps. Okay, let's get practical. We're going to walk through how to set up your account and get some funds in there so you're actually ready to make a trade.
Now, this is maybe one of the best features for any beginner. eToro gives you a virtual account, and it comes preloaded with $100,000 in play money. It is an absolutely fantastic way to practice, get a feel for the platform, and see how it all works without risking a single real dollar.
Once you're comfortable and you're ready to use real money, you'll see a screen like this. You've got a bunch of options to deposit cash, credit cards, PayPal, bank transfers. But listen up, because the choice you make here is way more important than you might think.
So here's a major pro tip for you. If you think you will ever want to move your crypto into your own personal wallet, you should seriously consider using a bank transfer. Why? Because the other methods come with a pretty big catch. And here's that catch. If you fund your account with a credit card or PayPal, you could be waiting up to 180 days before eToro will let you transfer your crypto off the platform. Yeah, that's almost half a year. It's a security measure on their end, but it's something you absolutely need to know before you deposit any money.
All right, now for the main event, Section 3. Let's do it. Let's walk through the exact step-by-step process of buying your very first crypto on eToro.
Honestly, when you boil it down, it's a super simple 4-step process. You find the crypto you want, you hit the trade button, you type in how much you want to buy, and you click open trade. That's it. Let's look at each of these a little closer.
So, step 1, finding your crypto. If you're not sure what you want, you can just head over to the Discover section. It's a great place to browse, see what's trending, and just explore all the different assets like Bitcoin and Ethereum.
But if you already know exactly what you're after, you can just skip all that browsing. Use the search bar, type in the name or the ticker symbol, like BTC for Bitcoin, find it, and then just click that trade button right from there. Okay, pause. Before we go to the final step, you have to understand this one critical difference. You're going to see 2 options: trade and order. A trade means buy it right now, at this very second, at whatever the market price is. An order, on the other hand, lets you say, hey, I only want to buy this if the price drops to a specific level I choose. So for most beginners, you'll probably just use trade. Your screen will look just like this. You just punch in the dollar amount you want to spend, hit that open trade button, and boom, the crypto is yours, purchased instantly at the current price.
But if you decide to get a little fancier and select Order, the screen changes just a bit. You'll see this box called Rate. This is where you put in your target price. The trade won't happen unless the market actually hits that price you've set.
Okay, congratulations. You clicked the button, the trade is done, you own some crypto. So, now what? Let's dive into Section 4 and talk about how you manage these new assets in your portfolio.
Now listen up, because this is probably the #1 thing that confuses new users on eToro. To take profits, meaning to sell your crypto and get cash back, you need to click Close Trade. The Sell button does something completely different. That actually opens a brand new trade where you're betting the price will go down, which is a much more advanced strategy. So remember, Close Trade means take profit.
So after you buy, you've really got 3 main options. 1, you can just let it sit in your portfolio and track how it's doing. 2, you can close the trade to lock in your profits. Just remember there's a $5 fee when you withdraw cash. Or 3, you can start the process to transfer your coins over to your personal eToro wallet.
Now, if you do choose to transfer your crypto out, just be aware that there are fees involved. eToro has its own transfer fee, which is different for every crypto, and that's on top of the regular blockchain network fee you'd pay anywhere.
And that brings us to our final section, where we look at a feature that really makes eToro stand out from the crowd. We're talking about social trading with something called Copy Trader.
So, what on earth is Copy Trader? It's basically a system that lets you find other successful traders on the platform and, well, copy them automatically.
You decide how much money to allocate, and from then on, whenever they make a trade, your account makes the exact same trade in proportion. It's a pretty powerful idea, especially for beginners.
And this all leads to a bigger, more interesting question. By letting literally anyone tap into the strategies of experienced investors, could social investing tools like CopyTrader be the key that finally makes the complex world of crypto truly accessible to everyone? It's definitely something to think about.
Hello, everyone, and welcome. What a time to be in the crypto markets, right? The bull run is on, and the big question on everyone's mind is, after Bitcoin, what's next? Today, we are going to break down a really interesting list of 5 altcoin picks from 2021, not just to look at the coins themselves, but to really understand the strategy behind them.
Okay, so let's just jump right in. Bitcoin is hitting new all-time highs, which is incredible, and it usually gets the whole market excited. Historically, this is the exact moment when people start shifting their focus over to altcoins. But, with literally thousands of projects out there, the question is, where in the world do you even start looking for that next big wave?
And this is the most crucial point to understand. The game has changed. This isn't like past crypto cycles where pretty much everything went up just because Bitcoin did. The market is way more mature now. It's more sophisticated. And that means you have to be strategic. You have to be selective. Not every project is going to make it this time around.
So here's our game plan for today. First, we're going to talk about the challenge of picking altcoins in this new environment. Then we'll dive into the 5 picks and we'll group them together so it makes sense. Privacy coins, platform coins, media, and finance. We'll even look at a high-risk moonshot pick. And we'll wrap it all up with what I think is the most important lesson here: diversification.
Okay, before we even whisper the name of a single coin, we have to talk strategy. This isn't about just throwing money at hyped-up projects and hoping for the best. It's about building a portfolio with a real thesis behind it. And speaking of which, just a quick heads up, this is all for educational purposes. It is not financial advice. You've got to do your own homework before making any investment decisions. All right, let's go.
The whole strategy really boils down to this 3-part approach to diversification. It's basically the opposite of putting all your eggs in one basket. First, you diversify by use case, so you're not just betting on one type of tech. Second, by sector, spreading your bets across different areas of the crypto world. And third, this is super important, by market cap. You want to balance those big, stable projects with the smaller, riskier ones that have that explosive growth potential.
All right, let's see how this all works in practice with our first 2 picks. We're starting at the bottom layer, the absolute foundation of the crypto world, the core infrastructure. Think of these as investments in the essential plumbing of the system. One is all about pure, unadulterated financial privacy, and the other is a bet on a next-generation smart contract platform. First up, we've got a true OG in the space, Monero, ticker XMR. This isn't some new, flashy coin. It's been around for over 6 years, and it's obsessed with doing one thing perfectly, being true, anonymous digital cash. And what's so telling is that regulators and governments are trying so hard to crack it. And you know what? That's seen as a massive vote of confidence. It's like the best marketing they could ask for, because it proves the privacy tech actually works.
Man, this quote just perfectly captures what's next for Monero. They're working on something called atomic swaps with Bitcoin. In plain English, that means you'll be able to swap your Bitcoin for Monero directly without ever touching a centralized exchange. It's literally creating a bridge from the transparent world of Bitcoin to the private, anonymous world of Monero. That is a seriously powerful idea.
So let's just quickly recap the bull case for Monero. It's got the best-in-class privacy tech that is constantly being upgraded. It's developed by hardcore cypherpunks, people who live and breathe this stuff, not some corporation. It's 100% funded by its own community, has more trading volume than any other privacy coin, and it's truly decentralized. It's the real deal.
Okay, let's move on to our second pick, Algorand, Algo. This is our platform play. With so much hype around Ethereum, the smart move is to diversify into other promising smart contract blockchains. And Algorand is super interesting because it was built from scratch to solve a very specific, very famous problem in the crypto space. And that problem is the legendary blockchain trilemma. You've probably heard of it. It's this idea that it's almost impossible for a blockchain to be super fast, super secure, and super decentralized all at the same time. You usually have to sacrifice one. Well, Algorand's solution is its pure proof-of-stake system, which is designed to tackle all 3 at once.
Now, this is where it gets really clever. Look at Algorand's approach to smart contracts. Its programming language is non-Turing complete. Okay, what does that even mean? Think of it like this. Ethereum's language is like a super flexible multi-tool that can do anything, but it's also easier to mess things up. Algorand's language is more like a specialized, high-precision tool. It's less flexible, but it is way safer and less likely to have costly bugs. And if you're a big bank or a major corporation, safety is everything.
Okay, so we've got our foundational layer covered. Now we're going to move up the stack and look at the applications being built on top of the blockchain. These next two picks are taking aim at two absolutely massive industries, media and finance. Our third pick is Theta, and let me tell you, this project has some serious ambition. They want to completely decentralize the entire online video streaming industry. We're talking about building a community-powered alternative to the giants, YouTube, Twitch, you name it. It's a huge idea.
And if you want to know if the community believes in this vision, just look at this number, 55%. Over half of all the Theta tokens in existence are staked. They're locked up by people supporting the network. That is a huge deal. It takes a massive chunk of the supply off the market. And, simple economics says when supply goes down and demand goes up, well, that can create some pretty powerful price action.
And the fundamentals here are just rock solid. They have patented, working technology. The advisory board includes the co-founders of YouTube and Twitch. I mean, come on, these guys know the streaming industry better than anyone. It's backed by huge names like Samsung, and at the time, there was a lot of buzz about a potential Coinbase listing. It just checks all the boxes.
Now for our fourth pick, we're diving into the world of decentralized finance with a medium-cap project called Injective Protocol, or INJ. It's a decentralized exchange, a DEX, that's focused on derivatives. So think of complex financial products, but built for anyone, anywhere, with no middlemen. Its big promise is to be lightning fast with super low fees. So what's its secret sauce? First, it's a layer 2, which means it bypasses all the traffic jams and high gas fees on Ethereum. Huge advantage. Second, it has some of the biggest names in crypto backing it, like Pantera and even Binance. And finally, and I love this part, it has great tokenomics. A portion of the fees on the exchange are burned, just gone forever. That means the total supply of the token goes down over time, which can make the remaining tokens more valuable. All right, we've covered the more established picks. So for our fifth and final selection, it's time for the wild card. This is our moonshot, the high-risk, high-reward bet in the portfolio, and it's on the absolute cutting edge of what's happening in DeFi. And that pick is Barnbridge, ticker BOND. Now this one is a bit of a mind-bender, but it is so cool. The core idea is to tokenize risk. It takes the messy, variable returns you get from different DeFi products and slices them up into different risk levels. This means conservative investors can buy a token that gives them a safer, fixed return, while risk takers can buy another token that gets them a potentially much higher but riskier return. It's financial engineering on the blockchain.
And if you're wondering if people are interested in this idea, look at this number, $200 million. That's how much value was locked into the protocol just 2 days after they launched their yield farming. That's not just interest, that is an absolute frenzy. It shows you there's massive demand for this kind of product.
So there we have it, 5 very different projects. But really, the biggest takeaway here isn't about any single coin. The real power in this list is how all these different pieces fit together to create a balanced, diversified portfolio.
And this table just lays it all out perfectly. You can see the strategy at a glance. We've diversified across different sectors, privacy, platforms, media, finance, and cutting-edge DeFi. And we've diversified across market caps, from the big, established players all the way down to our low-cap moonshot. The whole structure is designed to give you exposure to all these different trends in crypto while trying to manage your overall risk.
At the end of the day, a portfolio like this is really just a series of bets on different possible futures for crypto. And that leaves us with the one big question. As this technology evolves at lightning speed, which of these bets will be the one that defines the next chapter? The only way to find out is to stay curious and keep learning. And as always, remember to do your own research. Thanks for tuning in. Okay, let's just state the obvious. 2020 was the year DeFi absolutely exploded. Decentralized finance, this whole new financial system built on crypto. But with all that insane growth, it raises a huge question, right? How in the world do you figure out what any of this stuff is actually worth? Well, that's exactly what we're going to dive into. And when I say exploded, I am not kidding. Check this out, 20x.
The total value locked in DeFi, which is basically all the money flowing through these protocols, grew 20 times over in a single year. That is just an unbelievable amount of money flooding into a brand new space.
So with all that cash flying around, the big question becomes, how do we separate what's real, what has true value, from what's just, hype? That's the puzzle we're going to try and solve right now.
All right, so to even begin, we've got to talk about why the old ways of measuring value just completely fall apart in the wild world of DeFi. We're going to look at the two big metrics everyone throws around and see why, honestly, they can be super misleading.
First on the chopping block, market cap. I mean, you see it everywhere, right? It seems so straightforward. But trust me, in DeFi, just looking at market cap is a massive, massive mistake.
So let's take a perfect example, Uniswap. For a long, long time, this was an incredibly valuable, widely used protocol with a market cap of exactly 0. Then, boom, overnight, they airdropped the Uni token. Instantly, it has a market cap of over $700 million. So, did the protocol just magically become valuable in that one moment? No way. The value was there the whole time. It just goes to show you that market cap really doesn't tell the full story about a protocol's actual intrinsic value.
Okay, so if market cap is out, what's next? Well, everyone loves to talk about total value locked, or TVL. And yeah, you can kind of think of it like a protocol's balance sheet. It's all the crypto assets sitting in its smart contracts. And look, a high TVL is better than a low one, for sure. But here's the thing. Relying only on this number can be just as dangerous.
And to really understand why, we have to talk about one of the most famous stories in DeFi, the vampire attack. It's a classic tale. In one corner, you've got Uniswap, the OG, the innovator. And in the other corner, you have SushiSwap, which was, well, it was a literal copy and paste of Uniswap's code, a fork. But it had one tiny, crucial difference. It offered slightly better rewards. And with just that one small change, by offering those slightly juicier rewards, SushiSwap did something nobody thought was possible. It siphoned away over $830 million. That's how much it pulled from Uniswap's liquidity.
And that right there is the whole point. That massive total value locked? Turns out it wasn't locked at all. We're talking about more than half of Uniswap's entire asset base just gone in a single day. All of it fled to a copycat competitor. It's the perfect illustration of how incredibly slippery and temporary TVL can be.
And this really gets to the heart of the biggest challenge in DeFi. See, it's not just about building something that creates value. The real trick is figuring out how to hold on to that value. It's what we could call the great value escape.
So why is it so hard to capture value here? Well, for a few huge reasons. First, everything is open source. Anyone can just copy your code, just like we saw with SushiSwap. Second, capital is completely fluid. Money can whip from one protocol to another in the blink of an eye, chasing the highest yield. The competition is just ruthless. But there is one thing that's even more fragile, one thing that trumps all of it.
And that's security. At the end of the day, we are talking about people's actual money. Trust is the absolute bedrock of all of this. And a single mistake, one hack, and all of that trust can just vanish. Poof, gone.
I mean, just look at this number, -60%. That is a devastating drop, and it's what happened to one protocol's token price.
In just one day. This was Harvest Finance back in October 2020. They got hit with a $24 million hack. And the result? The token price just cratered, down 60%. Confidence was completely shattered. It proves that your TVL means absolutely nothing if people don't trust that their money is safe with you.
Okay, so if market cap is a trap, and TVL can disappear overnight and value is so hard to keep, then what are we supposed to be looking for? Well, the answer actually comes from the world of traditional investing. It's a concept called an economic moat.
Yeah, this idea was made famous by the one and only Warren Buffett. And the idea is simple, right? An economic moat is some kind of durable competitive advantage that protects a company from its rivals, just like a real moat protects a castle from invaders. And in DeFi, building one of these moats, that is the absolute key to capturing value for the long haul.
So what does a moat even look like in DeFi? I mean, you don't have patents or physical locations. Instead, you have things like this: deep integrations with other important protocols, a super passionate community that's basically a free marketing army, a killer user experience that's so simple and easy people just don't want to leave, a rock-solid reputation for security, which we know is crucial.
having the resources, a war chest, to keep innovating, and maybe most importantly, a brilliant team that's always one step ahead of the copycats. Let's make this more concrete. Think about user experience. If something is a pain to use, you'll just go somewhere else. Simplicity wins. Apple's the classic example of this. Or think about the team. A genius team, like Andre Cronje was for Yearn Finance, can innovate so fast that no one can keep up. And of course, security. You're just not going to put your money into a smart contract you don't trust, period. Public audits and a clean track record build that trust. These are the real advantages that are hard to copy.
Okay, so now that we have this framework of thinking in moats, let's look ahead a bit. What's next? How are protocols going to evolve to build even stronger, better moats to really lock in that value? Well, one of the biggest problems in DeFi right now is this imbalance. The whole system tends to reward yield farmers. You know, the short-term capital that just hops from one protocol to the next, chasing the highest interest rate. They get all the rewards. But what about the long-term liquidity providers, the people providing stable, valuable capital? They often get nothing extra for their loyalty.
So, the big next step, the future solution, is for protocols to finally crack this puzzle, to create what you might call true value locked. And how do they do that? By creating incentives that specifically reward the people who are willing to commit their capital for the long term. And this isn't some crazy new idea, by the way. This happens in traditional finance all the time. The fancy word for it is rehypothecation. But really, it's the same reason a bank gives you a much better interest rate on a 5-year CD than in your regular savings account. They're rewarding you for that long-term commitment because your money is stable capital they can actually rely on and work with.
And that really is the big question, isn't it? In this wild world of constant forks and insane competition, who is going to be the first to build a moat that actually lasts? Because the ultimate winners here, they won't be the projects with the flashiest, most temporary TVL. No, the winners will be the ones who crack the code on rewarding loyalty, the ones who build a true fortress of value that no vampire attack could ever drain.
All right, let's get right into it. Today, we are tackling the single most important and honestly, the most overlooked part of crypto investing, your exit strategy. Look, anyone can hit the buy button, but knowing when to sell, well, that's the part that actually makes you money. And this is it, the big one. It seems like such a simple question, doesn't it? But getting this right is literally the difference between celebrating life-changing gains and watching them all just vanish. And it's crazy, but most people just forget. They get so caught up in the excitement in the bull market rush that they never stop to think about the destination. It's like building a rocket ship to go to the moon, but completely forgetting to design the landing gear. The ride up is amazing, but trust me, the trip back down is brutal. Okay, let's dive into section 1. I want you to really imagine this scene. It's the peak of a bull market. The market is absolutely on fire. Everything you own, every single coin is deep, deep in the green. The feeling is just electric. And this quote just nails that feeling, doesn't it? It's that mix of pure euphoria and this creeping sense of dread. You're on top of the world, but then this little voice in your head goes, uh-oh, what's the plan now? Without a plan, you're just a passenger. So today, we're gonna build that plan so that doesn't happen to you. So to build any kind of bulletproof strategy, you first have to understand the battlefield. And the crypto market, it's not like the stock market. It's young, it's wild, and it moves to the beat of its own drum in these very clear cycles. A huge reason for all this volatility is this massive collision of two different worlds. On one side, you've got the old guard investors, the suits. They're cautious, risk-averse, dipping their toes in very carefully. And on the other side, well, you've got the new wave. They're tech-savvy, they love risk, and let's be real, they sometimes have a serious case of hope addiction. You mix those two groups together, and you get these huge, emotional, and often irrational market swings. But underneath all that chaos, there's actually a surprisingly predictable rhythm. The market tends to move in these 4-year cycles, and the engine driving the whole thing is the Bitcoin halving. Every 4 years, the amount of new Bitcoin being created gets sliced in half. It's a programmed supply shock. So when you have less new supply hitting the market and demand stays the same or goes up, boom. Historically, that's what kicks off the next massive bull market. Which brings us to the center of the crypto universe. You have to understand how this one asset basically dictates the fate of thousands of others. Because in crypto, all roads, and I mean all of them, lead back to Bitcoin. Now, just to give you some perspective, look at this.
We think of crypto as this massive industry, but when you compare it to legacy markets like gold, it's a baby. It's tiny. And for a lot of people, what this chart screams is potential. There is just so much room for this entire space to grow. But here's the kicker. Inside that relatively small market, one asset is the undisputed titan. I mean, just look at that. Despite thousands of other altcoins, Bitcoin is basically the whole pie. Why? Because that's where the smart money, the institutional money, flows first. So what's the critical takeaway here? It's this simple but powerful truth. As Bitcoin goes, so goes the rest of the market. You can't plan your altcoin exit strategy without keeping a very close eye on the king. And there's a specific dance you need to learn. There are really just 3 rules. 1, if Bitcoin is grinding up slowly or just moving sideways, money gets bored and flows into altcoins. That's alt season. That's when things get really fun. 2, if Bitcoin suddenly pumps like crazy, money flees from altcoins to chase those Bitcoin gains. And 3, the easiest rule, when Bitcoin dumps, everything dumps, usually even harder. Knowing this flow is absolutely crucial. Okay, so we've got the big market picture. Now let's zoom in. We need to look at the specific boat you're sailing in. Before you can decide when to sell, you've got to know exactly what you're holding. You need to pop the hood. And we do that by investigating a project's tokenomics. It sounds like a complicated word, but it just means the economics of the token. Think of it like the financial DNA of a project. And sometimes even the most hyped up projects have really, really bad DNA that's designed to wreck you. So here's your 3-point health check. This is your homework. First, who owns the tokens? Second, are there any hidden time bombs in the schedule? And third, is a massive wave of new supply about to hit the market and crash the price? You can find all this information on a block explorer. It's like a public search engine for crypto. You're hunting for red flags like these. If you see one wallet holding a huge chunk of the supply, well, that single person could tank the price whenever they want. And this one is critical. Look for vesting schedules. If you find out that 1 billion tokens are set to be unlocked and given to early investors on January 1st, well, you just found your sell-by date. Your new plan is to sell on December 31st. All right, theory time is over. Let's put all this together into a practical, real-world example. Let's run through a case study and see how this actually works. So say we bought into XYZ coin. Our initial research looks good. It has a reasonable market cap, lots of room to grow. But during our tokenomics deep dive, we found it, a ticking time bomb. A massive chunk of the supply unlocks for early investors on January 1st. That date is now our hard deadline. We must be out of our position before then. Now, let's fast forward. It's late 2022, the market is euphoric, and our coin hits $20. We're up 10x. We check the market signals. Bitcoin dominance is dropping, which tells us it's alt season, so we hold. Then, bam, another leg up to $30. Now it's time to execute our plan. We know from our research that a 50x move is a realistic best-case scenario, but we're not going to get greedy. Greedy gets you wrecked, so we play it safe and set a limit sell order for $34, well below any big psychological round numbers. And here's what happened. While we were sleeping, the price had a crazy spike, what traders call a wick, all the way up to $65 before it came crashing back down. Now, did we sell at the exact top? Nope. And you almost never will. But who cares? We executed our plan. We walked away with a clean 17x profit. And while all the greedy people got wiped out, we were already on the sidelines, safe and sound. That is the power of having a plan. So after all that, market cycles, Bitcoin, tokenomics, strategy, what is the one single most important thing you need to walk away with today? It is this. Forget about being perfect. Trying to time the exact top of the market is a fool's game. A good, solid plan that you actually follow is 1,000,000 times better than some perfect plan that you just dream about. When fear and greed are screaming at you, your plan is the only thing that will keep you rational. So I'll just leave you with this final question to think about. You probably spent hours, maybe even days, researching what coins to buy. But have you spent even 10 minutes planning how you're going to sell them? Your future self will thank you for it. Thanks for joining me. If you've ever had that feeling, you know, that nagging suspicion that the crypto markets are a game and that game is rigged against you, well, you're not wrong. Today, we're prying open the manipulator's playbook. Think of this as your personal survival guide. So let's pull back that curtain. Yeah, this isn't just a hunch. It's the reality of this space. There are so many forces out there, big and small, all trying to separate you from your money.
It's incredibly frustrating, and it adds this whole other layer of risk to what's already a super volatile world. So, why is crypto the perfect breeding ground for all this chaos? Well, this slide really lays it bare. On one side, you've got traditional finance. It's got watchdogs, like the SEC. If you do something bad, you can get caught and prosecuted. But then you look at crypto, and it's still pretty much the Wild West. It's anonymous, it's unregulated, and that means the folks with deep pockets can get away with a whole lot. The source material calls it a murky old mess, and honestly, it's tough to argue with that. All right, let's kick things off with the most classic, the most infamous manipulation of them all, the pump and dump. You've probably heard the term, but really understanding how it works, that's the key to never falling for it. I mean, the name really says it all, doesn't it? A group of insiders pumps up the price of a coin to create a ton of hype and get everyone's attention. This trick is as old as the hills. It used to be huge with penny stocks, but now these low-liquidity altcoins are its new favorite playground. Okay, so let's break down the 4 stages. It's like a script. First, the accumulate phase. The insiders quietly buy up a ton of some cheap, obscure coin that nobody's watching. Then, stage 2, the pump. They unleash a massive, coordinated promotion online. Think Telegram groups, Twitter, everywhere, to create this insane level of FOMO. That brings us to stage 3, where you and a bunch of other traders see the price going vertical and you jump in, terrified you're going to miss out. And that leads to the final, brutal step, the dump. The original insiders sell everything at the absolute peak. The price completely collapses, and everyone else is left holding a totally worthless bag. So how do you protect yourself from this? You have to learn to spot the red flags. These schemes almost always go after tiny coins, usually ones with only 1 or 2 exchange listings. You'll often see a huge, weird spike in volume before the price takes off. That's the insiders loading their bags. So if you see a coin just suddenly shooting for the moon with no news, no reason, and it's being hyped to death online, that is not a golden ticket. It's a trap. You've got to be super, super careful. Now let's move on to the next set of tactics. These are all about pure deception. They're about creating a total illusion of activity in the market, just to trick you into playing. This one is called wash trading. And what it is an exchange, or maybe a project, will just use bots to buy and sell a coin to themselves over and over and over again. Why would they do that? Well, it creates the appearance of a buzzing, active market. Traders, especially new ones, are drawn to coins with high volume. But in this case, that volume is a complete mirage. And if you think this is some small, niche problem, just look at this number. A major report from Bitwise to the SEC back in 2019 claimed that a jaw-dropping 95% of all reported crypto volume was either fake or what they call non-economic. Let that sink in for a minute. 95%. Now, things have gotten better since then, for sure, but it's a powerful reminder that you absolutely cannot trust the volume numbers you see on tracking sites at face value. You gotta dig deeper. So if the volume itself can be a total lie, what else can they fake? Well, that brings us straight to the order book itself. This is called order book spoofing, or sometimes painting the tape. Basically, a whale, a trader with a massive amount of money, will put a huge order on the books just to trick you. The key is they have absolutely no intention of ever letting that order get filled. Just imagine this. You're looking at the charts and you see a gigantic sell wall of, say, 1,000 Bitcoin. You'd probably think, whoa, the price is about to tank, right? So maybe you don't buy, or worse, you sell what you have. But here's the trick. Behind the scenes, that same whale is secretly scooping up coins at the lower price they just created. And then, just as the price gets close to that massive wall, poof, it vanishes. They just played the entire market. All right, this final category of manipulation, it's maybe the most devious of all, because it's not targeting the charts. It's targeting our own psychology, our fears, our greed, our human nature. FUD. It stands for fear, uncertainty, and doubt. This is basically spreading negative rumors, fake news, to scare everyone into selling. And it works so well because of something called loss aversion. As humans, we feel the pain of a loss way more intensely than we feel the joy of a gain. So that fear of losing money is a powerful motivator that can easily trigger a massive panic sell-off. So the most important thing here is to just take a breath and think critically before you react. Always, always question where the information is coming from. Is it a random account on social media or a credible source? Look for actual facts that can back up the claim. And maybe most importantly, ask yourself who benefits if the price crashes.
But a word of caution. Don't get so cynical that you just dismiss everything as FUD. Sometimes the concerns are very, very real. This next one is just nasty. It's called stop-loss hunting. This is when a whale knows exactly where a bunch of traders have set their automated sell orders, their stop losses, and they intentionally push the price down just far enough to trigger all of them. And what's so cool about this slide is you can see exactly how it works. The whale kicks it off with a bunch of big sell orders, creating that long, sharp downward wick you see. This sets off a chain reaction, triggering everyone's stop losses and forcing them to sell. Then the whale immediately turns around, scoops up all those cheap coins with massive buy orders, and the price snaps right back up. You check your phone and find out you were sold out of your position at the absolute bottom of the dip. It's infuriating. It's a really tough spot, right? Because stop losses are a critical tool for managing risk. You don't want to just trade without a safety net. So what's the move? Well, the answer is to use a smarter tool. It's called a stop limit order. Here's the difference. A regular stop loss becomes a market order the second it's hit. It sells at whatever the current price is. But a stop limit order has two parts. The stop price still gets triggered, but instead of selling instantly, it places a limit order. That means you're telling the exchange, hey, I'm not willing to sell for anything less than this specific price. That tiny bit of breathing room can be the difference between getting hunted and riding out the storm. Okay, deep breath. We have journeyed through the dark arts of crypto manipulation. Now for the most important part. How do you actually defend yourself? Let's build your survival strategy right now. Here it is. This is your takeaway checklist. At the end of the day, it all comes down to being diligent. Do your own research, always. Check your sources. Stick to the big, reputable exchanges that have a reason to play fair. Learn to analyze the order book and spot the signs of something fishy. And finally, use those smarter tools like stop limit orders to outmaneuver the hunters. And there is some good news here. It's not all doom and gloom. The crypto space is growing up. The biggest exchanges are working hard to stop these kinds of tactics, and even regulators are starting to step in and file cases. The Wild West is slowly but surely getting a little more civilized. But personal responsibility is still everything, which really leaves us with one final big question. The whole promise of crypto is financial freedom from the old broken system. But that freedom comes with the responsibility of navigating all these risks yourself. Knowing what you know now about all the hidden landmines, you have to ask yourself if that freedom is worth the fight. There are few topics in crypto guaranteed to start a debate quite like leverage trading. Seriously, bring it up and you'll get two totally different stories. Is it this sophisticated financial tool for professionals, or is it basically a casino game that's rigged to make you lose? Well, today we're going to cut through all that noise and figure out what's really going on. So that's the big question we're tackling here. Is leverage a legitimate instrument that can actually help traders manage their portfolios? Or is it just a destructive trap, one that's really just designed to prey on newcomers and make a ton of money for the exchanges? We're going to look at both sides of this coin. Okay, so what are we even talking about? Let's break it down real simple. Leverage trading means you're entering a position that's way bigger than the amount of money you're actually putting up. You put down a small deposit, that's called your collateral or your margin, and you basically borrow the rest to make a much bigger bet. Now, here is the most important part, the part you absolutely cannot forget. That power to make a bigger bet, it works both ways. If the market goes your way, your profits get multiplied. Fantastic. But if it goes against you, your losses get multiplied by that exact same amount. And this is what makes leverage either an incredible tool or an absolutely brutal account wrecker. To really get a handle on leverage in crypto, you kind of have to understand where it came from. And its history goes back a lot further than you might think. We're talking centuries before Bitcoin was even a glimmer in anyone's eye. And its original purpose? Yeah, it might surprise you. So get this. It all started with farmers who just wanted to hedge their risk and lock in a good price for their crops. Simple enough. Then, in the 70s and 80s, Wall Street gets its hands on the idea and it morphs into a tool for speculation. But the real game changer for crypto was 2013. BitMEX burst onto the scene, offering up to 100x leverage on Bitcoin. To anyone with an internet connection, it was the Wild West. It wasn't until years later, in 2017, that the big regulated exchanges showed up, and they did it in a much, much more cautious way. And man, in those early, unregulated days, exchanges like BitMEX earned a pretty gnarly reputation. Some called it a meat grinder. There were always these rumors swirling that the exchanges were trading against their own users, using inside data to their advantage. This quote just captures that feeling perfectly, the sense that you were playing a rigged game from the start. And this brings us right to the heart of the whole debate. You've got this one tool, leverage, but it's used in two completely different ways by two totally different mindsets. It really is the professional versus the gambler. Just look at this breakdown. The difference is night and day. A professional uses leverage like a scalpel. It's precise, it's strategic, they use small amounts to maybe hedge their portfolio, and crucially, they're usually already profitable just trading normally. The gambler, on the other hand, treats leverage like a lottery ticket. They're chasing a life-changing jackpot with 50 or 100x, trading on pure emotion and hoping it will magically fix their unprofitable strategy. So if so many people are losing with this approach, who's winning? Well, as they say, the house always wins. The exchanges have this powerful, automated system working 24/7 to protect themselves. It's called the liquidation engine, and you absolutely have to understand how it works. Okay, here's how it goes down. A trade moves against you, and because you're highly leveraged, your margin, your initial deposit, starts to evaporate fast. Before your account can go negative, which the exchange will never let happen, their system automatically swoops in and force closes your entire position. That's a liquidation. And let's be crystal clear, this is designed to protect the exchange, not you. And any little crumbs of margin left over, that usually gets swept right into the exchange's insurance fund. And just how big can these insurance funds get? Well, at one point, the BitMEX insurance fund held over 37,000 Bitcoin. That should give you an idea of the sheer scale of the losses we're talking about. This entire war chest was built from the digital dust of traders who got liquidated, or wrecked. So you start to see the business model here, right? There's a direct financial incentive, especially for unregulated exchanges, to offer these sky-high leverage options. Why? Because higher leverage makes positions incredibly fragile. That means more liquidations. And every liquidation is a forced trade that generates fees for the exchange, and it helps top off their insurance fund. And this chart just puts it all in perspective. On one end, you've got these casino-style exchanges offering 100x leverage, sometimes even more. In the middle, you have what most experienced traders actually use, something around 10x. And then way over on the other side, you have the big regulated exchanges where institutions play. They're working with about 2x leverage. The difference is just staggering. Okay, so after looking at all this, what's the final verdict? Well, the picture that emerges is that leverage itself isn't the good guy or the bad guy here. The outcome seems to depend almost entirely on the person who's using it, their knowledge, their discipline, and their strategy. So before you even think about touching that leverage slider, you have to be brutally honest with yourself. Ask these questions. Are you already consistently making money without it, just on the spot market? Do you have a clear, repeatable strategy? Do you know exactly how you'll manage your money? If the answer to any of these is no, then leverage is only going to amplify your mistakes. It's a magnifying glass, not a magic fix. Because at the end of the day, this is the fundamental truth. A reckless, emotional approach to the markets is going to lead to disaster. It doesn't matter if you're using 100x leverage on Bitcoin, going all in on a random meme coin, or chasing some impossible yield in DeFi. The tool itself is always secondary to the mindset of the person using it. And I want to leave you with this one final thought to chew on. The professionals on Wall Street, the folks managing billions of dollars on regulated platforms, are perfectly happy using 2, maybe 3 times leverage. So the question you really have to ask yourself is, why do you need 50 or 100 times more than that? What's the real objective? Is it trading or is it gambling?
Let's talk about the world of trading. It's a place with some absolutely incredible opportunities, but let's be real, it's also filled with some serious pitfalls. But here's the good news. Most of the traps that wipe out new traders, they're completely avoidable. You just have to know what you're looking for. So let's dive in.
It's the million-dollar question, isn't it? I mean, we all see the success stories on social media, but the tough reality is that most people who start trading end up losing money. So, what's really going on here? What's the secret killer of so many trading accounts?
Well, here's the key. It's almost never just bad luck. Failure in trading is usually a pattern. It's a collection of really common bad habits and mental mistakes. And once you learn how to spot them, you can start to systematically get rid of them. Let's break down the first big category.
First up, we've got to talk about the battlefield that's inside your own head. Because honestly, the biggest, toughest opponent you are ever going to face in the market is yourself. Okay,
Check this out. This comparison right here says it all. On the left, you've got the emotional trader. They operate on hope and ego, but the disciplined trader on the right, they operate on a plan. So when a trade goes wrong, the disciplined mind doesn't sit there hoping and praying. It just cuts the loss quickly and moves on. It's a simple but powerful switch from emotion to logic.
And this is where things get really dangerous. It's the most destructive mistake of all, chasing your losses. Instead of just taking that small, planned loss, the emotional trader doubles down, convinced they can win it back. They just dig a deeper and deeper hole. As the source material says, this is the fastest way to get wrecked. It's a straight path to what they call gambler's ruin.
But you know, fear isn't the only enemy here. Sometimes your last big win can be your most dangerous opponent. After a few successful trades, it's so easy to start feeling invincible, right? You get a little complacent, you stop doing your homework, and you start taking way bigger risks than you should. Even the absolute pros can fall victim to their own ego. A little bit of humility goes a long, long way in this game.
Okay, so having your head in the right place is huge, but it's pretty much useless if you don't have a winning plan. And that brings us to our next set of mistakes, the strategy sense. This is all about having your blueprint ready before you ever risk a single dollar. And this, right here, might be the single biggest mistake of them all. Treating the market like a casino. So many new traders just show up and start placing bets, hoping they'll get lucky. But here's the thing. If you treat it like a roulette wheel, you're always, eventually, going to lose to the house edge, which in this case is fees, spreads, and your own emotional decisions.
So what does a real plan actually look like? Well, it's built on these 4 pillars. First, you define your goal. Then you budget your risk. How much can you truly afford to lose? Third, you pick a clear strategy. And finally, and this is the most important part, you do your homework. This is what separates a professional from a gambler.
You know that old saying, a jack of all trades is a master of none? Well, it has never been more true than in trading. You simply can't be an expert in crypto and forex and stocks and commodities all at the same time. The most profitable traders are specialists. They pick a market, they learn everything about it, and they own that space. Your attention is a limited resource, so don't spread it too thin.
And here's another myth we need to bust. This idea that you have to be trading all the time to make money. That is just not true. In fact, your most valuable time isn't spent clicking buy or sell. It's spent researching, analyzing, and just patiently waiting for the right opportunity. Forcing a trade when there isn't one is basically just making a donation to the market.
All right, so you've got your mindset right, you've got your plan built. Now we need to talk about the mechanics, the nitty-gritty technical mistakes that can trip up even the most prepared trader.
I'm sure you've seen this splashed all over exchanges. 100-to-1 leverage. It promises these massive, life-changing gains from a tiny amount of capital. But what they don't always tell you is that it comes with a huge and often hidden risk.
Here's the scary part. Leverage magnifies everything. A 1% market move against you, when you're using 100x leverage, becomes a 100% loss. Your whole position is just gone, instantly. A tiny little mistake becomes absolutely catastrophic. So just because an exchange offers you that much leverage, it does not mean you should ever use it. Smart risk management is key to survival.
Okay, this is non-negotiable. This is your single most important safety net. A stop loss is an automated order that takes all the emotion out of the decision. You decide your maximum acceptable loss before you even get into the trade. If the price hits that level, the system automatically closes your position for you. It's like built-in discipline, and you have to use it.
Does this look familiar to anyone? Some traders just plaster their charts with so many lines and indicators that it ends up looking like a Christmas tree. But this doesn't make you a better analyst, it just leads to analysis paralysis. You end up with 5 indicators telling you to buy and 5 telling you to sell. Simplicity is clarity. Trust me, a few well-chosen tools are way more effective. All right, so even if you get your own house in order, you master your psychology, you build a solid strategy, the trading world is still full of external threats. You have to learn how to separate the real signal from all the noise out there.
Think of it this way. Your broker or exchange is your business partner in this journey, so you've got to choose them wisely. Don't just go for the one with the lowest fees. You need to know your funds are secure, that the platform is actually reliable, and that it has a solid reputation in the community. Doing your homework here can save you a world of pain down the road.
And oh boy, this is a big one. Beware the online guru. We've all seen them, right? Flashing a lifestyle that just seems way too good to be true. And you know what? It is. These folks aren't traders, they're marketers selling a dream. The real truth is, there are no secrets. All the education you could ever need is out there for free if you're just willing to put in the work.
So, let's bring all this together. The journey we've just walked through is really about making a fundamental shift, a shift in your identity. It's about leaving the casino behind and becoming a real trader.
If you remember just one thing from all this, let it be this. Everybody focuses on finding that one perfect trade, that one brilliant call. But long-term success isn't about brilliance. It's about discipline. It's a game of defense, and it's won by consistently avoiding these common, simple mistakes. And that leaves us with one final question to think about. When you look at your own habits, your own preparation, your own mindset, be honest with yourself. Which one are you truly building towards? Because the answer to that question will determine everything. All right, let's jump right in. We need to talk about a core contradiction, a real puzzle at the heart of crypto. We have all these decentralized assets, right? They're built on this big promise of you being in control. So why is almost everyone trading them on centralized platforms?
I mean, it's a real head-scratcher when you think about it. The entire philosophy of crypto seems to be at odds with how most people actually trade it. And this exact contradiction is what we're going to unpack today, and we'll look at one platform that's trying to finally solve it.
So here it is, laid out plain and simple. The promise was always about pure financial freedom, the idea that you, and only you, are in charge of your assets. But the reality? Well, for most traders, it's been about handing over that control to big, centralized exchanges, basically bringing back the very middlemen that crypto was supposed to get rid of.
But what if there was a better way? You know, a way to get that slick, professional trading experience you want, but without having to give up on that original decentralized dream. Well, there is. It's time to meet DYDX.
So what is DYDX exactly? Simply put, it's a decentralized exchange, or a DEX, and it lives right on the Ethereum blockchain. Now, the key phrase here, the one you really need to remember, is non-custodial. It sounds technical, but it just means that you are always in control of your funds and your private keys. And this isn't just for simple coin swaps. We're talking about a real powerhouse for serious traders. And you don't have to take my word for it. The numbers show that people really trust this thing. At the time this data was pulled, there was nearly $19 million of value locked into the protocol. In the world of decentralized finance, or DeFi, that's a huge metric. It's a massive vote of confidence from the entire community.
And all that trust, it translates directly into a ton of activity. We're talking over $200 million in trading volume since it first launched. This isn't some small experimental project. No, this is a serious player that's processing real, substantial trades every single day.
In fact, all this growth has really cemented its spot as a top dog in the DeFi space. Being the 8th most used app is a big deal. It means they've figured out how to blend really powerful features with an experience that people actually enjoy using, which keeps them coming back for more.
So what's the secret sauce here? I mean, what really makes DYDX stand out in such a crowded market? Well, it really boils down to 3 core functionalities, what I like to call its 3 superpowers.
And here they are, the 3 pillars of the platform: margin trading, lending, and borrowing. What's so amazing is that DYDX bundles all 3 of these into one seamless, decentralized package. So let's break each one of these down.
Okay, I absolutely love this slide. The glass box analogy is perfect. On most centralized exchanges, the rules for things like liquidation are totally hidden from you. It's a black box. You just have to trust that they're playing fair. But with DYDX, everything, and I mean everything, runs on open source smart contracts. It's a glass box. Anyone can look inside and see exactly how the rules work. Total transparency.
Now you might see that 5x leverage and think, wait a minute, other places offer 100x. And you're right, but this is actually a feature, not a bug. See, sky-high leverage is a double-edged sword. DYDX caps it at 5x on purpose, to reduce the insane risk of getting liquidated because of one tiny price swing. It's a strategic move that attracts a more calculated kind of trader, which honestly makes the whole ecosystem a lot more stable for everyone. Let's move on to the next superpower, lending. This is where the magic of DeFi really shines. It's so simple. You just deposit your assets, they go into this big global lending pool, and bam, you start earning interest right away. Instantly. And there are no lockup periods, no minimums. You can pull your funds out whenever you want. It's passive income, the crypto way.
And on the flip side of that, you've got borrowing, which is what powers all the margin trading on the platform. To borrow, you have to put up collateral that's worth at least 125% of what you want to borrow. But the number you really have to watch is 115%. If your collateral's value drops to that level, your position gets liquidated. This makes sure that the lenders always get paid back. It's a totally transparent system of checks and balances.
So running a super popular decentralized app on Ethereum isn't cheap. In the beginning, DYDX was actually covering all the transaction fees, the gas costs for its users. Pretty cool, right? But as the platform just exploded in popularity, those costs became totally unsustainable. So they made a practical switch to a classic maker-taker fee model to keep the whole thing running smoothly for everyone.
Okay, so we know DYDX is powerful, but hey, it doesn't exist in a bubble. To really get a feel for where it fits in, we need to see how it stacks up against some of the other giants in the DeFi world.
This chart pretty much tells the whole story. You've got these incredible projects, like Maker, which is all about stablecoins, or Compound, which is a pure lending machine. They're amazing at what they do. But just look at that top row. DYDX is the one that brings it all together. It's the only one that uniquely bundles that high-powered margin trading with deep lending and borrowing pools. It's a true all-in-one trading hub.
All right, so we've looked at the features. We've checked out the competition. What's the big picture here? What's the main takeaway? Why should you be paying attention to DYDX? Okay, here's the bottom line. DYDX really gives you the best of both worlds. You get a clean, fast interface that feels just like a top-tier centralized exchange, but you get the unbeatable non-custodial security of a DEX. That means you never give up control of your funds. It's a one-stop shop for all your advanced crypto activities, and that glass box transparency means you can actually trust the system because you can see all the rules for yourself.
And that kind of brings us to our final thought for today. What we're seeing with platforms like DYDX, this incredible mix of a great user experience, total user control, and radical transparency, it's really, really powerful. And it makes you wonder, is this glass box approach just the future of crypto, or could this be the future of all trading everywhere? Definitely something to think about. Thanks so much for tuning in.
So, crypto trading bots, are they the secret weapon to making money while you sleep? Or are they just a super fast way to lose your shirt? Today, we're going to cut right through all the hype and figure out what these things are really all about. Oh man, you know that feeling, right? That pit in your stomach when you wake up, check your phone, and realize you slept through a massive pump or a dump. If you're in crypto, it feels like you're in this constant, unwinnable race against a market that literally never closes. All right, so here's the game plan. First, we'll dig into that 24/7 problem. Then, we'll see how trading bots promise to be the solution. We're going to hit the pros and the cons. No sugarcoating here. After that, a quick look at a few different kinds of bots, and we'll wrap it all up with the single most important thing you need to remember. Okay, let's kick things off with Section 1, the 24/7 crypto problem. Or, as I like to call it, the trader's dilemma. Think about it. The crypto market is just this relentless, non-stop beast. There's no opening bell, no closing time. It's always on all over the world, which is awesome for opportunities, but it also creates this huge problem. How are you supposed to keep up? You have to sleep, you have to work, you have to live your life. And that's exactly the problem that automation claims it can solve. So, what's the fix for this 24/7 madness? Well, for a growing number of traders, the answer is automation. Let's talk about how a trading bot can step in and, maybe level the playing field a bit. So, what in the world is a crypto trading bot? Honestly, the simplest way to think about it is like hiring a personal assistant who's a trading prodigy and also never sleeps. You just give it a very specific set of instructions, your strategy. Like, hey, if Bitcoin drops to this price, buy this much. And poof, the bot does it for you instantly. No hesitation, no emotion, just pure execution 24/7. And you might think setting this up is some crazy technical feat, but it's actually pretty straightforward. First, you pick a bot and the strategy you want it to run. Second, you connect it to your crypto exchange using something called an API key. Think of it as a special, limited access key card for the bot. Third, and this is the big one, you set its permissions. And finally, you turn it on and let it do its thing. Okay, I can already hear you asking, wait, is it safe to give a program access to my money? And that is absolutely the right question to ask. The answer is yes, but only if you do it right.
When you make that API key, you're the boss. You tell it what it can and can't do. You set the permissions to only allow trading, buying and selling, and the absolute #1 non-negotiable golden rule is you must disable withdrawal permissions. That way the bot can trade inside your account, but it can never, ever, ever move your funds out. All right, time for the most important part of this whole discussion, the reality check. Let's weigh the pros against the cons, the dream versus the cold, hard facts. So on the pro side, it's pretty awesome. The bot trades around the clock, so you don't miss out. It takes all emotion out of it, no more FOMO, no more panic selling. And you can backtest your ideas, which is huge. You can see how your strategy would have done in the past before you risk a single penny. But, and this is a big but, it's not a free lunch. Bots aren't set and forget. They need constant babysitting. The world is full of scams and bad bots. And you have to keep your money on an exchange, which, let's be honest, always carries some risk. And this quote from one of our sources just nails the biggest misconception. People really get this idea in their head that a trading bot is like hitting a button that just prints money. But let's all say it together. There is no such thing as a magical money printing machine. So let's get down to the cold, hard truths. 1. These things are not set it and forget it. The market changes, your strategy has to change with it. 2. A bot is just a tool. It won't make a bad trader a good one. It just makes a good trader faster. And 3, and please burn this into your brain. If any bot service guarantees returns, especially for a cheap one-time fee, run. Just run for the hills. That is Scam 101. Okay, now that you know what the big red flags are, let's do a quick tour of what's actually out there. Because not all bots are created equal. You gotta find the right tool for the job. You've really got a whole ecosystem of bots for different people. You have something like Shrimpy, which is amazing for long-term hodlers. Its whole thing is automatically rebalancing your portfolio to keep your allocations in check. Then you have something like Trade Santa, which is really intuitive and great for beginners who just want to dip their toes in. And then you have the heavy hitters, like 3 commas. This is for more experienced traders who want all the advanced bells and whistles, like setting a profit target and a safety net stop loss at the exact same time. All right, let's bring it all home. What's the final takeaway? If you remember just one thing from all of this, please make it this. Bots are a tool. They are not magic. You know, a crypto trading bot is kind of like a Formula One race car. In the hands of a skilled driver, it's an incredible machine that can win championships. But if you give me the keys, I'm probably going to end up in a wall. The bot can't make you a better trader. All it can do is execute your strategy, your ideas with perfect discipline and speed. Its effectiveness is 100% on you. So if you're even thinking about diving in, here's my final advice. 1. Do your own research. Seriously, learn everything you can before you risk a dime. 2. Become the most skeptical person on earth. If a promise of profit sounds even a little too good to be true, it is. And 3, don't put all your eggs in one basket. Spreading your funds across different exchanges is just a smart way to manage your risk. So then you have it, the good, the bad, and the sometimes ugly truth about crypto trading bots. They offer some seriously impressive power, but that power comes with real risk and demands real skill. So the final question is for you. Are you ready to hand over the keys?
What if there was a secret signal out there, basically broadcasting the Bitcoin market's next move? Well, today, we're going to dig into a hidden advantage that could totally change how you look at price action.
You know, this quote really hits the nail on the head. Every single person in the market is looking for that special edge. But here's the catch, right? The really good stuff, the actionable insight, that's usually hidden away or costs a small fortune to get your hands on.
But what if I told you there's a free and, frankly, an incredibly powerful tool that does just that? A single number that basically acts like a mood ring for the entire market. I'm going to show you exactly what that number is and, way more importantly, how you can actually use it. So here's our game plan. First, we're going to do a super quick crash course on options. Then, we'll get a handle on a concept called moneyness. Once we have that down, we'll finally pull back the curtain on the secret signal, the put-call ratio. And by the end, you'll know exactly how to read the market's mood.
Okay, first up, a crash course on options. See, to understand the signal, we kind of need to speak the language. But don't worry, we're not going to get bogged down in the weeds. I'm just giving you the absolute basic vocabulary you need and nothing more.
So what even is an option? Well, think of it like a special kind of contract. It gives you the right, but, and this is key, not the obligation, to buy or sell something like Bitcoin at a price you agree on today for some time in the future. The key thing to remember is that it's a choice, not a command.
Now, there are really only two basic flavors. You've got a call option, which gives you the right to buy. This is basically a bullish bet. You're hoping the price goes up. And then you have a put option, which is the right to sell. This is your bearish bet. You make money if the price goes down. It's that simple. Calls for up, puts for down.
Now, I'm sure you've probably heard some pretty intimidating terms thrown around like the Greeks or the Black-Scholes model. Well, here's the great news for us today. You can just forget all of that. We're going to completely skip the heavy math and focus only on what we need to read the market's mood.
All right, let's move on to our next building block, understanding moneyness. It sounds kind of complicated, but it's really just a fancy way of asking a super simple question. If you could use your option right this very second, would you actually make any money?
See, moneyness is all about the relationship between two numbers. First, the current price of the asset on the market. We call that the spot price. And second, the price that's locked into your options contract. That's called the strike price. That's it.
For a call option, the right to buy, it's super simple. If the current market price is higher than your locked-in price, your option is in the money. Boom, it's profitable. If they're pretty much the same, it's at the money. And if the market price is lower, it's out of the money, which just means it's not profitable to use right now.
And for put options, yep, you probably guessed it, you just flip the whole thing on its head. A put option is in the money when the market price is below your locked-in strike price. Why? Because you've locked in the right to sell at that higher price, which is a great position to be in. And just like that, we've built our foundation.
And all that groundwork brings us right here to the main event, the put-call ratio. This is it. This is the market's secret sentiment score we've been building up to.
So what is this thing really? Well, at its core, it does one very simple job. It compares the total amount of bearish bets out there, the puts, to the total amount of bullish bets, the calls. It's a raw, unfiltered look at market fear versus market greed.
And reading it is honestly dead simple. If the ratio is bigger than 1, it means there are more puts than calls. Sentiment is leaning bearish. If it's less than 1, there are more calls than puts, and sentiment is bullish. It's just this beautifully simple snapshot of the market's vibe.
So let's take a look at a real number, a put-call ratio of 1.36. What is that actually telling us? Well, it means that the total value of all the bearish put options is 36% larger than the value of all the bullish call options. That's a pretty serious bearish tilt in the market.
To picture it, think of a seesaw that's clearly tipping to one side. For every single dollar that's betting the price will go up, there's $1.36 betting it's going to go down. This gives you an instant, intuitive feel for just how imbalanced the market's expectations have become.
Okay, this is the part we've all been waiting for. The final and most important section. How do we actually turn this number into a real actionable edge?
So why is this so powerful? Well, for one, it gives you a gut check on where traders actually expect the market to go. It shows you how the big money is positioned. And hey, here's a little pro tip. For the cleanest, most reliable signal, you want to look at the ratio based on open interest. That's the total number of active contracts, not just one day's trading volume. But listen, if you only take one thing away from this entire explainer, please let it be this. The real power here is not in today's number, whether it's 1.36 or 0.8. The real secret is in how that number moves over time.
The real signal is the trend. That's the whole game. Is the ratio creeping up day after day? Well, that's fear building in the market. Is it falling steadily over a week? That's confidence returning. Watching how this number shifts over time gives you a feel for the tides of the market that a single snapshot just never ever could.
So look, the data's out there, it's talking, broadcasting the market's mood 24/7. The only question left is, are you ready to listen?
You know, the crypto world, it's just a sea of noise, right? You've got price predictions flying all over the place, tons of hype, FUD. It can be pretty overwhelming. But what if I told you there's a way to cut through all that? A way to actually listen to the whispers of the market itself and hear what the real smart money is betting on? Well, today, that's exactly what we're going to do.
So that's the big question, isn't it? How do you find that real signal in all the market noise? I mean, who do you trust? The talking heads on social media? Or do you try to find a way to track where the actual money is flowing? It's a tough one, for sure. But what if there was a place where the biggest players, they're basically forced to show their cards? A place where the real high-stakes bets are being made? Well, that place exists, and it's the options market. We're talking about where the big institutional funds, the really sophisticated market makers, are putting down massive bets with real hard capital. And get this, by analyzing what they're doing, we can unlock two super powerful tools. One that lets us read the market's mood, and another that gives it a much-needed reality check.
Okay, so let's dive into tool number 1. It's called option skew. And honestly, it's kind of like having a secret window right into the market's soul. You can think of it like the market's heartbeat, telling us if it's racing with excitement and bullishness or if it's slowing down with a bit of bearish fear.
So what is it, really? Well, at its core, option skew is basically a big tug of war between the bulls and the bears, but they're playing with real money. It just measures the price difference between the bearish bets, those are called puts, and the bullish bets, which are called calls. The skew itself, that's our scorecard. It tells us which side is pulling harder at any given moment. And the best part about this is that it's all based on hard, cold data. Now, you're looking at the formula here, and yeah, it looks a little intense. But don't worry, you absolutely do not need to be a math whiz to get this. This is just the engine under the hood. The only thing that really matters is grasping the simple idea behind it. And that core idea is really, really simple. All that math is just telling us one thing: which type of bet is more expensive. See, when fear is running high in the market, traders rush to buy protection, and that makes the bearish puts cost more. And on the flip side, when greed takes over, everyone wants to bet on the upside, so the bullish calls get more expensive. It's pure supply and demand. So it all boils down to this, nice and simple. If the skew number is positive, it means puts are more expensive and the market is feeling bearish. If the skew number is negative, it means calls are more expensive, and that's a signal that the bulls are running the show. Yep, it's really that straightforward. Okay, theory's great, but let's get to the fun part. Let's put this into practice. We're going to look at some real-world Bitcoin data and actually read the market's mood right now. So what you're seeing here, think of it like an EKG for market sentiment. It's really cool. Each of these lines represents the skew for a different time frame: 1 month out, 3 months out, and 6 months out. This shows us not just the mood right now, but exactly how that mood has been shifting over the past few months. Okay. Now, zero in on that red line for me. That's the 3-month skew. And look where it is. It's sitting at negative 8.3%. Now, remember what we just said a minute ago? What does a negative skew mean? Bingo. It's a clear signal that traders are betting on the upside. The bulls are in charge.
Right, so that negative number itself points to bullish sentiment for sure. But what's even more powerful here is the trend. Do you see how that line has been moving lower and lower? That tells us that the bullish feeling isn't just there, it's actually been getting stronger over time. This isn't just some random gut feeling, it's a measurable trend. And what's fascinating is how closely it's been tracking Bitcoin's actual price movement.
Okay, so that's tool number 1. We now know how to read the market's mood. But here's the thing. Knowing the mood is one thing. Knowing how far the market thinks that mood can actually push the price, that's a whole other level. And for that, we need our second tool, price probabilities. I like to call this one the ultimate reality check. So this tool, it uses the exact same rich data from the options market, but it crunches it in a different way. This time, it's calculating the odds, the probability, of an asset hitting a certain price by a specific date. You know, it's kind of like a weather forecast, but for price. It's not going to promise you a sunny day, but it'll tell you there's a 70% chance of sunshine. It's a forecast generated by the market itself. And again, here's the best part. You don't have to be a stats genius or a math professor to use this. There are these super sophisticated models running in the background doing all the heavy lifting for us. They take all this incredibly complex market data and just spit out a simple, easy-to-read forecast. So let's peek behind the curtain. What are the pros really thinking? Where do they believe prices could realistically end up? Well, let's stop guessing and just look at the data. Okay, think of this chart as a roadmap of possibilities. It's super useful. It shows us the probability, according to the market, of Bitcoin being above a certain price target by a certain date. It's pretty intuitive, right? Along the bottom, you have the price targets, and as you move to higher and higher prices, you can see the probability on the side getting lower and lower. Makes sense. All right, let's pull out a specific example to make this really hit home. You see that point there? Right now, the market is pricing in a 28% chance that Bitcoin will be trading above $22,000 by December 25th.
Okay, so what about a bigger jump? What are the odds of hitting 24,000 by that same date? Well, you can see the probability drops down to 19%. And this is exactly how you use it. You start to get a real data-driven feel for what the professional market thinks is plausible versus what it thinks is, a bit of a long shot. And that right there, that is why this tool is so incredible. Seriously, the next time you're scrolling and you see some wild prediction, Bitcoin to 100K next month, instead of just reacting, you can pull up data like this and give yourself a reality check. You can ask, okay, that's a nice story, but what does the market actually think the odds are? So when you put it all together, what's the big takeaway? It's actually a pretty simple but really profound shift in how you look at the market. It's about learning to listen to the data and not just the hype. There's a quote from the source we used for this explainer that just nails it. It says that what professionals claim on TV, that's just talk, but the prices they are actually willing to pay for these options, that reveals their true conviction. At the end of the day, money talks, right? Okay, but here's a really important caveat. I gotta be super clear about this. These tools are not crystal balls. They're not gonna give you guaranteed winning lottery numbers. What they are powerful data-driven probabilities. They're designed to inform your analysis, not to be your analysis. So I'll leave you with this question. The next time you're trying to figure out what's going on in the market, just ask yourself, am I listening to all the noise and all the hype? Or am I listening for the real signal hidden in the data? Because honestly, the answer to that question could make all the difference.
All right, let's talk about one of the hidden forces that can send Bitcoin's price on a wild ride. And nope, it's not always about big news or social media hype. Sometimes it's just a specific date on the calendar. So let's dive in and figure out why.
You know the feeling, right? You're watching the charts, everything seems calm, and then boom, the price suddenly jumps or dumps, and you're just sitting there scratching your head trying to figure out what on earth just happened.
Well, a lot of the time, the clue isn't in a headline. It's right there, hiding in plain sight on the calendar. We're talking about something called an options expiry date, and today we're going to break down exactly what that is and why it matters so much.
So, let's get right to it. What are these dates and how do they have the power to shake up the entire market?
Okay, an options expiry date is pretty much what it sounds like. It's the last day that an options contract is still in play. But here's the key. When you get a huge number of these contracts all expiring on the exact same day, it can kick off a chain reaction that causes some serious volatility.
But how? I mean, how does a simple deadline for a bunch of contracts actually make the price of Bitcoin move? Well, it all comes down to a chain reaction that happens behind the scenes.
And here's how that whole thing unfolds. First, as that expiry date gets closer, traders who are holding these options, they have to make a choice. They either have to close their positions or roll them over. Now, at the same time, you've got the big players, the market makers, who have to shuffle their own holdings to manage their risk. All of that frantic activity in the options market then spills over directly into the spot market, and that's where you and I see the price start to go crazy.
And this isn't some new crypto-only phenomenon. The stock market has been dealing with this stuff for decades. They call them expiry weeks, and everyone knows that's when things can get a little choppy. Now that Bitcoin options have gotten so huge, we're just seeing that same exact effect play out in our world.
Okay, so we know these dates can bring the chaos. But is there any way to get a clue about which direction the price might be leaning? You bet there is. We just have to look at the data.
So first, we need to understand the two sides of the coin here. You've got call options, which are basically a bet that the price is going to go up. Think bullish. And then you have put options, which are a bet that the price is going to go down. Think bearish. Pretty simple, right?
The metric we really care about here is called open interest. Just think of it as the total number of active bets, both bullish and bearish, that are still out there waiting to be settled. So, by comparing the open interest for calls versus puts, we can get a really neat snapshot of how the market is feeling.
All right, let's walk through a real-world example from the source material. For options that were set to expire on a specific December 21st, the total open interest on the bullish side, that's the calls, was worth about 4,200 Bitcoin.
Now, let's look at the other side of the bet. For that very same day, the open interest on the bearish side, the puts, was only about 1,770 Bitcoin. You can probably already see where this is going. There's a big difference there.
And when you visualize it like this, it's just, wow, it's not even a close fight.
The number of bullish bets, those call options, is absolutely towering over the bearish side.
And if we put a hard number on it, there was almost 2.5 times more money betting on the price going up than betting on it going down. That is a really strong signal coming from the market.
So, what does this tell us? Well, in theory, an imbalance like this suggests there's a lot more potential buying pressure waiting in the wings than selling pressure. For this particular date, the market was definitely leaning bullish. Okay, but before you run off and start circling every expiry date on your calendar, we need to pump the brakes for a second. It's super important to remember that this is just a guide. It is not a crystal ball.
For one thing, market sentiment can shift really fast in those final days, so you always want to recheck this data maybe 2 or 3 days before the actual expiry. And remember, this isn't a perfect science. There are other huge forces at play, like the futures market or some massive whale order that could come out of nowhere and completely change the game.
You know, the trading expert in our source material put it perfectly. They said it's simply a handy guide that I use from time to time. It's one tool in a big toolbox, and it's definitely not the only tool. So, with all that said, what's the big takeaway? How can you actually put this knowledge to good use?
Well, the goal here isn't to perfectly predict the future. It's really all about preparation. Just knowing that a certain date on the calendar is a potential volatility hotspot means you won't be caught completely off guard when things get choppy.
So here's your game plan. First, go ahead and pin those major expiry dates in your calendar. Just knowing they're coming is half the battle. This simple step can help you not get blindsided by a sudden massive price gap. And finally, just add this whole concept to your broader research toolbox. It's one more piece of the puzzle.
Understanding options expiry is a fantastic tool, for sure. But it really makes you wonder, doesn't it? What other powerful market clues just like this one are out there, just hiding in plain sight, waiting for us to find them?
All right, today we're going to pull back the curtain on one of the most powerful tools out there for any crypto trader, Bitcoin options. Seriously, these things can open up a whole new universe of strategies, letting you trade with a kind of precision you just can't get anywhere else. So let's dive in. So let me ask you this. You ever have that feeling in your gut that the Bitcoin market is about to go absolutely wild, but you're just not sure which way? Is it going to pump or is it going to dump? How do you set yourself up to profit from that chaos without just making a 50-50 guess? Well, that's the exact problem that options were born to solve. To get to all those cool advanced strategies, we've got to start with the absolute core concept. So what in the world is an option? The secret is right there in the name. Okay, get this. An option gives you the right, but, and this is the crucial part, not the obligation to buy or sell an asset at a set price down the road. That little distinction between a right and an obligation, that's everything. It is the absolute secret sauce of options trading. This is what makes options completely different from something like a futures contract. With futures, you are obligated. You're locked in, you made a promise, and you have to see it through, for better or for worse. An option, though, it's literally what it sounds like. It's a choice you get to make later on. And here's why that choice is so incredibly powerful. If the market goes against you, if your trade is a total bust, you can just let the option expire. You just walk away. The only thing you lose is the money you paid for the option in the first place. Your risk is totally defined right from the get-go. And that brings us to the single most important, most beautiful idea in options, what we call asymmetric payoffs. It sounds fancy, but it's a really simple concept. Your risk is small and limited, but your potential for reward, well, that can be huge. Now just look at the shape of this graph. This says it all. This is the payoff for a basic call option. See that flat line at the bottom? That's your maximum loss. That's your safety net. No matter how far Bitcoin's price crashes, you can't lose a penny more than what you paid. But then, look to the right. As the price goes up, your profit potential just keeps on climbing. Now let's compare that to the world of futures, where your potential loss is often described with one simple, terrifying word: unlimited. And boom, this graph shows you exactly what that means. This is a futures contract. Notice something? There's no floor. There's no safety net. If that price moves against you, that red line just keeps plunging downwards, and your losses can become absolutely catastrophic. The difference in risk between this and what we just saw, it's night and day. All right, so if we're going to start building strategies, we need to speak the language. Let's do a super quick run-through of the essential lingo. First up, a call option. This gives you the right to buy. It's really simple. You use a call when you're bullish, when you think the price is headed up. You're calling the price higher.
The total opposite is a put option. This gives you the right to sell. This is your tool when you're bearish, when you expect the price to take a nosedive. You want the right to put your asset onto somebody else at a better price.
And next, we have the strike price. This is just the pre-agreed price that's locked into the contract. Think of it as the benchmark, the magic number that decides if your option is going to make you money or not.
Now, behind the scenes, there's a whole bunch of complicated math that determines an option's price. You'll hear traders talk about the Greeks, delta, gamma, vega, all that stuff. But listen, we are not going to drown in a math lecture today, because what's way more important is understanding what you can actually build with these things.
And that's the real key. You can combine calls and puts in all sorts of creative ways. Think of them like financial Legos. You can click them together to build a strategy that perfectly matches your very specific prediction for the market.
So let's play out a scenario. Let's say you think Bitcoin's going to go up, but you're not expecting it to, rocket to a new all-time high or anything. You're just moderately bullish. How do you trade that specific idea? Well, you could build a strategy called a bull spread. What you do is you buy a call option, but at the same time, you sell another call option with a higher strike price. Now, look at the graph. By selling that second option, you do cap your maximum profit. But, and here's the brilliant part, you drastically reduce how much it costs you to get into the trade in the first place. It's a way to make a really defined, cost-effective bet. But what if you don't have a clue about direction? What if you're just convinced the market is about to get really, really interesting?
I mean, this is a classic crypto scenario, isn't it? There's some huge event on the calendar, a big policy decision, a major network upgrade, and you just know it's going to set off fireworks. The price is either going to pump hard or dump hard.
The solution? You bet on both directions at the same time. You can actually buy a call option and a put option. This combo play is known as a straddle or a strangle. And this is what that looks like. It's this beautiful V shape. You're making a bet on pure movement. As long as the price moves far enough, in either direction, to cover the cost of buying both options, you make a profit. You're not trading direction anymore. You are literally trading volatility itself. And honestly, these two examples are just scratching the surface. By combining options in different ways, you can create an almost endless menu of strategies with awesome names like bear spreads, iron butterflies, iron condors. You can even use different expiry dates with calendar spreads. So if there's one thing you take away from this, let it be this. Options are so much more than just a different way to buy or sell Bitcoin. They are a precise toolkit. They let you express and trade your specific opinion about what's going to happen next. They let you turn a prediction into a structured position. So the only real question left is, what's your next prediction? All right, so if you've been around the crypto world for a minute, you know the #1 rule, right? Huddle. Just hold on for dear life. But what if there was a way more sophisticated way to play the game? Today, we're going way beyond just buying and holding. We're going to dive into a super powerful tool that's totally changing things for traders and big institutions, Bitcoin options. Okay, so just picture this for a second. You are bullish on Bitcoin. You're convinced it's headed up over the next few months. But you also know how this goes. You're aware of that crazy volatility, and you want to make sure you don't get wiped out by a sudden drop. That's the classic dilemma, right? And it's exactly where options come into the picture. So to see how this all works, we're not going to get bogged down in a bunch of dry theory. No. Instead, let's actually roll up our sleeves and build a real practical strategy you could use. It's called a bull spread. Now, what's so cool about this strategy is that it's all about balance. A bull spread, you're perfect for when you think the price is going up, but maybe not, to Mars. You're basically trading away that moonshot potential in exchange for putting a hard limit on your risk. And, get this, lowering how much it costs you to even get into the trade. It's a really calculated, smart bet. So how do you actually build this thing? It's just a simple two-step dance. First, you buy a call option. That gives you the right to buy Bitcoin at a set price. So let's say you buy a call at a $10,000 strike price. That's your bet that Bitcoin will rise above that. But here's the clever part. To help pay for that bet, you simultaneously sell a call option at a higher price, say $12,000.
Now, that second move does cap your maximum profit, but it also puts cash right back into your pocket, which makes the whole trade cheaper and less risky from the get-go. Pretty slick, right? Okay, so we've got a strategy down. But where in the world does a trade like this actually happen? Let's pull back and take a look at the ecosystem where all these Bitcoin options are flying around. First thing you gotta know is that the auctions market is still kinda the new kid on the block, especially when you compare it to the gigantic Bitcoin futures market. But, and this is a big but, it is catching up, and it's catching up really fast. All that action is happening in three main places. So you've kind of got three different flavors. On one end, there are swap dealers like LedgerX. These guys create totally custom or bespoke contracts for huge institutions. On the other end, you have retail exchanges like Deribit, which is where individual traders like you and me can jump in. But the real game changer has been the one in the middle, listed exchanges like the CME and Bakkt. They offer standardized contracts, and that makes everything more liquid and way easier to trade, especially for the big money players. And that right there, that standardization on those big listed exchanges, that's what blew the floodgates wide open for institutional investors. I mean, this was a massive, massive turning point for the whole market. See, before these exchanges, the big players had to use what's called the over-the-counter, or OTC market. And it was often described as being chunky and idiosyncratic. I love that phrase. It basically means the deals were slow, they were clunky, they were all one of a kind, and sometimes it was just hard to find anyone to take the other side of your bets. It was a mess. And then, bam, January 2020. The Chicago Mercantile Exchange, the CME, one of the absolute titans of traditional finance, steps onto the field. They launched their own regulated, standardized Bitcoin options. And that sent a signal to the entire financial world. Bitcoin derivatives are serious business now. The impact was, well, you can see it for yourself. It was immediate and it was dramatic. CME's competitor, Bakkt, had launched its own options the month before, but on day one, the very first day of trading, the volume on the CME just completely dwarfed all the volume Bakkt had done in its entire first month. The demand from institutions was obviously there, just waiting for the right product to show up. So we know the big institutions are here. They've arrived. But what are they actually doing with these things? Well, sure, there's always going to be some speculation, but the main reason they use options is much more about playing defense than offense. Yeah, think of futures and options as two sides of the same derivative coin. Futures contracts, those are often about pure speculation. It's like hitting the accelerator, trying to multiply your investment with leverage. Options, on the other hand, they're really more about risk management. Think of them as portfolio insurance. Their goal isn't always to hit a home run. It's to make sure you don't strike out. So who's doing all this hedging? Well, you've got these huge institutional funds that need to protect their massive crypto portfolios from a market crash. You've got Bitcoin miners who have to lock in a profitable price for the coins they're going to mine in the future, so they can pay their massive electricity bills. And you even have regular businesses that use Bitcoin and just need to know what their cash flow is going to look like. For all of them, options are an absolutely essential tool. This whole shift from just pure speculation to this really sophisticated risk management is a huge, huge deal. So let's take one last step back and really get our heads around what a healthy, growing options market means for Bitcoin itself. The ripple effects are just enormous. First off, it makes Bitcoin look even more legit in the eyes of those big conservative institutions. That, of course, brings more money into the whole ecosystem. It gives those crucial risk management tools to miners and businesses, which we just talked about. And hey, when this works for Bitcoin, it opens the door for options on other major cryptos, like Ethereum. But maybe the most important impact of all is on volatility. We can actually look at the foreign exchange markets for a clue here. When options were introduced there, studies found they had a calming effect on currencies that used to swing all over the place. Having the ability to hedge risk can literally make an entire asset class more stable. And that's the key. Options could finally help tame Bitcoin's legendary volatility. And believe it or not, the story doesn't end here. The next frontier is already being built as we speak. Fully decentralized options exchanges that run entirely on smart contracts. Just imagine that for a second, trading complex strategies directly on the blockchain with no central company in the middle. It is a wild glimpse into the future of finance. Which brings us to our final big question. For years, the #1 argument against Bitcoin becoming a real currency, a true medium of exchange, has been its volatility. So, if a healthy options market can bring more stability, more security, and more predictability to this ecosystem,
Could it finally help Bitcoin become more than just a speculative asset? Could it help it fulfill its original vision? That is the billion-dollar question that this maturing market is helping us answer.
You ever have that feeling? You know, after a string of losses, you just know you're finally due for a win? Or maybe you see a stock that's been dropping for days and you think, okay, it has to go up now. Well, that feeling, that gut instinct, it's a really common mental glitch. And when there's money on the line, it can be an incredibly expensive one.
So I've got to ask you directly, when it comes to your money, should you really be trusting your gut? Is your intuition a reliable guide in the super fast-paced world of trading and investing?
The short answer? Probably not. And look, it's not just you. It turns out human decision-making is, well, it's predictably irrational, especially when we're under pressure. This is all because of something called cognitive biases, a field that was basically pioneered by the Nobel-winning duo Daniel Kahneman and Amos Tversky. They showed us the specific, repeatable ways our brains consistently get things wrong. So let's dive into one of the most common and most costly of these biases. It's called the gambler's fallacy. And really, it's a glitch in our thinking that makes us see patterns in what is actually pure, unadulterated randomness.
Okay, so what is the gambler's fallacy? It's this mistaken belief that past events can somehow influence the next totally independent outcome. See, our brain absolutely craves balance. It's telling us that a streak has to end, that things are going to even out. But you know what? In the world of pure probability, that is a really dangerous assumption.
Let's use the classic example, a coin flip. Imagine you flip a coin and you get 4 heads in a row. What does your gut just scream is coming next? Tails, right? It just feels like tails is due. But here's the thing, the coin has no memory. The probability for that 5th flip is and always was exactly 50-50. It doesn't matter if it was 10 or even 100 heads before it.
Now, this isn't just some fun little thought experiment. In the world of trading, this exact thinking pattern, this illusion that we can predict what's next, can have some seriously devastating financial consequences. So let's see how this actually plays out in the real world.
Come on, be honest. Have you ever done any of these? You see a stock drop for 3 straight days and think, okay, it can't possibly go any lower. It's time to buy. Yep, that's the fallacy. Or maybe you've had an amazing week, a string of winning trades, and you start getting nervous. You start thinking, oh man, a loss is definitely coming, so you shrink your next trade. That's also the fallacy at work, making you doubt your own solid strategy just because of a random streak.
And this gets right to the heart of the issue. A good trading strategy has a certain probability of success, right? It's based on its own merits. That probability doesn't get better after a few losses, and it doesn't get worse after a few wins. Each trade you make is an independent event, just like that coin flip.
Still not convinced? I get it. Sometimes our intuition is so strong we need to see the cold, hard numbers to really believe it. So let's actually look at the math behind these streaks and see why our feelings about them are so often just wrong.
Okay, let's imagine you have a fantastic trading strategy. I mean, one that wins 70% of the time. That is a huge edge. So, with a strategy that good, how likely do you think it is that you'll get, I don't know, say 10 wins in a row? It should be pretty common, right?
You know, the math here is truly fascinating because of how quickly the odds just plummet. With that 70% win rate, your chance of winning the first trade is obviously 70%. But just look at the second bar on this chart. The chance of winning just 2 trades in a row drops to under 50%. It's actually more likely that you won't get 2 consecutive wins than that you will. Wild.
And the chance of getting that 10-win streak we were just talking about, it is less than 3%. I mean, let that sink in for a second. Even with a phenomenal strategy, a long winning streak is a massive statistical outlier. It is not the norm.
And hey, the same story holds true for losses. It doesn't matter if we're looking at the probability of winning streaks on the left or losing streaks on the right, the odds of a long streak are incredibly low. Randomness doesn't create a perfect back-and-forth pattern. What it means is that streaks can happen, sure, but they are statistical blips. They're not signs of what's to come.
So the big question is, how do we fight back against a glitch that's literally hardwired into our brains? Well, the good news is you can. It's not about trying to change your brain. It's about building a system that protects you from its worst instincts.
All right, 3 things. First, just accept that losses are part of the game. No strategy on Earth wins 100% of the time. Second, you have to use solid risk management. This makes sure that no single loss or even a small losing streak can wipe you out. And third, judge your strategy on its long-term performance, not some short-term streak.
Now, if you do hit more than 10 major losses in a row, that's not a sign you're due for a win. That's a sign you should probably reevaluate your entire strategy. So really, the crucial point is this. Assuming your strategy itself is sound, the outcome of your last trade or your last 50 trades has absolutely zero bearing on the probability of your next one. Your wins and losses, they just don't have a memory.
So the next time you feel that pull, that certainty that things are about to reverse, just ask yourself this question. Are you trading based on the proven mathematical edge of your strategy, or are you just betting on the outcome of the last coin flip? The answer could make all the difference. You know that feeling when you're trying a new trading strategy? A couple of quick wins and you think, this is it, I've cracked the code. Or maybe it's the other way around. A few losses and you toss it out thinking it's junk. That whole emotional roller coaster. It's exhausting, right? And honestly, it's how accounts get blown up. If any of that sounds familiar, it's because you've fallen for one of the biggest traps in trading, making huge decisions based on a tiny and frankly, completely unreliable amount of data.
Just think about it for a second. You try something new. Maybe it works once, maybe twice, or maybe it fails 3 times in a row, and you immediately jump to a conclusion, right? This is either a golden ticket or it's complete garbage. If you're nodding along, you are definitely not alone.
Well, that gut feeling, that snap judgment you make after just a few trades, it actually has a name. It's a cognitive bias, and it's called the law of small numbers fallacy. And let me tell you, it is one of the most common ways we trick ourselves into making really bad decisions.
So to really understand why this is such a big mistake, we need to compare it to the real statistical principle it's trying to be. Let's break down the difference between what's real and what's just a dangerous illusion.
Okay, so this is the real deal. This is a cornerstone of probability theory, the law of large numbers. It's basically a promise from the universe of statistics. It says if you do something enough times, whether it's rolling a die, flipping a coin, or, making a trade, the average result will get closer and closer to the true long-term average. The key word here, of course, is large.
Now this slide is where you can really see the trap. On the left, you've got the solid, dependable law of large numbers. It works with big samples and gives you accurate information. But on the right, you have its evil twin, the law of small numbers fallacy. Our brains just love to take the logic that works for big samples and apply it to small ones. But all that gives you is chaos, just random, misleading information.
And this graph just illustrates the point perfectly. Look at that chaotic red zone on the left. With just a few dice rolls, the average is all over the place. It's shooting up, it's crashing down, it's completely unpredictable. But as you do it more and more, look at how that green line just settles down. It stabilizes and gets right next to the true average. That chaotic red zone, that's exactly where you're living with just a handful of trades.
This quote just nails it, doesn't it? I mean, it sounds completely absurd when you put it that way, but that is exactly what a trader is doing when they judge a whole strategy based on 2 or 3 trades. You're just confusing random luck with actual performance.
So how do we get out of this trap? How do we escape that chaotic red zone and get over to the nice, stable green zone? Well, lucky for us, there's a simple, actionable rule that can be your antidote.
So, what's the magic number? Okay, there's no magic number, but there is a disciplined starting point, 20. 20 trades. It's considered the absolute minimum to gather enough data to even begin to make an informed decision about a strategy. It's not a guarantee of anything, but it's a huge step toward making a decision based on evidence, not just raw emotion.
But here's the thing, just making 20 trades isn't enough. You need a process. You need a playbook to make sure the data you're collecting is actually worth something. So let's look at how to build a reliable system for testing your ideas.
Okay, let's walk through this playbook, because every single step here is vital. First, reduce your risk. You have to be okay with losing on all 20 of these trades. This is non-negotiable. It takes the fear out of it so you can actually focus. Second, and this is a big mindset shift, your goal is not to make a profit. Your goal is to gather data. You're a scientist for these 20 trades, not a speculator. Third, be a robot. Create clear, black and white rules for your entries, exits, and risk, and then follow them to the letter. No gut feelings allowed. Fourth, keep a crazy detailed journal. Track everything. And only then, after those 20 trades and all that disciplined work, do you finally earn the right to sit back and evaluate the strategy.
You know, at the end of the day, this isn't just about a rule. It's about a complete shift in your mindset. It's about moving away from emotional, dramatic reactions and moving toward disciplined, data-driven analysis.
It's about choosing data over drama.
So to wrap this all up, what are the big takeaways here? First, small samples are liars. Just don't judge a strategy on a few trades, period. Second, you can't test a strategy if you don't actually have one. You need clear mechanical rules, otherwise you're just clicking buttons. And finally, you have to learn to trust the data you work so hard to collect, not the emotional high from a winning streak or the low from a losing one. So next time you're tempted to make a snap judgment, just remember that 20 trade test. It's your way out of the law of small numbers trap.
And I'll leave you with this one question. This fallacy doesn't just live in the trading world. Think about it. Where else in your life, in your career, your health, maybe even your relationships, are you making massive judgments based on just one or two little pieces of information? It's a pretty powerful question to think about.
All right, let's talk about a battle that every single trader faces. And nope, it's not about picking the right chart or catching the latest news. It's the fight that's happening inside your own head. Today, we're going to pull back the curtain on two sneaky mental blind spots that could be costing you real money. So let me just ask you this straight up. Is it possible your own brain, the one thing you count on to make smart decisions, is actually sabotaging your trades? It's a pretty wild thought, right? But stick with me, because by the end of this, you'll see exactly how it happens and, more importantly, what to do about it. Okay, let's get right into it with our first major blind spot. This one is a mental trap that is so common. I'm telling you, almost everyone falls for it without even knowing. It's called the confirmation bias. What's crazy is that this is just how our brains are wired. We all want to be right, you know? So once you make a decision like opening a new trade, your brain's first instinct is to go looking for proof that you're a genius. Now, in your day-to-day life, that's usually harmless, but in trading, oh, it can be an absolute disaster. And this is how you get stuck in this really dangerous loop. It starts the second you hit buy. Your next move is to start scrolling, right? Looking through social media or forums, not for a balanced opinion, but specifically for those posts that scream, "Great call, you nailed it." You start to subconsciously ignore all the warning signs, all the indicators telling you to be careful, and that leads you to feel way too confident. And that's the real kicker here. That little rush you get, that feeling of, "I knew it," when you find someone who agrees with you, that's not validation. It's an illusion. And it's a very expensive one, because it's the very thing that blinds you to the flashing red lights screaming at you to get out of a bad trade. All right, on to our second blind spot. Now, this one's a little more subtle, but trust me, it's just as dangerous. This bias completely messes with our idea of what success in the market even looks like. We're talking about survivorship bias. You know, Wikipedia really nails the definition here. And the key phrase, the part you really got to focus on, is lack of visibility. We only ever hear about the winners, the stocks that went to the moon, the funds that are still around today. But what about all the failures? Well, they just vanish. And that paints a super misleading picture of how things really work. Just think of it like an iceberg. What you see above the water is all the stuff that's easy to find when you're doing research. The big successful companies, the famous investment funds. But what you don't see is the giant hidden part of the iceberg underwater. That's the massive graveyard of companies that went bust and funds that did so badly they just got shut down and disappeared. And here's the dangerous idea that gets planted in our heads because of this. Since we're only seeing the survivors, it starts to look like picking a winner is easy. It feels like most things just go up eventually if you wait long enough. But that is absolutely not the reality. So, what are the actual odds? Well, a really eye-opening study from Vanguard looked at a whole bunch of large-cap funds way back in 1997. They tracked them until 2011 and found that an investor had only a 22% chance, just 22, of picking a fund that would both survive that whole time and beat the market. This chart just puts it all into perspective, doesn't it? A massive 78% of those funds either flat out disappeared or they underperformed. That's almost 4 out of every 5. That's the huge hidden story that survivorship bias keeps from us, and it's something you absolutely have to know as an investor. Okay, so I know that all sounds a little doom and gloom, but here's the good news. Once you know these enemies exist, once you can name them, you can actually build a defense against them. It's all about creating a system that saves you from your own worst instincts. So how do you actually do that? Well, it boils down to taking your gut feelings out of the driver's seat. First, you have to create a rock-solid trading plan before you even think about placing a trade. Write it down. What are your exact entry signals? What's your profit target? And most important of all, what is your non-negotiable exit point if the trade goes south? That plan is your new boss, not your feelings. Second, you have to start treating social media like a minefield. It's designed to be an echo chamber, which is the perfect breeding ground for these biases. If you're only following accounts that post their wins, you're getting a fire hose of survivorship bias. Your trading plan is your guide, not what's popular online. And that pretty much wraps it up. We've just exposed two really powerful psychological traps that are out to get you. So I'll leave you with this to think about. Knowing what you know now, what is the very first immediate change you're going to make to your own trading process to protect yourself from these blind spots? We all like to think we're smart with our money, right? That we're making rational choices. But what if I told you your brain is, well, kind of buggy? It's got these hidden glitches, these cognitive biases that can totally warp how you see things, especially when it comes to your finances. And trust me, these bugs can get expensive. So let's just get right to it with a kind of provocative question. Is your brain actually hardwired to lose money? No, of course not. That's a bit dramatic. But it is hardwired to take shortcuts. And when you're dealing with investing in finance, those shortcuts, they can be a one-way ticket to trouble. So today we're going to pull back the curtain on the mental traps that are standing between you and making smarter decisions. So here's the game plan. We're going to tackle 5 of the biggest, most expensive mental mistakes out there. We've got the survivorship trap, the hindsight illusion, that old classic correlation isn't causation. Then we'll look at why we always seem to overreact to whatever's happening right now. And finally, we'll talk about a big mindset shift, focusing on your process, not just the outcome. Okay, first on the list, the survivorship trap. And this one is super sneaky. It's all about how we tend to make big conclusions by only looking at the winners, the success stories, the strategies that worked, while we completely, totally ignore all the failures. You've probably heard this saying before, and it just nails the idea of survivorship bias perfectly. In the world of money, just like in history, the stories of the people who failed, the ones who crashed and burned, they just vanish. And what we're left with is this super distorted, overly rosy picture of what it takes to win, simply because we're not seeing the whole story. Think about it like this. Let's say you want to be a successful entrepreneur, so you study a bunch of them, and you notice, hey, they all wake up at 5 a.m. But here's the thing, here's the trap. You're not looking at the thousands of other people who also woke up at 5 a.m. and whose businesses totally failed. You're only seeing the one shiny success story, not the giant graveyard of failures right next to it. So the question you've got to ask yourself is, what am I missing here? Is there an invisible filter that's hiding all the failures from me? All right, let's jump into our second mental trap. And be honest, we've all done this one. It's called the hindsight illusion. You know that feeling you get after something happens and you think to yourself, oh, I knew that was going to happen. Yeah, that. It makes things in the past seem way, way more predictable than they actually were at the time. The Nobel Prize winner Daniel Kahneman just puts it perfectly here. We have this really bad habit of judging how good a decision was based only on how it turned out. So if you make a really dumb decision but you get lucky, suddenly you look like a genius in hindsight. And on the flip side, if you make a solid, well-thought-out decision and it just doesn't work out, you beat yourself up. It's a huge, huge trap. And right here, this is the main problem. See, a good decision is all about the process. Did you have a sound strategy? Did you have a plan? A good outcome, though, that can just be pure dumb luck. And that's why hindsight bias is so dangerous. It messes with our heads and teaches us all the wrong lessons because we start confusing a lucky outcome with a smart decision. You know where you see this all the time? Looking at old stock charts. It's so deceptive. When you look back, every single peak and every valley looks crystal clear. You're like, duh, of course I should have sold right there. But in the moment, in real time, making that call is, well, it's a million times harder. So if you're looking at a chart and a past move seems super obvious now, just remember, that's your hindsight bias talking. Okay, moving on. Next up is a true classic, a logical mistake that our brains, which are basically pattern-finding machines, fall for constantly. And that's confusing correlation with causation. Basically, just because two things happen at the same time or move together doesn't mean one is causing the other. Let's start with a really simple example of this, called reverse causation. Think about it. We see a lot of umbrellas when it's raining. Those two things are highly correlated. But does that mean umbrellas cause rain? No, of course not. It's the other way around.
Now, that seems totally obvious with umbrellas, but trust me, when you get into the messy, complex world of financial markets, it is so much easier to get that cause and effect totally backward. Another way we get tricked is by a hidden third variable. So you might notice that two different oil stocks are moving up and down in perfect sync, and you might think, oh, one must be affecting the other. But the real reason they're both moving together might be something else entirely, a third factor, like, say, the global price of oil, which is the actual driver. But this is where it gets really, really weird. Sometimes things are correlated for absolutely no logical reason. None at all. It's just a random statistical coincidence. And you got to hear this example. For more than a decade, there were two sets of data that had a crazy high correlation. Ready for it? It was the per capita consumption of chicken in the US and US crude oil imports. I mean, logically, there is no way those two things should have anything to do with each other, right? And yet, the correlation was nearly 90%. So, here's the big takeaway. The next time somebody tells you that A causes B just because they move together, you need to be super skeptical. Because finding a correlation, that's easy. Proving one thing actually causes another, that is a whole different ballgame. Okay, on to our fourth trap, and this one is all about our obsession with what's happening right now. Our brains are wired to give way too much importance to recent events, and on top of that, we feel this powerful need to cook up a simple story to explain why it's happening. Let's break this down. First, there's something called recency bias, and it's a really nasty cycle. When the market's been going up for a long time, we all get kind of lazy and forget that prices can actually go down. We take on way too much risk, then the market crashes. And all of a sudden, that fresh, recent fear is all we can think about. We get way too cautious, we think another crash is right around the corner, and we end up missing some of the best buying opportunities. It's like we're always fighting the last war. And right alongside that is attribution bias. This is our deep human need to have a reason for everything. We need a simple cause and effect story. And you know who loves this bias? The financial news. They're always ready with a neat, tidy explanation for why the market did what it did today. Even when the truth is, it was probably just random. You know, all those complicated stories and expert opinions you hear, they often cover up a very simple truth. You want to know why the market went up today? The simplest explanation is often the most accurate one. There were just more buyers than sellers. End of story. And that's a really powerful thing to remember. Be careful of the neat little stories people invent to explain what is essentially just noise. So, okay, we've gone through all these ways our own brains can trip us up. So, what do we do about it? Well, the solution isn't to try and be perfect. Nobody is. It's about making a huge shift in your mindset. It's about focusing on your process for making decisions, not just on the outcome, which is often random. Because look, you can't control luck, but you can control how you make your decisions, and that's where the power is. All right, let's do a super quick recap of these tricky mental shortcuts. We've got the survivorship trap, where we only look at the winners. Then there's hindsight bias, where we convince ourselves the past was totally obvious. We get fooled by the causation fallacy, mixing up correlation with a real cause. And of course, there's recency and attribution bias, where we overreact to what's happening now and make up stories to feel better about it. And that brings us to the most important question of all. Honestly, if you take one thing away from this whole explainer, I want it to be this. The next time you're looking at an investment or any financial choice you've made, just stop and ask yourself, am I evaluating my decision-making process here, or am I just reacting to the result? Because focusing on a solid, repeatable process, well, that's your absolute best defense against the sneaky little traps your own mind sets for you. Thanks for tuning in. All right, today we're going to talk about something that gets everybody. I'm talking about a powerful mental trap that trips up even the most seasoned traders. And really, anyone making a tough call. It's called the sunk cost fallacy. And trust me, learning to spot this thing, it can completely change the game for you. So let me ask you something and be honest. Have you ever been there, staring at a losing trade, watching those numbers just bleed red, and you're telling yourself, just a little longer, it's gotta turn around? You know, deep down, you should probably just cut your losses and get out, but something just won't let you pull the trigger. Look, if that sounds even a little bit familiar, you are so not alone. This isn't about you being a bad trader or not being smart enough. Nope. What you're dealing with is a classic cognitive bias. Think of it like a glitch in our human programming that really messes with our decisions, especially, you guessed it, when there's money on the line. Okay, so if we're going to fight this thing, we've got to know our enemy, right? So let's dive in and get a really clear definition of what this sunk cost trap is all about.
So here it is, plain and simple. The sunk cost fallacy is our tendency to keep doing something, whether it's holding a trade, staying on a project, you name it. Not because it's a good idea for the future, but because we've already poured so much time or money into it. It's like having an anchor tied to your ankle, dragging you down because of where you've been.
You know that little voice in your head, the one that whispers, "Man, I've already lost so much on this, I can't quit now." That's the fallacy talking. It's this emotional attachment to what we've already sacrificed that just completely clouds our vision for what we should do next. And let's be super clear here. This is not just some minor personality quirk. This thing is dangerous. Understanding this bias is absolutely critical because when it gets its hooks in you, it can be devastating, not just for your trading account, but for your sanity too. You know, you really can't overstate how powerful this bias is. This isn't some simple mistake you can just decide to stop making. It's hardwired into our psychology. Trying to just will your way out of it, it's not going to work. That's why we don't need willpower, we need a solid game plan. Okay, this slide just lays it out perfectly. Look at the difference here. On one side, you've got the sunk cost brain, totally trapped, thinking, "I've lost too much to sell, it's all about the past." But on the other side, that's the rational, profitable mindset. It completely ignores what's already happened and asks the only question that actually matters. Right here, right now, at this price, is this a good investment? And that leads us to what is pretty much the golden rule for beating this thing. Seriously, write this down. You have to forget what you paid for the asset. Forget how long you've been holding on. Just ask yourself one simple question. If my portfolio was all cash right now, would I buy this asset at its current price? If the answer is no, well then, you shouldn't be holding it. Full stop. It's such a powerful way to just slice right through all that emotional noise. All right, so we get the trap. We know how dangerous it is. The big question is, what do we do about it? How do we actually defend ourselves? Well, it's time to build our toolkit. But here's a quick reality check. Just knowing this bias exists, that's step one, and it's great, but it's not enough. Awareness alone isn't going to save you when the market's going crazy and the pressure is on. You absolutely need a plan, a system. And here it is, your 4-step plan. First step, and this is huge, create a trade plan. This means you know your exit points, where you'll take profit, and where you'll cut losses before you even enter the trade. Number 2, avoid time pressure. Do all your homework beforehand so you're not making it up as you go. Third, keep a trade journal. Seriously, write down your decisions. This helps you spot your own bad habits. And finally, number 4, actively monitor yourself. Pay attention to how you're feeling and thinking, especially when things get chaotic. I want to just double click on that trade plan for a second, because it is without a doubt your number one weapon against this bias. The whole point is to make your plan so crystal clear, so specific, that when it's time to act, you can do it almost mechanically, like a robot. You're not thinking, you're not feeling, you're just executing the logical rules that your calm, rational self already laid out. Okay, so those tools are awesome, but they're only as good as the person using them, right? They work best when you've also got the right mindset. So for our last section, let's talk about the mental game, the habits that make all these strategies actually stick. Think of these as your mental guardrails. First, when you feel that emotional pull, just step back. Try to look at the trade from a totally different perspective. And this is huge. Do not make important decisions when you're in a bad mood, or angry, or just totally unfocused. And yes, that definitely includes being tired. A lack of sleep can wreck your judgment just as much as a market crash. When it all comes down to it, this is the entire secret. You have to create a clean break in your mind between the past and the present. The money you invested, it's gone. It's a sunk cost. Your decision today has to be based only, and I mean only, on the potential for the future. The two things are completely separate. And so I want to leave you with this one last thought. Because let's be real, this goes way beyond trading, doesn't it? It's about that business project, that career path, maybe even a relationship. So the question for you today is this. What are you still holding on to just because of what you've already put into it? What sunk cost are you finally ready to cut loose?
Okay,
Let's be real. Have you ever found a trading strategy that looks absolutely perfect on paper, but then you go to use it and you still end up losing money? It is one of the most frustrating things, right? You put in all the work, you do the analysis, but the results, they just aren't there. Well, today we're going to dig into why that keeps happening. And here's a hint. It probably has less to do with your strategy than you think and everything to do with your mindset.
Yeah, the solution is all about psychology. And for the core ideas in this explainer, we're drawing from Mark Zuckerman's book, Trading for Beginners. He does a fantastic job breaking down the key mental shifts that really separate the pros from the amateurs.
All right, so the first big idea we really need to get our heads around is this kind of counterintuitive truth about trading, and it's that it works completely differently than almost anything else we do in our lives. And this really illustrates the problem perfectly, doesn't it? You know, in most jobs, there's a pretty clear link. You put in more effort, you get better results. Simple. But trading just completely breaks that rule. You can spend hours, days even, on analysis, do everything you think is right, and still lose money. It's maddening.
And that's what makes this so incredibly tough. I mean, trading forces you to stare uncertainty right in the face, constantly. Watching your own hard-earned money just fluctuate or even disappear right before your eyes, that's a huge emotional hit, and if you let those emotions start driving your decisions, well, they can just absolutely wreck your performance.
So if the whole work harder model is out the window, what's left? What does work? Well, this brings us to a really powerful shift in perspective. It's time to stop thinking like a player at the table and start thinking like the casino itself.
And this right here is the key. You are not a player trying to guess the next card or the next spin. No, you are the house. You're the one operating a system that you know has a statistical advantage over the long run.
Let's break down the difference. On one side, you've got the player. They're emotional, totally fixated on winning this one trade, basically running on hope. But the house is the complete opposite. It's mechanical, it thinks long-term, it couldn't care less about any single loss because it knows with total certainty that its statistical edge will make money over thousands and thousands of hands.
Okay, so how do we actually build this casino mindset? Well, it's all built on a foundation of 5 fundamental truths. And I mean it when I say, once you truly accept these, you will see the market in a completely new light.
So here they are real quick. Anything can happen, you don't need to know what's next, wins and losses are randomly distributed, an edge is just a probability, and every single moment is unique. These 5 ideas, together, create the mental frameworks you need to trade mechanically, without emotion, just like the house.
Let's start with truth number 1. Anything can happen. Seriously, the market is just millions of people all acting on their own beliefs, and because any one of them can affect the price, literally any outcome is possible, no matter how wild it seems. Accepting this is ground zero for managing your risk properly.
And that leads right into truth number 2. You don't need to know what's going to happen next. In fact, you can't know. It's impossible. But guess what? It doesn't even matter. Think about it. The casino has no idea if the next roulette spin is going to be red or black. Do they care? Not at all. They make money anyway because their edge plays out over hundreds of spins.
Okay, truth number 3 is a big one. Even with a winning strategy, the sequence of your wins and losses is totally random. You might have 5 losses in a row, then 10 wins. You can't know the order. Believing you can predict whether the next trade will be a winner, that's a classic gambler's mistake.
And this quote just hits the nail on the head. Think about this for a second. If you truly believe in a random distribution between wins and losses, could you really ever feel betrayed by the market? I mean, no, right? You'd stop taking losses personally. The market isn't out to get you. It's just a coin flip that didn't go your way. You don't get mad at the coin.
So we've been throwing this word edge around a lot. What does it actually mean? Well, it's not a crystal ball. It's not a guarantee. An edge is simply an indication that one thing is more likely to happen than another. That's it. A slight statistical advantage that plays out over time.
And the last truth, number 5, is that every single moment in the market is unique. It will never repeat itself perfectly. Why? Well, think about what it would take. As the book says, every single person would have to do the exact same thing again. With millions of traders out there, that's pretty much impossible.
Okay, so we get the mindset, we've got the 5 fundamental truths down. The big question now is, how do we put this into practice? How do we actually become the house? Well, the cool thing is, once you truly, deeply believe in these 5 truths, the right actions start to follow automatically. If you really accept that anything can happen on any trade, what are you going to do? You're going to define your risk before you even think about clicking buy. Your decisions become logical, not emotional.
And that naturally leads you to create a trading plan. And let me be clear, this is not optional. This is non-negotiable. Before every single trade, you have to define these things. Your max risk, your target reward, your entry, your exit, your position size, the whole shebang. Your plan should be so clear that you could hand it to a stranger and they could execute it for you without asking a single question. That's how you trade mechanically.
And maybe the single most important part of that entire plan is this number right here, 2%. You should never ever risk more than a tiny fraction of your capital on one trade. A good rule of thumb is 2%. Why? Because it ensures that one bad trade, or heck, even a whole string of bad trades, can't knock you out of the game.
And this brings us full circle, right back to our casino analogy. Ever wonder why casinos have betting limits on their tables? It's because they know they can lose any given hand. They can't let one super lucky high roller take them to the cleaners. Their edge only works over thousands of hands. And you're trading. It's the exact same principle. You have to trade small enough to survive the random losses so you can be there for the wins.
So I want to leave you with a question to really think about. The next time you're struggling, the next time your profits just aren't consistent, ask yourself this: is your strategy really failing, or is it your mindset? Are you just jumping from one system to the next, searching for some kind of holy grail, or is the real problem how you think about risk, about randomness, and about probability? Because more often than not, the key to winning isn't finding a better strategy, it's building a better mindset.
So if you're in the crypto world at all, you definitely know this feeling. The days when you had maybe 1 or 2 places to trade are long gone. Today, it's just a sea of options out there. And with all that choice, how do you really know if you're on the right platform for you?
You know, it's the #1 question everybody asks. As soon as the market starts taking off, your friends and family all come asking the same thing. Hey, what is the absolute best #1 crypto exchange I should use?
But here's the thing. That's actually the wrong question to be asking. The real question, the one that's going to get you a useful answer is, what's the best crypto exchange for me? I mean, think about it. We all want different things, right? There's just no such thing as a one-size-fits-all solution here.
So here's the plan. First, we're going to talk about why that one-size-fits-all idea is just not a thing here. Then, we're going to break down 4 totally different kinds of exchanges: Coinbase, the simple start; FTX, the trader's desk; Binance, the massive everything store; and Uniswap, the decentralized way. By the end of this, you'll have a much clearer picture of what works for you.
Okay, so let's get real. Are you a complete beginner who just wants the absolute simplest way to buy your first sliver of Bitcoin? Or are you, a seasoned trader who's looking for the lowest fees and the most complex trading tools? Or hey, maybe you're a purist, and the most important thing to you is holding your own crypto. Each of those paths leads to a completely different exchange.
All right, let's kick things off with the big one, the name pretty much everyone knows, Coinbase. Now for this, we're really focusing on their trading platform, Coinbase Pro, which I'm calling the simple start. It's the first stop for a lot of people, and for good reason. It's one of the oldest names in the game.
And make no mistake, these guys are a huge player. They were founded all the way back in 2013, which is like ancient history in crypto terms. And they've got 35 million users. That kind of scale brings a level of trust that's really appealing, especially if you're just getting started.
So who's this really for? Well, if you just want the absolute simplest way to get your US dollars or euros into crypto, Coinbase Pro is probably it. But, and this is a really big but, you are absolutely paying a premium for that simplicity. The trade-off is clear. You get convenience, but it's going to cost you. So let's break down those costs. Yeah, bank deposit is free, which is great, but the number you really need to look at is that trading fee. If your monthly trading volume is under 10 grand, you're paying 0.5%. That is one of the highest entry-level fees you'll find, period.
And look, the price you pay isn't just in fees. The source material for this explainer points out some big downsides. We're talking about notoriously slow customer support and, this is the killer, frequent outages right when the market is going crazy. Trust me, there's nothing more frustrating than getting locked out of your account when prices are flying up or down.
Okay, now let's do a complete 180. We're moving on to our next archetype, FTX, what I'm calling the trader's desk. This platform was built from the ground up for one type of person, the serious professional trader. But wait, before we go any further, there's a huge catch we have to get out of the way right now. If you live in the United States, I'm sorry, but this one's not for you. FTX is not available for US residents. And this right here, this shows you exactly why FTX is for the pros. We're talking perpetual futures, leveraged tokens, crypto indexes. I mean, these are super complex financial tools. They're incredibly powerful if you know what you're doing, but for a beginner, this is a definite do not touch zone. For a pro, though, it's a playground.
And you can bet the fees reflect who this is for. Taker fees start at a tiny 0.07%. Just think about that for a second. Compare that to Coinbase Pro's 0.5%. For anyone trading frequently, that difference is absolutely massive. It's one of the cheapest exchanges out there, full stop.
All right, next up we've got the 800-pound gorilla in the room, the biggest exchange on the planet, and it's not even close. Binance. Seriously, think of it as the Amazon of crypto. It's the everything store. See, Binance isn't just an exchange, it's this whole financial universe. You can earn interest, get loans, jump into new coin launches, even get a crypto debit card. I mean, the whole shebang. It's a true one-stop shop.
And yet, their fees? Super competitive. They start at just 0.1%. That's already 5 times cheaper than Coinbase Pro. And they have this cool trick. If you use their own coin, BNB, to pay the fees, they knock another 25% off.
So what's the catch? Well, the huge pro is the selection. I mean, if a coin exists, it's probably on Binance. But the big con, you gotta know their history. They had a major hack back in 2019. Now, to be fair, they made everyone whole, paid back every single affected user. But it's still part of the story.
Okay, hold on. Before we jump to our last exchange, we need to wrap our heads around a totally different idea. The decentralized exchange, or DEX for short. This is a game changer. Unlike the others, there's no company, no headquarters, no CEO. It's literally just code running on a blockchain, enabling peer-to-peer trading.
And that idea brings us right to our final contender, Uniswap. This is the decentralized way. It's a completely different animal, a whole different philosophy for trading.
And this is the absolute key takeaway. On Uniswap, you are always in control. It's non-custodial, which is just a fancy way of saying no company ever touches your crypto. They can't freeze it, they can't lose it in a hack. I mean, just go ask anyone who was on Mt. Gox back in the day how critical that is.
And if you're thinking, oh, that sounds kind of niche, think again. Check this out. It's kind of mind-blowing, but back in September 2020, Uniswap's trading volume actually blew past Coinbase's. Yeah. So the idea that DEXs are just for hardcore techies, that's old news.
All right, so we've covered 4 totally different approaches: the simple on-ramp, the pros trading desk, the everything store, and the new decentralized frontier. Let's put them all head-to-head so you can figure out which one is right for you.
Okay, let's nail this down. This table right here, this is your cheat sheet. Let's walk through it. Are you a total beginner who just wants to buy some crypto without a headache? Coinbase Pro is your best bet, but get ready for those fees. Are you a serious trader and you're not in the US? Man, FTX is your playground. The tools and low costs are just unbeatable. What if you're an altcoin hunter who wants access to everything? It's got to be Binance, no question. And finally, if you're a true believer in self-sovereignty, not your keys, not your coins, then you belong in the decentralized world of Uniswap. Just know there's a bit of a learning curve.
So you see, it all comes back to that first question, but now we know how to ask it correctly. It's all about what you value most. Is it the easy, hands-off experience you get with a centralized company? Or is it the absolute control and freedom that only a decentralized world can offer? So, the final question is for you. Centralized convenience or decentralized control? Which will you choose?
Okay, let's be honest. Is your crypto portfolio just a complete mess? A tangle of different exchanges, a bunch of wallets, maybe some altcoins you forgot you even bought? Well, you are definitely not alone. Today, we are going to cut through all that clutter. We're talking about 5 essential tools that'll turn that chaos into a streamlined, easy-to-track investment machine. Let's dive in. I mean, this quote just hits home, doesn't it? It's a feeling so many of us know all too well. You start out super enthusiastic, right? You open accounts on a few different exchanges, download some wallets, and then before you know it, you're just drowning in complexity. You have no clear idea of what you actually own or how it's all performing.
Yeah, I'm willing to bet it does. That feeling of opening one app to check a price, then jumping to another to see your holdings, and maybe a third to see if a transaction finally went through, it's just exhausting. You might even have some coins stashed away on an old paper wallet somewhere in a drawer. We've all been there. And that right there is what we call the crypto tracking problem. It's really the first major hurdle for anyone who's getting serious about investing. But here's the good news. The solution isn't some super complicated thing. It all starts with creating a single, clear view of all your assets, basically a command center for your entire crypto world. So let's start with that command center. The first tools in our toolkit are portfolio dashboards. You need to think of these as your home base, the one place you check every morning to get a complete, real-time snapshot of every single one of your investments.
First up, we've got Blockfolio. This app is an absolute game changer, and it solves that core problem of price tracking head on. Seriously, no more messy spreadsheets, no more pulling out the calculator, just a single, clean interface that tells you exactly how your portfolio is doing second by second. And Blockfolio is just packed with features designed to solve all those little headaches. You can connect your exchange account so it syncs automatically, or just add your coins manually in a couple of taps. Your portfolio value is always auto-refreshing, you get news right in the app, crucial project updates through a feature called Signals, and a market section for quick research. But honestly, my favorite feature has to be the price alerts. It'll ping you if there's a big move, so you're never caught completely off guard.
So who is this actually for? To be honest, Blockfolio is a must-have for pretty much anyone who's serious about crypto. It just simplifies everything. And here's the best part. It's completely free, so there's really no reason not to give it a shot.
Now, you've probably heard of its main competitor, Delta, which is another fantastic option, and functionally, the two apps are very, very similar. Historically, Blockfolio has usually been the first to roll out cool new features like Signals, and then Delta follows with something comparable a little later. But really, it all comes down to personal preference. My advice? Hey, they're both free. Download them both, play around, and see which one feels better to you.
Okay, so once you have a clear handle on your own portfolio, what's the next step? Well, the next level is to get an edge by learning from what other people are doing. And that's where social trading comes into play.
Let me introduce you to AltPocket. Now, while it does track your portfolio just like Blockfolio, its real superpower lies in its social features. AltPocket literally lets you pull back the curtain and see exactly what the most successful traders on the platform are buying and selling.
This is where AltPocket's value really, really shines. You can browse the top performing traders, click on their profiles, and see their exact holdings, down to the percentage. You can see all their recent trades, you can even follow them, and get a notification every time they make a move. It's like having a free, over-the-shoulder look into the strategies of the best in the game. So this tool is absolutely perfect for what I call the social learner. If you want to see how your performance stacks up, find brand new ideas, or just understand the logic behind a successful trade, AltPocket is a tool you really should have in your back pocket. All right, so we're tracking our portfolio and we're learning from others. Now, how do we find the next big thing? For that, we need to build ourselves a proper research desk. And this is Masari. Now, this is not a portfolio tracker. It's a powerful data aggregator. In crypto, knowledge is absolutely power, and Masari gives you that data-driven, almost detective-like approach you need to scout for those hidden gems before everyone else piles in.
Its real power is in its screener. You can filter thousands of coins by sector, market cap, and tons of other metrics. That real volume feature, for example, that's a lifesaver. It helps you avoid projects that look popular just because of fake wash-traded volume on shady exchanges, which is a classic trap for new investors. It also shows you all-time high and cycle low data, which is just invaluable for figuring out potential entry points. Just look at this example. Let's say you're on the hunt for the next big smart contract platform. Okay, so you can filter by that sector. Then you narrow it down to microcap projects, for that high reward potential. And then you filter again for projects with real volume to make sure there's actual trustworthy liquidity. And boom, in just a few clicks, you've gone from thousands of coins down to a manageable shortlist that's ready for some deep dive research. So we've tracked, we've learned, we've researched. But there's one final, crucial piece of the puzzle that way too many investors ignore, usually until it's way too late. And that's taxes. And for that, we have coin tracking. You got to think of this tool as the professional accountant for your portfolio. It's a true one-stop shop for deep analytics and, most importantly, tax reporting.
It imports data from almost everywhere you can think of. It supports over 7,000 coins. It can even watch your wallets for you and log new transactions automatically. The dashboard gives you the most comprehensive data you'll find anywhere, generating reports for realized and unrealized gains and calculating your average purchase price for every asset. Its main draw, though, the killer feature, is the do-it-yourself tax report generator. Now, let's be really clear here. This tool is not for everyone. If you're a beginner or you're just making a few trades a year, Blockfolio is probably all you need. But if you are a high-volume trader, someone who needs to submit detailed tax reports, then coin tracking becomes absolutely essential. So let's put this all together. You build your toolkit in stages. You start with your dashboard, Blockfolio or Delta, just to get organized. Then you add that social edge with AltPocket. Next, you build your research desk with Masari to find new opportunities. And finally, when you need it, you hire your accountant, coin tracking. It's a progressive system that lets you grow as an investor. You see, moving from crypto chaos to crypto control isn't about getting lucky. It's about having the right tools for the job. You now have the blueprint for building a toolkit that can help you make smarter, more confident decisions. So the only question left is, now that you have the map, which treasure are you going to hunt for first?
So, if you're just getting into trading, let me tell you something. Your biggest enemy? It's not the market. Nope. It's your own guesswork. So today we're going to build the one tool that separates real strategy from just gambling. And that is your very first trading plan. Let's get this blueprint drawn up.
You know, this quote right here, it just hits the nail on the head. This is the single most expensive mistake a new trader can make. Hopping into the market without a plan isn't just a little risky, it's like trying to find your way through a maze with the lights off.
And that really is the million-dollar question, isn't it? How do we flip that switch? Well, the answer is to build a simple, repeatable plan before you ever put a single dollar on the line. That's the map we're going to draw together today.
Seriously, imagine trying to drive clear across the country with no map, no GPS, nothing. That is exactly what trading without a plan feels like. It's just a long, frustrating journey full of wrong turns, emotional decisions, and yeah, usually some very costly mistakes. And at the very heart of this problem is just a lack of preparation. It's that simple. See, when you don't decide on your entry and exit points beforehand, you're leaving every single decision up to your emotions in the heat of the moment. And trust me, fear and greed are terrible, terrible co-pilots.
So, what's the cure for trading blind? It's your pre-trade checklist. Think of it like a pilot's checklist before takeoff. It's a straightforward process that just makes sure you've thought through every critical piece of the puzzle before you're up in the air.
And the core of your plan really just boils down to these 4 things. First, you check for any big events coming up. Then, you define your risk versus your potential reward. After that, you decide on a time frame. And finally, you plan out your exact entry and exit points. So, let's break each of these down.
Okay, now we're getting into the nitty-gritty. This is where we start building your actual blueprint. This is where you take a kind of fuzzy idea and turn it into a solid, actionable strategy.
First things first, always check the calendar. Are there any major events on the horizon? I'm talking about stuff like company earnings reports, dividend payments, things like that. These events can make a stock act, well, pretty unpredictably. Knowing about them ahead of time helps you avoid any nasty surprises.
Now, these are the 2 most important numbers you need to lock in before you trade. On one side, you have your maximum risk, your stop loss. This is the absolute most you're willing to lose. No exceptions. On the other side is your maximum reward, your profit target. This is your clear goal, and it's what prevents greed from turning a winning trade into a loser.
Now, once you have those 2 numbers, you can figure out a super important metric, the risk-to-reward ratio. Really, all it does is answer a simple question. Is the potential prize here actually worth the gamble I'm about to take?
And a really good rule of thumb, especially when you're starting out, is to aim for a risk-to-reward ratio that's better than 1 to 2. All that means is your potential profit should be at least double your potential loss. It's a simple way to help stack the odds in your favor over time.
Next up, you gotta ask yourself, how long am I planning to be in this thing? Are you a day trader, looking to be in and out before the market closes? Are you a swing trader, holding for a few days or maybe a few weeks? Or are you a long-term investor, looking at months, even years? Your time frame changes everything about your strategy. Okay, time to get specific. Your entry plan needs to spell out the price you'll buy at, your position size, and how you'll do it. Are you going all in at once, or are you going to average in? And just as important, your exit plan. What specific price or event is your trigger to get out? How are you going to close the position? You need to know this stuff cold. So having a plan on paper is one thing, but actually putting it into action, and more importantly, learning from it, that's where the real magic happens. And this is such a critical piece of psychology. The second your money is actually on the line, your brain chemistry literally changes. You're not a neutral observer anymore. So think of your plan as a contract you make with your calm, rational self to protect you from your future emotional self. That's why you have to make it beforehand, while you can still think clearly.
You know, this is why, especially for beginners, actually writing your trading plan down, like physically writing it, is such a powerful habit. It forces you to slow down, to think through every single detail. It's the ultimate defense against making those impulsive, gambling-like trades.
And hey, the learning doesn't stop just because the trade is over. After every single trade, win or lose, you need to do a little review. Asking these 3 simple questions helps you check your discipline, spot your emotional triggers, and most importantly, helps you keep refining your strategy for next time.
And the absolute best way to do this is with a trading journal. It's just a simple log where you track your plans, your actual trades, and what you learned from your review. This is how you really evaluate your performance with a clear head without letting your memory play tricks on you.
So as we wrap this up, I want to leave you with this one last thought. The next time you get a trade idea, stop and ask yourself honestly, is this a real thought-out plan based on a solid checklist, or is it just a prayer? Believe me, the answer to that question will make all the difference in the world. All right, let's talk about the big one. What's the real secret that separates the handful of successful traders from, well, everybody else? Forget the hype, forget the magic formulas. Stick with me and we're going to break down the actual key to making it in the markets.
Let's just start with a number. A huge, kind of scary number actually, 90%. This single figure, this is the reason most people who give trading a shot end up walking away with nothing.
That's the reality. Around 90% of all traders lose their money. That leaves just a tiny fraction who are consistently profitable. This isn't just a random statistic to scare you, it's a massive reality check. And really understanding why this happens, that's the absolute first step to making sure you land in that successful 10%.
So how do we get you into that 10% club? Here's our game plan for today. We're going to start by facing that 90% number head-on. Then, we'll compare the 2 very different paths a trader can take. We'll get into the whole education dilemma, map out a smart way for you to learn, and finally, we'll uncover that real secret to success.
Okay, Section 1, the 90% reality check. You know, to figure out how to win, we've got to start by understanding how most people lose. So, what does the journey of a losing trader actually look like?
I bet this path looks kind of familiar to some of you. It all starts with a dream, right? That fancy lifestyle, making easy money from a laptop on a beach. And that dream fuels a ton of motivation, but also a ton of greed. So what happens next? They watch a couple of random videos online, sign up for the first broker they see an ad for, and then they start buying stuff for completely random reasons. And the result is almost always the same, a quick, painful loss. And just like that, another person joins that 90% statistic.
All right, on to Section 2. We've seen the playbook for failure. So what about the path to success? What on earth are the winning 10% of traders doing that's so different?
And wow, when you put them side by side, the difference is just night and day. On one side, you've got the 90%. They're running on greed, making impulsive moves without any kind of plan, and basically treating the stock market like it's a lottery ticket. But then you look at the 10%. They have experience. They're disciplined and professional. They follow a trading system that's been tested. And here's the kicker. They actually know what they're doing. It's the difference between gambling and running a serious business.
Let me put it another way. Think about this. Would you ever try to perform heart surgery on someone without going to medical school? Without years and years of training and practice? No way, of course not. The results would be absolutely catastrophic. Or how about this one? Would you just hop into the cockpit of an airplane and try to fly with zero education or practice? The outcome is a guarantee. You are going to crash. In both cases, the answer is a hard no. So why do so many people think trading should be any different?
Because trading your hard-earned money is no different.
Trying to do it without the proper education is exactly like trying to fly that plane without any training. You will crash your account. It's not a question of if, it's just a question of when.
So this all boils down to one single key takeaway. You need education. That's it. It is the fundamental dividing line. It's the one thing that separates the winners from the losers before a single dollar even enters the game. It is the foundation for everything else.
Now, this brings us to a really important question in Section 3, the education dilemma. So if education is the key, the next question is obvious. What kind? Do you have to shell out a bunch of money for it, or can you learn everything you need for free?
Let's break it down, shall we? Paid education definitely has its pros. You're way more committed because you've got skin in the game. The courses are usually focused on one specific strategy, and you might even get some personal support. But the cons are real too. It costs money, obviously. There's a huge risk of scams out there, and sometimes the focus can be a little too narrow. On the other hand, free education is, well, free, so there's no financial risk to get started. But the downside is that it's often not as deep, and it requires a lot more work from you to find all the pieces and put them together yourself.
So what's the smartest way to move forward? Well, that brings us to Section 4, your smart learning path. The most effective route is actually a hybrid approach, one that gives you the best of both worlds.
I want you to think of this as your personal roadmap. Step 1, start for free. No excuses, master the absolute basics, things like different asset types, how to read a chart, and the fundamentals of risk management. Step 2 is a gut check. Ask yourself, am I still into this? And if so, what trading style actually fits your life, your capital, your schedule? Only then in Step 3 do you even start researching paid courses that match that style, and you have to look for proven track records. Step 4 is a huge warning. Beware of scams. Seriously, if it sounds too good to be true, it is. And then notice the final, most important step of all. Trading with real money is the very last thing you do, only after you have the education, a system, and a solid plan in place.
All right, we're at our final section. And honestly, this is the real heart of it all. Section 5, the real secret to success. Because it's about more than just knowledge. It's about adopting a completely professional mindset.
To build that professional mindset, you first have to know what to avoid. These are the landmines. Never, ever risk money before you are educated. Never blindly follow some random trade alerts you see online. Never base your decisions on just one or two little indicators. And please, for the love of everything, don't ever believe in some magic software that promises you'll never lose. These are the traps that keep people stuck in that 90%.
And this right here is the critical mindset shift you have to make. You must treat trading as your profession, not as a hobby. A profession requires study, practice, discipline, and constant improvement. A hobby is just something you do for fun. When your hard-earned money is on the line, trust me, this is not a game.
You see, when it all comes down to it, the so-called secret isn't some hidden trick at all. It's this. The secret to trading success is the same as the secret to success in general. It's hard work, experience, education, taking action, and practice. There just are no shortcuts, period.
And that leaves us with one final question, and this one is for you. Knowing that this path isn't easy, that it requires real dedication and a professional approach, are you ready to do the hard work that's required to join the 10%?
All right, today we're going to tackle one of the most powerful, but let's be honest, often misunderstood concepts in trading, implied volatility. Now, I know it can sound a little intimidating, but trust me, by the end of this, you'll see it as a serious tool for your trading toolkit.
I mean, just think about that for a second. What if you had a tool, not a crystal ball, but something that could show you the market's collective bet on how much a stock or crypto's price is about to swing? Well, that tool actually exists, and that's exactly what we're going to break down. So let's dive right in. We're going to pull back the curtain on the market's secret forecast. And that forecast has a name, implied volatility, or just IV for short. So what is it really? Well, at its core, implied volatility is simply the market's best guess about how wild the ride is going to be in the future. It's not just some random number, it's literally implied by the prices of options contracts. So whenever you hear traders talking about expecting big moves, what they're really saying is that the IV is high. Look, the absolute best way to think about this is like a weather forecast, but for the market. A high IV is like the Weather Channel warning of a hurricane. It doesn't mean the storm is guaranteed to hit, but it tells you the conditions are ripe for some serious action. A low IV? That's your forecast for a calm, sunny day. Okay, this is super important. You have to know the difference between implied volatility and its cousin, historical volatility. See, historical volatility is like driving while only looking in the rearview mirror. It just tells you how bumpy the road has been. Implied volatility, though, is all about looking forward, through the windshield. It's the market's prediction of what's coming, and it's what makes options cheap or expensive. Okay, so we've got the what, but who cares, right? The real question is, how do you use it? Well, this is where it gets really fun and practical. We can actually use IV to map out an expected price range for pretty much any asset. To do that, we start with this thing called a normal distribution. You probably know it as a bell curve. Basically, the idea is that small, boring price moves right in the middle happen all the time, but those huge, dramatic price swings way out on the edges are pretty rare. See that big bulge in the middle? That's called one standard deviation, and the market expects about 68% of all price action to happen right inside that zone. Whoa, okay, I know what you're thinking, a scary formula, right? But hang on, don't let your eyes glaze over. You don't have to memorize this. The only thing you need to know is that this formula combines the price, the IV, and time to give us a probable range. Let's make this real with an example. So let's make this real. Imagine an asset is trading at a nice, round $100. Its implied volatility is sitting at 40%, and we're looking 30 days into the future. You plug those numbers in, and boom! That formula spits out a one standard deviation range of 88.50 to 111.50. What this tells us is that the market believes there's a 68% chance the price will land somewhere inside this range over the next 30 days. It's kind of like the market's cone of probability. Okay, that's cool, but what if we just change one little thing? We'll keep the price at $100 and the IV at 40%, but now we're going to look 60 days out instead of 30. So what do you think is going to happen to that range? Does it get bigger or smaller? Yep, you guessed it. The range gets wider. With twice the time to move around, the market now expects a range somewhere between $84 and $116. And this brings us to a really simple, but honestly a powerful rule of thumb. More time gives the price more room to roam. It just makes sense, right? The longer the clock is ticking, the more chances there are for something crazy to happen and push the price around. Okay, so you're feeling good, right? You can calculate a price range. But here's the trap. This is where a lot of people get tripped up. Just looking at that raw IV number by itself is not enough. A number without context can be totally misleading. So let me ask you this. You've got asset XYZ with an IV of 40% and asset ABC with an IV of 30%. Now, your gut reaction is probably to say XYZ is way more volatile, right? I mean, 40 is bigger than 30. But is it really that simple? And the answer is, we actually have no idea. Not yet, because what if asset XYZ is normally a wild child and its average IV is usually 70%? Well, then 40% is actually really calm for it. And what if asset ABC is usually super quiet with an average IV of only 20%? Suddenly, 30% is extremely high for that asset. See? We need context. And this is where our hero comes in to save the day. It's a brilliant little tool designed to solve this exact problem, and it's called Implied Volatility Rank, or IV rank for short. And yep, there's a formula for it. It just looks at where the current IV is compared to its high and low over the past year. But again, and this is the best part, you can totally ignore this. Your trading platform does all the heavy lifting for you. What it spits out is this super simple score from 0 to 100. And this is all you need to know. If the IV rank is near 0, volatility is scraping the bottom of its yearly range, and options are relatively cheap. If the rank is near 100, volatility is at a yearly high, and options are relatively expensive. And 50? Well, that's just perfectly average for that stock. So that's the magic of IV rank. It instantly gives you that context we were missing. It answers one simple question. Is the current volatility high or low for this specific asset, based on how it's behaved for the last year? All right, let's bring this all home. How do you actually use this stuff in a practical way? Let's put it all together into a framework you can start using today. It's a really simple 3-step check you can do. First, you check the IV rank. That's going to tell you right away if options are on sale or if they're overpriced. Step 2, you use the raw IV number to get a handle on that expected price range. And step 3, you put those two pieces of info together to decide if your trade idea actually makes sense in the current market. And I want to say this one more time. you don't have to be a math whiz. The trading platforms do all the number crunching for you. Your job, the real skill here, is interpretation. It's about looking at these numbers and understanding the story they're telling you about what the market expects to happen. So you're not just looking at prices anymore. You're looking at forecasts. You now have the tools to see what the market is thinking. So the real question is, with this new perspective, what opportunities are you going to spot that everyone else might be missing? All right, let's talk about setting up a trade order. It seems so simple, doesn't it? You just click a button and you're in the game. But what if I told you that single click is where most new traders lose before they even start? Seriously, getting this right is the foundation of smart trading. So let's break it down. I'm not exaggerating here. Something like 90% of beginner traders make the exact same, really costly mistake. It's this quiet little error that just eats away at your profits on every single trade. And over the long run, the damage can be huge. So the big question is, could you be one of them? Let's find out, because I promise you, getting a handle on this one thing could totally change your trading results for the better. Okay, so what is this critical error we're talking about? Well, it's falling into what I call the market order trap. It feels like the fastest, easiest way to get into a trade, but trust me, it's often the most expensive choice you can possibly make. So this really shows you the basic trade-off. A market order is all about speed. It gets you into the trade right now, no questions asked. A limit order, on the other hand, is all about control. It lets you name your price. And understanding this difference, well, it's everything. So when you place a market order, you're pretty much yelling at your broker, get me in this trade this second. I don't care what the price is, just get me in. You're absolutely guaranteed to get your order filled, but you have zero control over the price you actually get. And that's the trap, right there. In the world of trading, where prices move in a blink, the next available price can be way worse than what you were looking at just a second ago. You're basically trading price precision for a little hit of instant gratification, and that is almost always a losing deal. So how do we get out of this trap? Simple. We embrace the power of limit orders. And look, this isn't just a different order type. It's a totally different mindset. It's about you taking control back from the market. A limit order is you making a declaration. You're telling the market, hey, I'm happy to buy this thing, but I'm only doing it at my price. Or an even better one, you are setting the terms. Either the market meets your price or the trade just doesn't happen. You are in command. And this quote just captures the professional mindset perfectly. A bad entry price handicaps your trade from the very start. You got to remember, missing a trade costs you nothing at all, but taking a bad price, that can cost you a whole lot. It's all about discipline over impulse. Okay, so we're going to use limit orders. Awesome, but how do we find the right price? Well, it all starts with understanding a really fundamental concept, the bid-ask spread. Just think of it like a negotiation that's happening constantly. The bid is the highest price any buyer in the market is willing to pay right now. The ask is the lowest price any seller is willing to accept. That little gap between those two numbers, that's the spread, and that's where all the action happens. So here's your super simple 3-step process. Step 1, find the bid price. Step 2, find the ask price. Step 3, your starting point for your limit order should be right smack in the middle, what we call the mid price. It's basically the fairest value at that exact moment. And please, do not underestimate how powerful this one little habit is. That tiny little bit of $1 you save on every trade by not chasing the market, by aiming for that mid price, it really adds up. Over a year of active trading, we're talking about literally thousands of dollars back in your pocket. Okay, so now that you've totally mastered your entry, let's level up. The real pros, they automate their entire exit plan before they even get into a trade. This is how you start working smarter, not harder, and make your trading way more mechanical and way less emotional. This is how you can pre-program your whole trade. A good till canceled, or GTC order, just stays active until you say otherwise, which is great for a long-term profit target. A good till date is pretty similar, but it expires on a day you pick. But the real game changer here is the OCO, or one cancels other order. This thing lets you set both your profit target and your stop loss at the same time. The second one of them gets hit, the other one is automatically canceled. It is full automation for your trade. So the bottom line is this. By setting these orders up in advance, you take your emotions right out of the equation. Your plan is locked in. You stop reacting to every little wiggle in the market, and you just let your system do the work for you. Okay, so you're using a limit order, you're aiming for the mid-price, but what happens if you're not getting filled? It happens. So here are a few rapid-fire tips to boost your odds of the market coming to your price. First off, trade liquid securities. High volume means tons of buyers and sellers, which makes it easier to find a match. Second, try breaking your big order into smaller pieces. Third, target round numbers, like a stock price of $50 even. They're like magnets for orders. And finally, if you absolutely have to, you can nudge your price a tiny bit closer to the market, but only if it still fits your plan. All right, let's pull all of this together into a simple but really powerful ritual. A checklist you can run through before every single trade to make sure you're always executing like a pro. So before you ever click that buy or sell button again, just ask yourself these 4 questions. Number 1, do I have a clear plan? 2, am I using a limit order? 3, is my starting price at the midpoint? And 4, is this a liquid asset? If you can say yes to all 4, you are putting the odds way, way in your favor. And really, that's what this all comes down to. The way you place your order, it isn't just some small detail. It's a direct reflection of your entire trading philosophy. So ask yourself, is your process setting you up for failure, or is it a professional plan that's actually built to succeed? The choice is yours. So today, we're jumping into one of the biggest debates in all of finance. It's really a clash of 2 totally different ways of thinking, a divide that splits the investing world right down the middle. We're going to break down how each side tries to answer that one huge question. How do you figure out if a stock is a total bargain or, well, a bust? Let's get into fundamental versus technical analysis. You know, when you really get down to it, every single investment decision, doesn't matter if it's for $100 or $100 million, it all comes down to this one simple question. Is this thing I'm looking at cheap or is it expensive? And how you choose to answer that question says everything about which of these 2 major investing philosophies you belong to. Okay, and this is really the key difference, right? These 2 philosophies are coming at the exact same problem from completely opposite angles. Fundamental analysis is obsessed with the why. Why is this company actually worth something? What makes it tick? Technical analysis, on the other hand, couldn't care less about the why. It's all about the when. When is the perfect moment to buy or sell based on what the market is doing right now? Okay, let's dive into our first philosophy. I want you to picture a financial detective. They've got the magnifying glass out and they are completely ignoring all the day-to-day noise of the market. They're not staring at the stock price. No, they are investigating the business itself, piecing together all these little clues to figure out what's really going on with the company. So the core belief here is pretty straightforward. Sooner or later, a company's stock price has to catch up with its actual real-world health. The goal then is to become an expert on that business. You dig into its sales, its profits, its debt, who's running the show, all to calculate what it's truly worth, its intrinsic value. And if the market price is way below that value, boom, you've just found yourself a bargain. And this detective work, it really breaks down into 2 main types of clues. First, you've got the quantitative stuff, the hard numbers. We're talking revenue growth, profit margins, debt levels, you name it. But, and this is just as important, you also have the qualitative clues, the things you can't easily measure. How powerful is the brand? Is the CEO a true visionary? To really solve the case, you absolutely need both. All right, now let's completely switch gears and look at our second philosophy, which honestly couldn't be more different. The technical analyst pretty much ignores all that financial detective work. Instead, they focus on just one thing, the raw, unfiltered psychology of the market as told by a price chart. This quote, "This is the absolute heart of technical analysis. The core assumption is that all that fundamental stuff we just talked about, the earnings, the management drama, the big economic news, all of that is already baked into the price you see on the screen. So why dig through financial statements? All you have to do is read the chart." So for a technical analyst, the chart isn't just a tool, it's pretty much the entire universe. Think of it like a real-time map of the constant battle between fear and greed in the market. The idea is that human psychology is predictable, right? Fear, greed, panic, euphoria, those things don't really change. So the patterns we've seen in the past are probably going to repeat, giving you a clue about what might happen next. So what's in their toolkit? While they're looking at a few key things. They're watching the price action and trying to spot trends to see if the momentum is going up or down. They're looking for support and resistance levels. Those are key price points where buyers or sellers tend to jump in, creating these invisible floors and ceilings for the price. It's all about finding clues in the chart to predict the market's next move. Okay, so we've met our detective and our trend spotter. Now let's put them head to head and really get a feel for just how differently they see the world.
And wow, when you see it laid out like this, the differences are just crystal clear, aren't they? Just look at that key question. The fundamental analyst is obsessed with what to buy, trying to find a fantastic business to own for the long haul. The technical analyst, they're all about when to buy, looking for that perfect short-term entry point based on the market's mood. One is playing a slow, strategic game of chess, while the other is trying to catch and ride a wave. And this brings us to the really critical trade-off between the two. A fundamental analyst could be 100% right about a company being undervalued, but they have absolutely no idea when the rest of the market will finally see it and the price will move. It could be tomorrow or it could be years from now. And that is the exact problem that technical analysis is designed to solve. It's all about providing signals for timing, trying to pinpoint that perfect moment to make a move.
So, the big question, which camp is right? Who wins, the detective or the trend spotter? Well, here's the secret. You don't actually have to choose. The smartest people out there don't see this as an either-or fight. The truth is, in the real world, most people aren't just one or the other. They use a combination of both toolkits. I mean, even the most hardcore fundamental analyst is going to glance at a price chart, and even the purest technical trader is probably going to pay attention if a company announces bankruptcy, right? The two can, and very often do, work together beautifully.
Actually, it's probably better to think of it as a spectrum. On one far end, you've got the TA purist, who believes the chart tells you literally everything. On the complete opposite end, you have the Warren Buffett type, who is laser-focused on long-term value and nothing else. But right there in the middle, you have all these interesting blends, like the amatrader, who gets the best of both worlds. They use fundamental analysis to find what to buy, a great company, and then use technical analysis to decide when to buy it.
At the end of the day, there is no magic formula here. There's no one right answer. The real goal isn't to decide which philosophy is better, but to figure out which approach or which combination of tools actually clicks with your own goals, your time frame, and yeah, even your personality. So I'll leave you with this to think about. When you have to make a decision, who are you? Is your inner investor a detective, carefully sifting through the evidence to find the truth? Or are you more of a trend spotter, trying to read the mood of the crowd from a chart? Or maybe, just maybe, you're a little bit of both.
All right, let's talk about something that gets a lot of investors, especially new ones, totally confused: technical analysis. We're going to break it down and figure out why it actually works. And here's a little spoiler for you. It's not magic. So let's just dive right in. I mean, have you ever seen one of those stock charts, the ones with all the squiggly lines and weird indicators all over them, and just thought to yourself, really, these lines are going to predict the future? Look, if you've had that thought, you're in good company. It's a totally fair question, and it's exactly what we're going to tackle today.
Okay, so here's the game plan. We'll kick things off by asking if it's magic or science. Then we'll look at the two big ways investors think. After that, we'll get into the real secret sauce, crowd psychology. And yep, you heard that right. We're going to use a dancing guy to explain it all, connect that to a real chart, and hopefully by the end, you'll see things in a whole new light.
All right, first up, magic lines. Or is there some real science behind this? To get to the bottom of it, we got to start with the basics. And that means understanding the two main paths every investor can walk down.
So when it comes to figuring out where to put your money, you've really got two major schools of thought. Two totally different ways of looking at the same problem.
Okay, so on one hand, you've got fundamental analysis. This is the stuff that just makes sense to most of us, right? You're like a detective digging into a company's health, checking out its balance sheets, its earnings reports, how many users it's getting. The idea is simple. If the company is doing well, the stock price should go up. Easy enough. But then you've got technical analysis over on the other side, and it throws all that company stuff right out the window. Seriously, it only cares about two things: what the price did in the past and how many people were trading it. It's not about the company's health at all. It's all about the market's behavior.
But here's the crazy part. Even though these two approaches are like polar opposites, the end goal is exactly the same. It doesn't matter if you're buried in spreadsheets or staring at charts full of lines. At the end of the day, you're doing the same thing. You put money in, and you really, really hope to get more money out. That's it. That's the one thing that connects everybody.
So, if technical analysis isn't looking at how the company's doing, what on earth is it looking at? Well, this is where we get to the big secret, the real aha moment. It's not about numbers or spreadsheets. It's all about crowd psychology.
Okay, so that's the big question, isn't it? How can looking at past prices and trading volume possibly tell us anything about the future? It doesn't sound logical, right? But it starts to make sense once you realize what those squiggly lines are actually showing you.
And here's the answer. It's all about crowd psychology and the law of supply and demand. See, technical analysis isn't some magic crystal ball. It's more like a visual map of human emotion. Every tick up and down on a chart is a story about the constant battle between buyers and sellers, a battle fueled by pure human emotion, fear, greed, hope, you name it.
I know. Crowd psychology sounds a little vague, maybe a bit academic. So to make this idea super clear, we're going to use an analogy. It's simple, it's powerful, and honestly, it's pretty great. We're going to talk about a dancing guy.
You might have even seen this. There's this famous video by a guy named Derek Sivers, and it's called First Follower. It's basically just a video of this one dude dancing all by himself at a festival. It's framed as this lesson on leadership, but what's amazing is that it's also a perfect model for how a movement or a market trend gets started.
So here's how it goes down. First, you've got one guy, the lone innovator, just dancing his heart out. He looks kind of ridiculous, right? All by himself. But then the second person joins in. This is the first follower, and this person is everything. They're the one who turns the lone nut into a leader. Then a couple more people see what's happening and they join in. That's social proof. All of a sudden, it's not weird anymore, it's cool. And that's when you hit the tipping point. Suddenly, everyone else gets FOMO, fear of missing out, and the whole crowd just rushes the dance floor. It's a party.
Okay, fun story. A guy dances, a crowd forms. Great. But what does that have to do with trading? Well, this is the cool part. We're going to take that whole scene from the lone dancer to the full-on party and map it directly onto a stock chart. This is where it's all going to click.
Think about it. Who's the lone dancer on the chart? That's the first buyer, the person taking a risk when everyone else is on the sidelines. And that crucial first follower? That's your early adopters, the savvy traders who see something brewing and jump in, which makes other people take notice. And when the crowd rushes in, boom, that's a huge volume spike on your chart. It's undeniable. And what happens when the dance floor gets totally packed and there's no more room? In trading, that's called a resistance level. It's where the party starts to die down and people start cashing out.
So the key question is, how do you see the crowd on a chart? How do you measure their excitement? The answer is one word: volume. Volume tells you everything. It tells you if people are actually showing up to the party or just watching from the sidelines. It's the ultimate confirmation.
So let's say you see the price start to creep up, but the volume is super low. What's that telling you? It's just a whisper. It's our lone dancer and maybe his one friend. There's no real conviction there. The crowd isn't interested yet. It's not a real trend.
But what about this? The price makes a big move and the volume goes through the roof? Now that is a roar. That's the sound of the crowd stampeding onto the dance floor. That high volume is your proof that the move is legit, that there's real energy behind it. This is exactly what traders are looking for.
And this is a perfect way to understand two of the most basic terms in technical analysis: support and resistance. Forget the complicated definitions. Just think of the dance floor. Resistance? That's when the dance floor is full. The party's gotten too crowded, the price feels too high, and people start to leave. They start selling. And support is the exact opposite. It's a price that looks like a bargain, where people see an empty spot on the dance floor and are eager to jump in and start buying. They're not magic lines. They're just psychological levels where the crowd's mood tends to shift.
Okay, so once you start seeing the chart as a dance floor, you've got this whole new way of looking at the market. It kind of changes everything. Let's wrap this up by putting it all together.
So here's what it all boils down to. All those weird chart patterns you hear about, triangles, flags, whatever, they're not magic signals. They're just pictures of the crowd's behavior. They show you the story of that tug of war between the buyers and the sellers. And remember, volume is what confirms if that story is real. And the best part? Because this is all just human psychology in action, it doesn't matter if you're looking at a daily chart or a weekly one. People are people. Our reactions of fear and greed are pretty consistent.
So I want to leave you with a challenge. The next time you look at a chart, stop yourself from asking, what is the price going to do? Instead, ask a much better question. What is the crowd about to do?
If you can make that one little shift in how you see things, well, you've just unlocked the whole secret behind technical analysis.
All right, today we're going to talk about something that's honestly a game changer for reading charts. We're going to clear away all that clutter and focus on one of the most powerful yet simple concepts out there, support and resistance. So let's just dive right in.
You know that feeling, right? You open up a chart and it's just a mess. It's a sea of squiggly lines, indicators, and oscillators. It's so easy to get completely overwhelmed and just feel lost. Trust me, you're not alone.
But what if I told you that you could kind of push all those complex formulas aside? What if you could learn to read the story the market itself is trying to tell you? I'm talking about a story told by the raw actions of buyers and sellers. That right there is the real power behind support and resistance. You see, so many traders get hyper-focused on all those fancy indicators that they totally miss this fundamental piece of information. I mean, seriously, if you could only use one tool, just one, it shouldn't be any of those complicated ones. It should be support and resistance. Why? Because it literally shows you where the market itself has decided things are valuable.
And that's really the heart of it, isn't it? We're not plugging numbers into some fancy formula. We are simply listening to the market. Support and resistance levels are just the market showing us, plain as day, where buyers and sellers have drawn their lines in the sand.
Okay, so the absolute easiest way to get your head around this is with a really simple analogy. Just think of price ceilings and price floors. This little mental picture is going to help you see exactly what's going on when you look at a chart.
So first up, we've got resistance. Just picture a ceiling above the price. The price is going up, 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 and then bam, it hits this ceiling and just can't seem to break through. This is the spot where sellers are basically saying, whoa, that's too expensive. They jump in, take control, and start pushing the price right back down.
And on the flip side, you have support. This is our price floor. So as the price is dropping, it hits this floor. And this is the level where buyers look at it and go, hey, that's a good deal. They start buying, that buying pressure takes over, and it stops the drop in its tracks. A lot of the time, it'll even cause the price to bounce right back up.
Okay, theory is one thing, but seeing this stuff in action on a real chart is where it all clicks. So let's look at a real-world example. We're going to start with a long-term chart for oil and see if we can spot one of those price ceilings, that is, resistance.
All right, so have a look at this. This is a weekly chart of oil, meaning every single one of those candles is a full week of trading. Now, based on what we just talked about, where do you think sellers might step in? Where's the ceiling here? Just take a second and see if you can spot it.
Okay, did you spot it? If you were looking somewhere around that $55 level, you absolutely nailed it. Look how the price shot up, tried to break through, but couldn't. Then, a few weeks later, it tried again and again. The market couldn't be clearer here. It's telling us that sellers are dug in, defending that price.
And then, look what happens. The market gives it one more shot, tests that resistance, fails, and then sells off hard. For anyone who was watching that level, that failure was a massive, blinking sign that it was time to sell.
And here's something really cool. Notice how these levels seem to have a memory. We're talking months later, towards the end of the year, and what's happening? The price is climbing right back up to that exact same $55 ceiling. That makes it a super important area to keep an eye on, right?
Okay, so we've seen a ceiling. Now let's flip it around and go looking for a floor. This time we're going to pull up a daily chart of the euro versus the dollar and see if we can find a support level.
So here's the situation. The market's been on a really strong run-up, but now it's starting to pull back a bit. So the big question for a trader is, where is it going to stop falling? To figure that out, we need to look to the past. We're looking for a previous low point, a spot on the chart where buyers showed up in a big way. And there it is. That previous low is the key. You can see right there, the market dipped down to the 1.1650 level, and then boom, it rallied hard. So what do traders do? They mark that spot on their chart. The thinking is, hey, if the price gets back down there, the same buyers who thought it was a good deal before will probably think so again. So let's fast forward a couple of months. The price drops, and I mean it really drops, almost 400 points. And where does it go? Right back down to that exact level. And just look, the fall stops, dead in its tracks. It's like the market literally remembered that this floor was here. And it's not just that it stopped falling. Just a few days later, the market shoots up 200 points away from that support. That floor held strong. It did its job perfectly. And for anyone paying attention, that was a huge potential buying opportunity.
So you can see, right? This isn't just some abstract theory from a textbook. Support and resistance is a simple but incredibly powerful and really practical tool that you can literally start using today.
And you know what the best part is? It works on everything. I mean, it doesn't matter if you're trading stocks, currencies, crypto, commodities, whatever. And it doesn't matter what your time frame is either. Are you a long-term investor looking at weekly charts? Great. Are you a day trader staring at a 10-minute chart? Perfect. This principle applies across the board.
So, okay, why should you care about this? Well, it's because it helps you do 3 absolutely critical things. First, it lets you spot potential turning points. It's like having a map of where the next big battle between buyers and sellers is going to happen. Second, you can use these levels to plan your trades with way more precision. And third, and this might be the most important one, it helps you manage your risk, because you can set your stop losses just on the other side of these key levels.
So here's your action plan. It's super simple. Pull up any chart. I don't care which one. Now, look to the left and find the major peaks. Those are your potential ceilings, your resistance. Then look for the major valleys. Those are your potential floors, your support. Draw some lines. And then just watch. See what happens when the price gets back to those areas. That's it. That's how you start planning trades and managing your risk around what the market is actually doing.
Now, look, is it going to work perfectly every single time? Of course not. Nothing does. But what it does give you is a logical, obvious place to start looking for opportunities. So, I guess the only question left is, are you ready to finally clear all that junk off your charts, stop just guessing, and actually start listening to the story the market is telling you?
So, you're looking to get into trading, right? You've probably been bombarded with all these different strategies. But here's the big question. Which one is actually right for you? Well, in this explainer, we're going to break it all down. We're diving into how to pick a trading style that really fits who you are, your personality, your lifestyle, your whole mindset, so you can land on an approach that actually helps you hit your goals.
Okay, let's start with a really fundamental question. What's your trading personality? Seriously, this isn't just about staring at charts and crunching numbers. It's about getting to know yourself. I mean, your personal temperament. It might just be the single biggest factor in whether you succeed or not. Think about it. Are you a patient person? Are you decisive? Do you have tons of free time? Or are you squeezing this in between everything else? And this quote, it just nails it, doesn't it? The truth is, no two traders are alike, not even close. We all have different needs, different psychological wiring. So this idea that there's some magical one-size-fits-all approach to trading, it's just a myth. The real goal here is to find what clicks for you. All right, so let's start our little journey at one end of the spectrum, the long-term end. We're talking about a style called position trading. You can kind of think of this as the marathon runner's approach to the markets. It's all about the long game. So what exactly is a position player? Well, at their core, they're a trend follower. They're not getting bogged down in all the day-to-day noise of the market. Nope, their whole game is to spot a major trend, whether it's going up or down, that could last for months, maybe 3, 6, even 9 months, and just ride that wave for a really substantial profit. Now, this approach, it's a definite trade-off. On the one hand, the pros are pretty sweet. It's super low maintenance, you're not glued to your screen all day, and that usually means less stress. But, and this is a big but, the cons are significant. Good opportunities, they're pretty rare. And honestly, it can be psychologically brutal. You've got to have the stomach to sit through all the normal ups and downs of the market without panicking and getting shaken out of a good position. Plus, you have to be totally okay with taking a bunch of small losses while you wait for that one big winner to come along. So, what's in a position player's toolkit? What do they use? Well, they basically live on the daily chart. That's their main view. And then they'll zoom out to the weekly chart to get the bigger picture. They often keep it simple, relying on tools like long-term moving averages to see which way the trend is going. But really, the most important tool they have is their mindset. You have to be incredibly patient and just resilient. You have to accept that most of the trades you try are not going to be that big winner you're looking for. Okay, so if sitting around being patient for months doesn't exactly sound like your cup of tea, no worries. Let's move down the spectrum a bit and look for a happy medium. And that brings us to something called swing trading. People often call swing trading the happy medium for a good reason. It sits perfectly between that slow and steady marathon of position trading and the absolute frantic sprint of day trading. The whole goal here is to strike a nice balance between finding good opportunities and still having a life. So what's the goal with swing trading? Well, a swing trader is trying to catch these predictable patterns or swings in the market. They're not holding on for months at a time, but they're not jumping in and out in a matter of minutes either. A typical trade for them might last anywhere from a couple of days to maybe a few weeks. And what about their toolkit? A swing trader is probably looking at things like the 30-minute, 1-hour, or maybe even 4-hour charts to spot their entry points. They might use indicators like the RSI to see if things are overbought or oversold, but they're always keeping one eye on that daily chart to see the bigger trend. The real advantage here is that balance we talked about. You get way more trading opportunities than a position player, but you're not chained to your desk all day long. All right, enough with the middle ground. Let's just sprint all the way to the complete opposite end of the spectrum. Now we're entering the world of high-speed, high-intensity trading, and we're going to start with the day trader. I mean, the name pretty much says it all, right? A day trader opens and closes every single one of their positions within the same trading day. The golden rule is super simple. You never hold a position overnight. You might be in a trade for a couple of hours, or heck, it could be just a few minutes. So what's the biggest pro of day trading? Well, you completely eliminate overnight risk. You don't have to worry about some crazy news event happening while you're asleep that just wipes out your position. Plus, you get instant feedback on your trades and there are tons of opportunities. But the downside is massive. This style is incredibly high maintenance. It requires intense laser-like focus, and it can be so emotionally draining. But what if even day trading isn't fast enough for you? If you've got that need for speed, that urge to operate at maximum velocity, then you might be entering the world of the scalper. Think of it as a super specialized, high-octane version of a day trader. A scalper is, without a doubt, the sprinter of the trading world. They are constantly in and out of the market. They're just trying to snatch a few pips, those are the tiny little bits of profit, on minuscule price movements. Essentially, their entire game is just trying to beat the spread again and again and again. Now, let's be real about scalping. It is intense. It's the highest maintenance style there is, period. It demands an insane amount of time and focus. But here's the most important thing you need to know. Your risk management has to be on a razor-tight leash. This is where that psychological trap of revenge trading becomes so dangerous. See, if you're only making tiny little profits on each trade, you absolutely cannot afford to take one big loss trying to win back your money. One bad trade can literally wipe out a whole day's worth of hard work. Okay, so let's zoom out and put it all together. Let's look at this entire spectrum. On one end, you've got the position player. Low maintenance, but you need the patience of a saint. On the complete other end, you've got the scalper. Super high maintenance requiring absolute hyper-focus. And then right in the middle, you have the swing and day traders. And they each offer their own unique balance of time commitment and psychological stress. So we've basically laid out the whole map for you, right? We've gone from the slow-moving continents of position trading all the way to the lightning-fast islands of scalping. So now the big question is, how do you find your spot on this map? Finding your style really comes down to a simple 3-step process. Step 1, you've got to look in the mirror. Be honest with yourself. What's your personality really like? How much time can you realistically commit to this? Step 2, take that personal profile and see how it matches up with the demands of the styles we just talked about. And finally, step 3, don't be afraid to experiment. Try out different approaches, in a low-risk way, just to see what feels right, what you're most comfortable with. And that really brings us to the final question, doesn't it? Now that you've seen the whole spectrum, the different demands, the pros and cons of each style, just take a second to think about it. Where do you see yourself fitting in? Are you that patient, long-term trend follower? The balanced opportunist? The focused day trader? Or maybe even that decisive, fast-moving scalper? Figuring that out? Well, that's the very first step on your trading journey. All right, welcome. Today, we're going to tackle something that looks super complicated, but is actually an incredibly powerful tool for any trader, the Japanese candlestick chart. So when you first look at one of these, I get it. It can totally look like some kind of secret code, right? Just a bunch of red and green blocks all over the place. But here's the deal. By the time we're done here, you're going to be able to read this like a story. And I mean it. Every single candle, every pattern, it's telling you a story about what's going on with the price. So, you ready to crack the code? Awesome. Let's get into it. Okay, first things first. To read the chart, you gotta learn the language. And the basic building block of that language is the candle itself. Think of each one as a snapshot, a little story of what happened over a specific time period.
It's actually amazing how much information they pack into this one simple shape. See, every single candle shows you 4 key things: where the price opened, where it closed, the highest point it reached, and the lowest point it hit. Now that thick part, that's the body. It shows you the range between the open and close. And those thin lines, they're called shadows or wicks, and they show the absolute high and low. It's simple, really. If the candle is green, the price closed higher than it opened. The buyers, or bulls, won that round. If it's red, it closed lower. The sellers, or bears, took control.
Okay, now that we can read a single candle, this is where the fun begins. We can start spotting patterns. Let's start with the bullish ones. These are the combinations that might signal a price is about to swing upwards. You can think of them as potential buy signals.
First up, we have a total classic, the bullish engulfing pattern. I mean, the name pretty much says it all, right? You've got this big green candle that just completely swallows or engulfs the little red one that came before it.
So, what's the story here? Well, it's a story about a massive power shift. The sellers were in charge. You see that with the red candle. But then, bam! The buyers didn't just show up, they stormed in. With so much force, they completely wiped out the previous losses and then some. This is a huge signal that momentum could be shifting from selling to buying. All right, next up is the hammer. And you can probably see exactly how it got its name. This little guy has a really distinctive pattern that you often see popping up at the bottom of a downtrend. This candle tells a very specific story of a battle. During this period, the sellers pushed the price way, way down. That's what creates that long, lower shadow. But then the buyers fought back hard, pushing the price all the way back up to close near where it started. It's a sign that the sellers are getting tired and the downward trend might be running out of gas. Now for a really powerful one, this is a 3-candle pattern called the Morning Doji Star. Because it plays out over 3 candles, a lot of traders see this as a really strong confirmation that a downtrend might be over. Let's break down this little 3-act play. Act 1, a big red candle shows the downtrend is still going strong. Act 2, a doji appears. This signals indecision, the selling has stalled out. And then Act 3, a powerful green candle shows up, confirming the buyers have taken control. It's kind of like the sun rising after a dark night, a really strong signal that things might be turning around. Okay, so we've seen the signals for when you might want to buy. Now, let's flip the script. Let's look at the bearish patterns, the ones that can act as a heads up or potential sell signals. Hey, this should look pretty familiar. The bearish engulfing is literally the mirror image of the bullish one. After the price has been going up, a huge red candle comes along and completely swallows the green one before it. And just like its counterpart, this pattern tells a story of a dramatic power shift. The buyers were cruising along, pushing the price up, but then the sellers came in with overwhelming force, not only erasing the gains, but driving the price down even further. It's a really clear warning sign that the uptrend could be over. Now listen up, because this is where context is everything. This pattern, the hanging man, looks exactly like the hammer we saw earlier, but its meaning is completely different, all because of where it shows up on the chart. So why is the same shape now a sell signal? Because it happens after the price has been rising. That long lower shadow tells you that, at some point, a big sell-off happened. Even though the buyers managed to push the price back up by the end, that sell-off is a huge red flag. It shows that cracks are starting to appear in the buyer's confidence. And our last major bearish pattern for today is the shooting star. Just think of it like an upside-down hammer that appears at the top of an uptrend. Here's the story this one tells. The buyers tried, they really tried to push the price even higher. That's what that long upper shadow represents. But they failed. Sellers stepped in and smacked the price right back down to close near where it opened. It's a classic sign of rejection at a higher price level. You know, it's not always about these huge, dramatic reversals. Sometimes the charts are just telling us that the market is, well, taking a breath. So let's look at patterns that signal indecision or even confirm that a trend is probably just going to keep on going. And for that, you need to meet the doji. This is one of the most important single candles you can recognize. It basically represents a perfect tie, a stalemate between the buyers and sellers. The key to the doji is that tiny, almost invisible body. It means the opening price and the closing price were pretty much identical. It was a tug of war and nobody won. Now, on its own, a doji is neutral, but like we saw with the Morning Doji Star, when it's part of a bigger pattern, it becomes incredibly powerful. So, to kind of bring this all together, traders are basically looking for the answers to two big questions. The first one is this trend about to end? That's where you look for those reversal patterns, like the engulfing or the hammer. The second question is this trend still going strong? That's when you look for continuation patterns. Understanding both is absolutely key to reading the market's full story. And this brings us to what is maybe the single most important rule of all. Ready? No candlestick pattern is a magic bullet. They're an amazing tool for reading market psychology, for sure, but they should always be used with other forms of analysis, things like volume or key support and resistance levels, to confirm what you think you're seeing. So there you have it. You've learned the basic language of candlesticks, from the anatomy of a single candle to the complex stories that patterns can tell. You've cracked the code. These charts aren't a secret anymore. So the only real question left is, now that you can read them, what stories are they going to tell you?
Ever look at a stock chart and just your eyes glaze over? Feels like you're trying to read some kind of secret code, right? Well, today, we're going to crack that code. We're going to show you how to read a financial chart, and we'll do it in just about 5 minutes. Let's get into it.
Yeah, I mean, look at this thing. At first glance, it's a lot. It's just a crazy jumble of lines and colors and shapes. And if you're looking at this and thinking, what on earth am I even seeing? Trust me, you are not alone. It can look like total chaos.
But here's the thing. What if I told you that this isn't chaos? Not at all. It's actually a language. It's telling a story. And get this, the really wild part is that this language is over 400 years old. So that's our goal today. We're going to learn the basic grammar of this language. We are going to decode this chart so you can finally start to see those stories that are just hiding in plain sight. And hey, just remember this. Every single expert trader out there, they all started right where you are now. They all looked at a chart and felt completely overwhelmed. So that feeling, that's actually the first step. It's totally normal.
Okay, so to really learn this language, we've got to go back in time, way back. We're about to uncover a 400-year-old secret. And it didn't come from Wall Street. Nope. It came from feudal Japan. Let's talk about where these things, these candlesticks, actually came from. So, picture this. It's the 1600s in Japan. Rice traders are the ones who came up with this. And the context here is just so cool. It was a samurai culture. So they didn't see trading as just numbers. They saw it as a battle, a war of strategy. Then this legendary trader, a guy named Homina, he mastered it and basically became known as the god of the market. And the craziest part, this technique didn't even hit the US until the 1970s. Pretty new to us in the West. So you have to ask, right? Why is this 400-year-old method still a thing in our world of AI and supercomputers? Well, the answer is simple. It charts the one thing that never, ever changes: human emotion. These little shapes you see on the screen, they're not just data. They are a literal picture of greed and fear, of panic and excitement, playing out in real time.
All right, history lesson over. Now let's get practical. Let's actually break down the anatomy of one single candlestick. Think of this as learning the ABCs of this new language.
When you boil it all down, there are really just two main characters in this story. You've got your green candle, the bullish one, that means the price went up, and then you've got your red candle, the bearish one. You guessed it, that means the price went down. It's a classic tale, the bull versus the bear. So let's see how they're built, because it's pretty simple. On a green, bullish candle, the price opens at the bottom of that thick part and closes at the top. Makes sense, right? It went up. For a red, bearish candle, it's the complete opposite. It opens at the top and closes at the bottom, because the price went down. The color is your instant shortcut to what happened. Now that thick colored part has a name. It's called the real body. And all it shows you is the main action, the distance the price traveled between the open and the close for whatever time period you're looking at. Could be a minute, an hour, a whole day. Doesn't matter.
And what about those thin little lines poking out from the top and bottom? Those are called wicks, or sometimes tails. They're super important. They show you the full range of the fight, the absolute highest price that was hit and the absolute lowest price during that time. They show you the crazy extremes of the battle.
Okay, so now we know the parts. This is where it gets really cool, because now we can basically start to read the market's mind. The shape of the candle, how big its body is, how long its wicks are. That tells you a whole story about the psychology of the traders in that moment.
Remember that battle metaphor? Well, this is it. Every single one of these candles is a snapshot of that battle. It's a tug-of-war between the bulls, the buyers trying to push the price up, and the bears, the sellers trying to drag it down. And the final shape of that candle, that's who won the fight.
So let's read one of these stories right now. Take a look at this candle here. See that long wick on the bottom? Here's what that's telling us. At some point, the sellers, the bears, they were in control. They pushed the price way down. But then, the buyers, the bulls, they stormed back in and fought like crazy, pushing the price all the way back up by the end. That's a huge sign of strength. You've probably heard the term buying the dip. This is what it looks like.
Okay, now let's flip it and look at the opposite story. See this one with the long wick on top? It's the reverse. Here, the buyers were winning at first. They pushed the price way up high, but they couldn't hold it. The sellers came in strong and knocked the price right back down. This is often a sign of profit-taking, and it can signal that the momentum is fading.
So what about when it's not a close fight? What does a total blowout look like? Well, a big, long green body with teeny tiny wicks. That tells you the buyers were in complete control, from the opening bell to the close. And, on the flip side, a long, solid red body with barely any wicks, that means the sellers just dominated the whole time. It's a total knockout punch.
All right, so if each candle is like a single sentence in a book, what happens when we zoom out? Let's put these sentences together and see how they create a whole chapter, a whole story.
So let's go all the way back to that first chart we saw, the one that looked so chaotic. Does it still look like just a bunch of noise to you? Or can you start to see it now? It's not chaos. It's a history book, recording thousands of tiny battles fought every single day between fear and greed, between buyers and sellers.
Look, we've just learned how to read a single page from this massive storybook. You now have the basic tool to start decoding it. So I'll leave you with this question. Now that you can read the story of a single day, what do you think you'll discover when you start reading the whole book?
Today, we're going to talk about something that is, no joke, one of the most important things you can learn as a trader. But for some reason, it's so often overlooked. We're talking about reading volume. Seriously. This is the missing piece that can turn a chart that looks like total chaos into a story that actually makes sense.
So, picture this. You're staring at a chart, right? The price is climbing, but is that a strong move? Is it for real? Or is it about to just fizzle out and reverse on you? If you're only looking at the price, it's almost impossible to know for sure. You're kind of just guessing.
And that's because price is really just one single piece of the puzzle. To see what's really going on, you have to look at volume. Volume is what gives you the context. It's the confirmation. It shows you the strength or the complete lack of strength behind every single move the price makes.
Okay, so let's get right into it. What exactly is volume? Well, the best way to think about it is as the proof. It's the evidence, the hard data that backs up whatever the price is doing. All it is, really, is the total number of shares that have been traded during a specific time frame. So if you're on a daily chart, each of those little volume bars at the bottom represents all the shares traded during that one day. If you're on a weekly chart, it's 1 week's worth. That's it. Super simple.
I really like calling volume the proof indicator. Think about it. You see a big, strong green candle pushing the price up. Awesome, right? But then you look down and see a huge green volume bar to match it. Now that's the proof. That's your confirmation that tons of traders are jumping in, and that move has some real power behind it.
Okay, now this is a big one. It's a detail that a lot of traders just completely miss, and it can change your whole perspective. See, not all volume is created equal. We need to talk about the huge difference between just share volume and what's way more important, dollar volume. Just look at this table. It makes it so clear. At first glance, you might think stock A is the hot stock, right? 1 million shares traded, wow! But it's a $1 stock, so that's only $1 million changing hands. Now look at stock B. It only traded half the shares, 500,000. But at $20 a share, that's $10 million of actual money being put to work, 10 times the financial commitment. Now which stock do you think the big institutions are more interested in?
And this is exactly why looking at the share number alone can be so misleading. Dollar volume is the great equalizer. It tells you the true financial weight, the real conviction behind a move. It lets you compare the interest in a penny stock versus, a $100 stock on an equal playing field. So all of this leads us right to a concept that is, quite literally, the lifeblood of the market: liquidity. And guess what? Volume is your #1 indicator for how much liquidity a stock has.
So why do we care so much about liquidity? Why do we chase it? Well, because that's where the opportunity is. It's like the difference between a deep flowing river and a tiny rocky stream.
High-volume stocks are that river. The price action is smoother, it's more predictable, and you can get in and out of your trades easily. That's where chart patterns actually work. But a low-volume, illiquid stock, that's the choppy stream. The price can suddenly jump or drop on you with one weird trade, making it super risky and unpredictable.
All right, let's get into the good stuff, the practical application. How do we actually use this on our charts? We're going to go through the key rules of thumb for decoding what those volume bars are trying to tell you.
First up, confirming an uptrend. This is simple but powerful. If the price is moving up and you see those green volume bars getting bigger and bigger with each push higher, that is a beautiful sign. It shows that more and more people are buying in with conviction. But if you see the price slowly drifting higher on volume that's drying up, ooh, that's a red flag. It's a sign of weakness, showing the bulls are running out of steam.
But what about pullbacks? Because no stock goes straight up, right? In a strong, healthy uptrend, you actually want to see the red days happen on light, decreasing volume. That shows the sellers aren't very aggressive. It's just a normal breather. But if you start seeing red days with increasing volume, that's a huge warning sign. It tells you the bears are waking up and starting to fight back with some real force.
And now for my favorite pattern, the breakout. Look at how this works. First, the price gets squeezed into a really tight range. And as it's doing that, look at the volume. It just dies down almost to nothing. It's like the market is holding its breath, building up all this potential energy. Then bam, the price breaks out. And what happens with it? You get a massive explosion of volume. That huge spike is your confirmation. It's the rocket fuel that tells you this move is the real deal.
All right, let's talk about our final signal. And trust me, this one is pretty dramatic. It's called a volume climax. And it's often the last gasp, the final power move before a major trend completely reverses.
It looks just like this, a gigantic, almost absurd spike in volume that just dwarfs everything that came before it. This isn't just a day with high volume. This is pure exhaustion. This is the moment when everyone who is late to the party panics and buys at the very top, or when every last seller gives up and panic sells at the absolute bottom.
So, when you see that kind of climax spike at the end of a long run-up or at the bottom of a brutal downtrend, it's often a sign that the trend is completely exhausted. All the buyers or sellers are finally in, and there's no one left. It's a massive signal that a reversal could be right around the corner.
And really, that just says it all, doesn't it? Price tells you what's happening. But volume tells you the story behind what's happening. It's the emotion, the conviction, the proof. If you had to throw away almost all of your indicators, volume is one you would absolutely want to keep.
So the next time you pull up a chart, please don't just look at the price. Glance down at those volume bars. Because now that you can see the whole puzzle, not just one piece, what new stories are your charts going to tell you?
Have you ever looked at a financial chart and just felt completely lost? It can look like this chaotic mess of lines and bars and colors. But what if I told you there's a simple tool that traders use to cut right through all that noise and see what's really going on? Well, that's where the moving average comes in. I mean, look at this. It's busy, right? You've got your price bars, you've got different lines, indicators down at the bottom. It's just a lot to process, especially if you're new to this. It's so easy to get lost in the details and totally miss the bigger story the chart is trying to tell you. But there is a way. There's a tool that's specifically designed to ignore all that day-to-day volatility, all those little jumpy price swings, and just reveal the big picture. It's a way to smooth everything out so you can see the true direction the market is trying to go. And yep, you guessed it, that tool is the moving average. Its entire job is to do exactly what we're talking about. Take a choppy, kind of confusing price chart and make it way clearer and easier to read. So what is it really? A moving average is just a line on your chart that shows the average price of something over a specific amount of time. Think of it like this. If the price is a bumpy, winding road, the moving average is like drawing a smooth, gentle curve that shows the general direction of that road. It just ignores every little pothole along the way. Now, moving averages come in two main flavors. You've got the simple moving average, the SMA, which is just the basic, straightforward average price. Then you have the exponential moving average, or EMA. It's a little more complex, and it gives more weight to the most recent prices. So what does that really mean for you? It means an EMA is going to react much faster to new price changes than a slow and steady SMA will. Okay, so this is where it gets really interesting. Moving averages do more than just show you the trend. They actually play this huge psychological role in the market. acting like moving floors and ceilings for the price. Let's dig into how that works. First, let's talk about support. When an asset's price is trading above a moving average, traders start to look at that line as a potential price floor. They expect that if the price drops down to that level, a bunch of buyers might jump in and push the price right back up. So it becomes a really key area to watch. And you guessed it, the exact opposite is true for resistance. If the price is trading below a moving average, that same line now acts like a price ceiling. Traders start to think that if the price rallies up to that line, sellers are going to step in and stop the move cold. Now here's the really wild part, the psychology of it. Why does this even work? Well, a big part of it is that it's a self-fulfilling prophecy. Because thousands, maybe millions, of traders and all their fancy algorithms are all looking at the exact same lines on their charts. They all anticipate these reactions, so they place their buy and sell orders right at these levels, which then causes the exact price reaction they were all expecting to happen. All right, enough theory. Theory is great, but let's make this real. We're going to look at an actual daily chart of the S&P 500 and see exactly how this plays out in the wild. Okay, so on this chart, see that gently rising line? That's the 20-day moving average. And just look at what happened. For almost 2 months straight, every single time the price dipped down to touch that line, it bounced. It acted like a perfect, consistent price floor, a really reliable support level. But here is a critical rule you have to know. See how in a few spots, that little thin line on the price bar, people call it a wick, actually dips below the moving average? Well, that doesn't count as a break. The most important thing, the only thing that matters, is where the price closes at the end of the day. If the main body of that price bar closes back above the line, then support is considered to have held. Simple as that. And this is the moment it all changed. Right here. After holding strong for 2 solid months, the price finally fell. And this is the crucial part. It closed the day below the 20-day moving average. That support that was so reliable, it was officially broken. The game had changed. And this brings us to one of the most powerful, fundamental ideas in all of technical analysis. That line that was a strong floor for 2 months, it's now flipped. Former support becomes the new resistance. So we've seen the price break a really important level. But how can we feel more confident that this isn't just a fluke, a temporary dip, but a real change in the market's mind? Well, that's where we bring in our final piece of the puzzle. In other words, how do we know if a move has real power, real conviction behind it? Is it a genuine breakout or just a fake out trying to trick us? There is one indicator that helps answer that question better than any other. And the answer is volume. The bars at the bottom of the chart tell the story. Look at the left side first. When the price broke out to the upside earlier in the trend, notice that huge spike in volume? That was the market screaming that the move was legit. Now, look to the right. When our support level finally broke down, boom, we saw another big increase in selling volume. High volume is like the market's stamp of approval. It tells you that a lot of people believe in the direction of the move.
So let's wrap this all up real quick. Number 1, moving averages smooth out all the price noise so we can see the real trend. 2, they act as these dynamic floors and ceilings, support and resistance, that pretty much everyone is watching. 3, when a key support level breaks, it almost always flips to become the new resistance ceiling. And finally, number 4, a big spike in volume helps confirm that a price move is the real deal.
See, when you combine these simple ideas, trend, support, resistance, and volume, a chart stops being a confusing mess and it turns into a story. It's a story about the constant battle between buyers and sellers. So the only question left is, now that you can read the lines, what stories are the charts going to tell you? Okay, so you open up a financial chart, and what do you see? For most people, it's just a bunch of jagged, confusing lines. It looks like pure noise. But what if I told you that inside all that chaos, there's actually a story, a clear narrative just waiting to be read? Well, that's exactly what we're going to do today. We're going to learn how to turn that noise into a narrative. At first glance, a chart like this can feel pretty intimidating, right? Is it a friend full of helpful clues, or is it a foe just there to confuse you? The truth is, it's packed with a powerful story, but you have to know how to speak its language. And today, we're going to learn the absolute basics of that language. So, where do we even begin? What's the very first word you need to know in this new language? It's trend. That's it. This one single concept is the foundation for pretty much everything else. And the best way to get it isn't with some complex formula, but with a simple pattern you already know really, really well. It's just a stair-step pattern. Seriously, think about it. In an uptrend, the price moves up, it takes a little breather, and then it moves up again. This creates higher highs and higher lows. It's like you're walking up a flight of stairs. And a downtrend? You guessed it, it's the exact opposite. You get lower highs and lower lows, like you're walking down the stairs. The key takeaway here is that nothing goes straight up or straight down forever. It's the step-by-step movement that defines the trend.
Okay, so you've got the stair-step idea down. Simple enough, right? Well, here's where things get really, really interesting. The trend you see, that story the chart is telling you, can completely change depending on how far away you're standing. You know, a chart might be showing the price dropping over the last few weeks. Looks like a terrible investment, right? But what happens when you zoom out and look at the last 2 years? You might discover that little short-term dip is just one tiny step backward on a very long staircase that's been heading up for ages. Perspective, it's everything. And this perfectly explains why different people use different charts. A long-term investor who's thinking about where their money will be in a year or 5 years, they care about the big picture. So they're looking at weekly and monthly charts. But a day trader, they need to know what's happening right now, so they're glued to the hourly and daily charts. It all comes down to what your goals are. All right, theory is great, but let's see how this all works in the real world. Let's pull up a chart of the S&P 500 and see if we can spot that stair-step pattern in the wild. Okay, here we are looking at a daily chart of the S&P 500. Now follow the peaks and valleys with me here. You can see how the price pushes up to a new high, then it pulls back to form a low, but notice that low is still higher than the one before it. Then, boom, it pushes to an even higher high. That is your classic uptrend staircase, right there in action. Now let's zoom out. We're going to switch over to the weekly chart, where each of those bars represents a full week of trading. And what do we see? Well, it's the same story, just on a much grander scale. We've got our lows, our higher lows, and our higher highs. The short-term daily picture and the long-term weekly picture are telling us the exact same thing. This is what we call a confirmed uptrend. There's this famous saying on Wall Street, the trend is your friend. And as we just saw with the S&P 500, when you're moving with the trend, you've got the wind at your back. But sometimes your friend can be a little bit deceptive. And now for our second case study. Ooh, this one is good. It comes with a fantastic plot twist. This is where you'll really see why looking at just one time frame can get you into a world of trouble. Okay, so take a look at this daily chart for a company called GWPH. We see a high, then a pullback to a lower high, and then another drop to a lower low. I mean, come on, that is a textbook downtrend. It looks like the bears, the folks betting the price will go down, are totally in charge here. The evidence seems pretty clear, doesn't it? Based on this chart alone, you'd think this stock is in real trouble. But is that the whole story? Are we maybe missing something important here? And here it is, the reveal. When we zoom out to the weekly chart, the picture completely flips on its head. That scary-looking downtrend on the daily chart, it turns out it's just a small, healthy little pullback inside a massive long-term uptrend. The bulls, the ones who think the price is going up, were actually in control the whole time. What a twist, right? And that is why relying on just one time frame is like trying to drive with blinders on. You're only seeing a tiny piece of the road ahead. You have to zoom out to see the whole map and understand the real story. Okay, so now we know how to read the trend, and we definitely understand why timeframes are so important. So how do we actually turn all this knowledge into a strategy that we can use? It really comes down to this. Think about paddling a canoe down a river. If you trade with the main trend, like buying into that S&P 500 uptrend, you're paddling with the current. It's just easier. The river is helping you get where you want to go. But if you trade against the trend, like betting against that big GWPH uptrend, you're paddling against the current. It's way harder, and those kinds of trades need to be quick because you are fighting the main flow of the river. So let's boil it all down into a simple game plan you can use for any chart. Number 1, find the stair-step pattern. Just identify the highs and the lows. Number 2, change your time frame. You got to zoom out to the weekly and zoom in to the daily. 3, put those pieces together so you know the bigger picture. What's the dominant long-term trend? And finally, number 4, trade accordingly. Align your strategy with what the chart is telling you. So those confusing lines on a chart, they aren't just noise anymore, are they? They're a map. They're telling a story about human psychology, about fear and greed and optimism. You now have the basic tools to start reading that map for yourself.
The only question left is, where are you going to let it take you? You ever look at a financial chart, you see the price candles, and then all those squiggly lines underneath? The ones that look like a heart rate monitor? Well, those are called indicators, and today we're going to demystify them. Let's figure out how to turn those confusing lines into a story you can actually read. So this is the big one, isn't it? This is the dream. Can you find some magic combination of lines that tells you exactly what the market's gonna do next? Just buy when the blue line crosses the red line and boom, you're a millionaire. But is it really that simple? Well, there's your answer. Right there, plain and simple. Let's say it again. Indicators are descriptive. They are not predictive. What does that mean? It means they are fantastic at telling you what has already happened, but they have absolutely no crystal ball for what's about to happen. This is probably the single most important thing to get right from the start. Okay, so let's just rip the Band-Aid off and tackle this idea of predicting the future head on. If these tools can't tell us what's coming, then what in the world are they even for? Here's what an indicator really is at its core. It's basically a fancy calculator. It takes all the same data you can already see in the price candles, the open, the high, the low, the close, and it just runs it through a math formula. It's not giving you new information. It's just giving you a different view of the same old information. And because they use old data, indicators are, by their very nature, lagging. They're always a step behind the live price. A lot of the most common indicators, they're looking at the last 14 periods of data. So the number you see right now is based on stuff that happened up to 14 days or 14 hours or 14 minutes ago. They're literally looking in the rearview mirror. So you're probably thinking, if they're always looking backwards, how are they useful at all? Well, think of it like forecasting the weather. A meteorologist looks at historical patterns. They look at what the pressure and the wind are doing right now, and they make an educated guess. They don't know for sure it's going to rain tomorrow, but they can say, hey, based on everything I see, there's a really high probability. And that's exactly what indicators do for us. They help us see probabilities, not certainties. So, okay, if they're not crystal balls, what are they? Let's stop talking in theories and get practical. We're going to break down one of the most popular indicators out there so you can see exactly how it works under the hood. We're going to use the RSI, which stands for Relative Strength Index. Its main job is to act like a speedometer for the market. It measures the speed and the strength of price changes. And by doing that, it tries to tell us if the price has gone up too far, too fast, what we call overbought, or if it's dropped too far, too fast, what we call oversold. Now, the RSI is pretty simple to read. It's just a scale from 0 to 100. The general rule of thumb is that any reading over 70 is considered overbought. Think of it like a car engine running hot in the red zone. It suggests that all the buying might be getting exhausted. And on the flip side, a reading under 30 is oversold. That suggests the sellers are getting tired and the price might be due for a bounce. All right, so we know what the RSI is supposed to tell us. But to really, truly get it, we need to pop the hood open and see how that little number actually gets made. Yeah, we're going to look at the math. Whoa, okay, don't freak out. This looks super complicated, I know, but we're not trying to become math wizards here. The only thing you need to see is that this is all it is. It's a formula. It takes the average gains and the average losses from the past and plugs them into an equation. It's just math, not magic. Let's break that scary formula down. It's actually pretty simple. The indicator first looks back at the last 14 periods and calculates the average size of the up moves. Then, it does the same for the down moves. Step 3, it just compares the two. It divides the average gain by the average loss to get a ratio, and that tells you the relative strength. Finally, it just plugs that ratio into a formula to squish it onto that easy-to-read 0 to 100 scale. That's it. Right about now, you might be thinking, okay, that's kind of neat, but why do I care? Can I just wait for the line to go above 70 or below 30? Well, understanding the why behind that number is what separates the amateurs from the pros. This quote right here hits the nail on the head. If your entire trading strategy is just, I'm going to buy when this line crosses that line, you don't really have a strategy. You have a superstition. Without understanding what's going on behind the scenes, you have no clue why those lines are crossing, or more importantly, when that signal might be a total fake out. See, this is where you get a real edge. When you know how the RSI is built, you know that a high reading actually means that the recent up moves have been significantly stronger than the down moves. You start to understand its strengths, but also its weaknesses.
You stop being just a passive observer waiting for a light to turn green, and you become an informed analyst who can actually interpret the data. And that brings us to the biggest point of all. An indicator is never, ever the whole story. It's just one chapter in a much, much bigger book. A smart trader reads the entire chart. They look at the shape of the candlesticks, they check the trading volume, they understand the overall trend. An indicator isn't the main signal. It's just one extra piece of evidence that adds color and context to the bigger picture that the price is painting. This right here is the perfect example of why context is everything. A doji candlestick, the one that looks like a plus sign, it means indecision. Now, if you see that exact same candle at the very top of a huge uptrend, it's a major warning sign. It means the buyers are exhausted. But if you see that same exact doji at the bottom of a long downtrend, it's a bullish sign that the sellers are running out of gas. It's the same signal, but with a completely opposite meaning, all because of where it showed up in the story. So I'll leave you with this question. The next time you pull up a chart, ask yourself, are you just watching lines, hoping they'll tell you what to do? Or are you taking a step back, looking at all the evidence, and actually reading the story that the market is telling you? That right there is the difference that matters. Welcome to The Explainer. Today, we're going to tackle a topic that gives pretty much everyone a headache: crypto's taxes. It's notoriously complicated, I know, but the good news? There's software out there built specifically to solve this exact problem for you. So, let's just paint a picture here. You did your research, you picked a hot altcoin before it went mainstream, and boom, it went to the moon. Those gains are real, and they are sitting right there in your wallet. It feels great, right? But, and it's a big but, with those amazing gains comes a really big problem. This isn't something you can just hand over to your family accountant. As our source material points out, this stuff is so complex that most accountants will literally run for the hills if you even mention crypto. And that's when that sinking feeling hits you. You realize you have to account for every single trade, every swap, every little bit of staking income. The sheer amount of data is just overwhelming, and, the temptation to just close your eyes and pretend it doesn't exist is huge. Okay, so let's break this down. Here's our game plan. First, we're going to really unpack why this is such a problem. Then we'll see how software can save the day. We'll look at the best tools for US traders, then for global pros, and finally, we'll help you make the right choice for you. So this is really the core of it, right? After you've had a successful run, you're standing at a fork in the road. You've basically got two choices on how to deal with the tax man. On one hand, you can try to do it all yourself, the manual method. This means weeks of your life buried in spreadsheets, trying to make sense of it all. Or there's the hope method, just hope nobody notices, which, let's be honest, is super stressful. Neither of these is a good look. But thankfully, there is a third way, a much, much better option that lets you skip the endless spreadsheets and the sleepless nights. And that's where crypto tax software comes in. These tools exist for one simple reason: to do all the heavy lifting for you. They're built from the ground up to take this incredibly messy process and make it simple, saving you a ton of time and, let's face it, a lot of stress. And the process is actually pretty straightforward. First, you just connect your exchanges and wallets to pull in all your data. Next, you go through and tag any other income, from things like staking or mining. And finally, you click a button and boom, it spits out the exact reports you need to file your taxes. It's really that simple. All right, let's get into the nitty-gritty. We're going to start with two really popular tools that are built primarily for people in the US, CryptoTrader.tax and BearTax. And right away, you can kind of see they're aimed at different folks. CryptoTrader.tax is really geared towards beginners who just want something easy. BearTax, on the other hand, is perfect for someone who's super budget conscious, maybe someone who just holds a few coins. And wow, yeah, that price difference is pretty dramatic. For just $10 a tax season, BearTax is an incredibly cheap way to get started. I mean, that's less than a couple of fancy coffees. So really, it just comes down to what you need. If you want something that's super simple, that integrates with TurboTax, and has cool features like tax loss harvesting, CryptoTrader.tax is your winner. But if you're all about saving money and maybe you do some high-frequency bot trading, then BearTax is definitely the way to go. Okay, but what if you're not in the US? Or what if you're a serious, hardcore trader with thousands of transactions and all sorts of obscure altcoins? Well, that's when we need to bring out the big guns.
And you can just see the power here. I mean, look at this. Coin tracking is an absolute data machine. It supports 12 different ways to calculate your taxes and over 7,500 coins. CoinLee, meanwhile, is all about getting the rules right for your specific country and has a really slick AI feature. And this is where CoinLee really shines. It's not just a US tool that kind of works elsewhere. It was built from day one for a global audience. We're talking full, dedicated support for the tax laws in over 20 countries, like Canada, the UK, Australia, and many more. So here's why our source material picks CoinLee as the top dog. That smart transfer matching feature, it's a total game changer. It's smart enough to know when you're just moving crypto between your own wallets so you don't accidentally report a huge gain and pay tax on it. That, plus its massive support for exchanges and DeFi, makes it an incredibly powerful tool. Okay, so we've thrown a lot of options at you. How in the world do you actually pick one? Let's just tie this all together and make it super simple.
You know, the source is really direct with its final advice. It basically says that for most people who are pretty active in crypto and live in one of those supported countries, CoinLee is the one. It's the best all-around solution. This right here is probably the most important slide. It's your cheat sheet. Just find your profile on the left and it'll point you to the right software. If you're a beginner in the US, check out cryptotrader.tax. If you're watching every penny, Bear Tax is for you. If you're a global pro trading every altcoin under the sun, coin tracking is your beast. And for just about everyone else, CoinLee is the place to start. So at the end of the day, these tools are amazing. They solve a very real, very complicated problem that exists right now. But the fact that we even need them, it just shows how messy this all is. And it leaves us with one final thought. As crypto gets bigger and bigger, how are the tax laws themselves going to have to change to make this whole process simpler for everybody?